Just wait for a few minutes. We're going to start. Good morning, everybody. Okay, shall we make a start? Okay. So today we are going to revise Group 2 Accounting Standards. Okay, totally how many standards are there in Group 2? How many accounting standards are there in Group 2? So altogether we are having 13 standards, 13. 13 standards are there in Group 2. Now out of which one standard is chapter related, so which is AS 14, amalgamation. One standard is chapter related, which is amalgamation. So that means excluding that, we have how many standards? 12 standards. Excluding that, we are going to have 12 standards. Now today we will revise all these 12 standards. Now totally we are having how many sessions? 4 sessions today. So what I'll try to do is, in each session, we'll try to cover 3 standards. Out of the existing standards, I'll take one big and 2 chota standards, so that in each session, we can complete 3 altogether. So by the end of today, we are going to complete all the 12 standards. Shall I start? Okay, right. First, we'll start with some short standards, of course, or we can say Lilliput standards also. So what are those standards, sir? So in this session, let me confine to AS4, AS5 and AS7. So in this first 2-hour session, so let us try to complete these 3, sir. Then in the later on other sessions, in each session we'll try to complete another 3 standards. Now let me tell you one thing. Sir, I'm just going to brief you most of the topics. Now it is not that for each and every provision we are going to learn logics. It's not possible within the time we are having. but wherever difficult aspects are there or wherever logics are required, I will communicate. Is that clear, everybody? And one more thing, I just don't want to explain only theory, sir, because ultimately in exam, you're not going to write any theory answers. You're going to attempt some practical questions. So what I'll do is, I'll link up both practical aspects as well as theory. I'll just communicate theory in a short manner and I'll just go through at least 4 or 5 questions in every standard so that some important aspects will be completed even through questions also. Is that clear, everybody? Then only it becomes a complete revision. If we just learn theory, maybe for us completion will be simple. Later on at the time of examination, suddenly reading a practical questions once again may be a difficult aspect. So when we are doing revision, we'll do both the things. We'll learn some theory and I'll show you some questions also simultaneously, which are more important. It is not possible to complete all the questions, but at least important questions we will complete. Theory also, whatever required for examination, to that extent we'll complete, and then the questions. So I think with this little introduction, we are ready to start with the standards. So first, let me start with AS4. What is the name of the standard? Contingencies and events occurring after balance sheet date. Contingencies and events occurring after balance sheet date. One of the smallest standards, of course not in terms of name. Hello. One of the smallest standards in terms of content. What we are going to learn here, sir? So mainly our discussion is going to be on events occurring after balance sheet date, because most of the provisions of contingencies were already transferred to another standard, AS29, provisions, contingent liabilities and contingent assets with effect from 1/4/2004 onwards. So that means now our discussion is going to focus on events occurring after balance sheet date. Maybe you might get doubts, one doubt. Sir, why the word contingencies is still continuing? Logic is simple. There are 1 or 2 contingencies which are still not covered by AS29 and are still continued in AS4. For that reason, we'll start with the word contingencies. If you ask me what is that contingency, it is relating to doubtful debts, sir. That provision for doubtful debts. Okay, right? Anyway, so let me start with the main aspect of this chapter, that is events occurring after balance sheet date. So what do you mean by events occurring after balance sheet date, sir? First we should know the meaning. So those events, hello everybody, those events which occurs after balance sheet date. So this is balance sheet date, let us assume, sir. Those events which occurs after balance sheet date and before approval of financial statements, usually done by board of directors. For companies it is board of directors, for partnership firm maybe partner, like that. So approval of financial statements by the approving authority. So please remember, those significant events which occurs between balance sheet date, of course that is after balance sheet date and before approval of financial statements by board of directors, they are called as events occurring after balance sheet date. If we look at in a dictionary language, sir, if something happens after approval of financial statements, is it an event occurring after balance sheet date? Dictionary wise, yes. Hello, this is 31st March 21, sir. Now here it is, let us say 1/7/21. Now anything after 1/7/21, is it an event occurring after balance sheet date or not? Maybe dictionary wise, yes only, sir. But still, for the purpose of our standard, we talk about only those events which happens after balance sheet date and before board approval. Because once the financial statements are approved by the board of directors, now whatever is there in the financial statements, for that board of directors feel responsible. Now if anything happens after their approval, they will say, I am not responsible for such event. To keep them responsible, now we are going to talking about only such events which happens after balance sheet date and before board approval. So hope the scope of the standard is clear. It is not everything that happens after balance sheet date. So it is after balance sheet date and before approval of financial statements by board of directors. So that is what the definition or the meaning of events occurring after balance sheet date. Now these events will divide into two types. Whatever events are there, we are going to divide into two types. One is adjusting events. The other one is non-adjusting events. Whatever events occurring after balance sheet date, please remember, we are dividing events occurring after balance sheet date. So whatever events occurring after balance sheet date are there, so that only we are dividing into two types. One is adjusting, the other one is non-adjusting. What do you mean by adjusting, sir? So very simple, adjusting event refers to those events which provide further evidence to the conditions existing as on balance sheet date. Something I have said, it should provide further evidence to the conditions existing as on balance sheet date. Sir, then what is non-adjusting? If it is indicative of conditions, that arose subsequent to the balance sheet date. That means if condition itself arose subsequent to the balance sheet date, so those are called as non-adjusting events. Sir, we are dividing into two types. One is adjusting, the other one is non-adjusting. Adjusting means those events which provide further evidence to the conditions existing as on balance sheet date. Non-adjusting event means it represents those events which are indicative of conditions that arose subsequent to the balance sheet date. In other words, to call it as an adjusting event, first of all, it should be an event occurring after balance sheet date, because what we are dividing into adjusting and non-adjusting, sir, events occurring after balance sheet date only. So therefore, first it should be a event occurring after balance sheet date. Next, it should provide you, first of all, it should have a condition existing as on balance sheet date, and this event should provide further evidence. So if like that all these three are satisfied, then we will call that event as a adjusting event. If these three are not there, then we don't call it as a adjusting. Anyway, we will say mainly this aspect, sir. If condition arose subsequent to the balance sheet date, so that we will call as what, sir? Non-adjusting event. Sir, is that clear, everybody? Hello, everybody, is that clear, sir? Let me quickly summarize one thing, sir. Before summarizing, let me give you the accounting treatment also. Sir, if it is adjusting event, what is the accounting treatment? What you will do? Name itself conveys. You have to adjust. What you will adjust, sir? Assets or liabilities. Because ultimately, what remains in the financial statements? Balance sheet values only. Because any incomes or expenses are closed by charging to P&L. So thereby we are going to adjust what, sir? Assets and liabilities. Now what about non-adjusting events, sir? What we are going to do? Are we going to adjust, sir? No. Are we going to disclose, sir? We are also not going to disclose in the financial statements. Neither will adjust nor will disclose in the financial statements. But if it is material, but if the event is material, we can disclose, but not in the financial statements, but in the board of directors report. So if it is material, we are going to disclose in the board of directors report. Hope you know that board of directors report is not a part of financial statements. So if it is adjusting events, we are going to adjust the assets and liabilities and suitable disclosure also for the same, for the adjustment. And we are going to use suitable disclosure also for adjustment. If it is a non-adjusting event, neither will adjust nor will disclose within the financial statements. However, we are going to disclose in the board of directors report. So hope it is clear. Now, let me quickly summarize, sir, because this is okay theoretically, but when we are solving questions, we should have one particular approach, sir. So let me discuss that approach. Look here carefully. In the question, first observe when the event has occurred. What is that? When the event has occurred. So if whatever event is there which is occurring after balance sheet date, we will observe, sir, first whether that event is before board approval or after board approval? Something I have said. If it is it before board approval or after board approval? So if it is after board of directors approval, now first of all, is it an event occurring after balance sheet date as per AS4? No. It's not a event, because our scope clearly says those events which occurs after balance sheet date and before board's approval. So if it is after board approval, not a event at all. No sir, before board approval only. Then clearly check whether condition was existing or not existing as on balance sheet date. So if condition is existing as on balance sheet date, usually further evidence will be there, sir. So that's not a big point to be checked. The big point to be checked is whether condition is there or not. So if condition is not existing, another point. So condition existing or not existing. If condition is existing, what we will say, sir? Adjusting. Hello, what, sir? Adjusting. So if condition is not existing on balance sheet date, what we will say, sir? It's a non-adjusting. It's a non-adjusting. Sir, these are the principles to be followed. But in the standard, they have given one exception to these rules. Hello? They have given one exception to these rules. What is that, sir? Sir, usually non-adjusting events are to be adjusted or disclosed? Nothing. They are not to be adjusted, not to be disclosed. Only max what we will do, sir, will disclose in the board of directors report. But they have given an exception. If at all a particular event is affecting your going concern. Hello, what is that? If a particular event is affecting your going concern, then even though it is a non-adjusting event, that means even though condition is not existing as on balance sheet date, then also we'll still adjust the financials, because, sir, a big fire occurred after balance sheet date. Let us say somewhere in May, big fire occurred, entire entity got destroyed. It is very clear that maybe within 6 to 9 months we are going to close our entity only. Now in the AGM, when you show that financial statements, now will you show that we are having financials on going concern basis? Now that means you are cheating the shareholders. So hope you are getting. So though condition is not existing, because nobody can expect fire, sir. For fire, there will not be any condition before balance sheet date. But still what we say, go and adjust the financials. It amounts to cheating the shareholders only if you doesn't disclose it to the shareholders. So hence, except going concern, in all other scenarios we say non-adjusting only. But in the case of going concern alone, though condition is not existing, we will call it as a adjusting. In other words, we'll adjust the financials. So what you have to check is, if condition is not existing, check whether going concern affected or not affected. If going concern affected, one way. If going concern not affected, another way. Sir, if going concern is affected, what we will do? That means no more going concern, sir. So what we have to do? We have to adjust the financials and prepare it. Adjusting financials means what, sir? Preparing on NRV basis. Hello? Generally, when the company goes into liquidation, we'll prepare the financials on which basis? NRV basis. If going concern is not affected, no big discussion. It's a non-adjusting event. That's all, sir. If you remember, if you apply this chart, all the questions will be very, very simple. One last time I'm revising the chart. So what is that, sir? First is event, if there is an event occurring after balance sheet. Let me tell you one thing, sir. In the question they might have given 2 or 3 events, sir. But for us, what is important? It should occur after balance sheet. That is only event for us. So whatever event occurred after balance sheet date, check whether it is before or after board. If it is after board approval, not an event at all. Before board approval, then check for condition. If condition is existing, adjusting. If condition is not existing, then check whether going concern is affected or not. If it is affected, adjust the financials on NRV basis. Otherwise, simply non-adjusting event. Already we have seen the treatment also. Sir, is that clear, sir? So with this, theoretical part is completed, sir. The main important theoretical part for exam. Now what we will do is, we will take some questions, sir, and we apply the same concepts into those questions. Important questions. Is that clear, sir? Okay. Now what I am going to do is, I am not going to read the solution, sir. I'll just tell you clearly how it is becoming a adjusting events, because to become an adjusting event, how many things it should satisfy, sir? 3. What are the 3? First of all, it should be an event occurring after balance sheet date. Next, there should be a condition existing as on balance sheet date. Next, there should be a condition existing as on balance sheet date. Next, it should provide you further evidence. If these 3 things are satisfied, then it is a adjusting. Otherwise, we have to think non-adjusting or sometimes not a event. So what I'll do is, I'll take the question, sir. I'll not write any situation clearly. We'll just analyze these 3 aspects so that we'll have full clarity. Because more and more questions are there. Now we will not read solutions, sir, but I'll give you conclusions and I'll clear explanation as to how they are becoming adjusting or non-adjusting. So hope it is clear, sir. Now let me start dealing with few questions. Okay. Usually for a CRD alone, if you prepare sufficient for exam also, sir. Now let me quickly discuss those CRDs which are important for exam. Question number 1, sir. Sir, question, is that clearly visible? Okay. Let me read the question. While preparing its final accounts for the year ended 31st March 2017, company made a provision for bad debts or doubtful debts at the rate of 5%. In the last week of February, a trade receivable for 2 lakhs had suffered heavy loss due to earthquake and the loss was not covered by any insurance policy. In April 2017, trade receivable became bankrupt. In other words, debtor became bankrupt. Can the company provide for this loss? That is what the question, sir. Now, first of all, what is the event for us here? What is the event for us here? Now, in April, the debtor became insolvent. Sir, anything happened before 31st March, not an event for us, because no doubt relating to that, we will anyway record it. Our doubt is only with respect to that thing which happened after balance sheet date. So, event for us is debtor becoming insolvent. So, thereby, for that, first of all, is it an event occurring after balance sheet date? Now in the question, how do we check, sir? Look at the balance sheet date, look at the board of directors approval date. What is the balance sheet date? 31st March 17. What is board of directors approval date? Not given. Hence you have to take the assumption that the transaction happened before board of directors approval. You give an alternative also. If at all it happens after board approval, what will be your solution? Now here, it is before board approval. If you take that assumption like that, is it an event occurring after balance sheet date or not? Yes. Then is there a condition existing as on balance sheet date? Condition in the sense some indicator should be there for that, sir. Now debtor became insolvent. Is there any indicator for us before it? Now if you observe, there was an earthquake in the premises of the debtor, which shows that in future there is a chance for he becoming insolvent. So that's an indicator, sir. That is giving some information. Condition in the sense proper evidence, proper information. Now already some information is there, so thereby condition is existing. Now today you becoming insolvent is a further evidence. So that's all the 3 conditions are satisfied. It is a adjusting event. Now if at all that is after board approval, what we will say, it's not a event at all. Now sometimes in the same question, what they may say, sir, this earthquake also happened in April. Let us say in May he has become insolvent, sir. Now earthquake occurred in April. Now can we say, what is the answer? Adjusting or non-adjusting? Suppose earthquake in April, insolvency in May. Now is there any condition existing as on balance sheet date? No. In this scenario, it is non-adjusting event. So in the question, single question itself, they may bring the changes. Please be ready for that. Is that clear, sir? So this is question number 1. One of the important ones, sir, regularly asked. Next one, sir. During the year 2015-16, Raj Limited was sued by a competitor for 15 lakhs for infringement of trademark. Based on the advice of the company's legal counsel, Raj Limited provided for a sum of 10 lakhs in its financial statements. on 18th May, the court decided in favor of the party alleging the infringement of the trademark and ordered Raj Limited to pay the aggrieved sum of 14 lakhs. The financial statements were prepared by the company's management on 30th April and approved on 30th May. Now, first of all, what is the scenario? Somebody has filed a case against us, sir. When they have filed, sir, in the last year itself, somebody has filed a case. Now, as on the balance sheet date, with the information we know, what we thought, we are going to lose the case only. Our estimation. So, when we are going to lose the case, if the probability of losing the case is greater than 50, we'll create a provision. If the probability of losing the case is less than 50, we'll treat it as a contingent liability. Now, here the probability is greater than 50. That's why they have created a provision. But what they have created is only 10 lakhs. Hello, how much they have created? 10 lakhs. Now, in May, when sir 18th May, the judgment came out telling that, okay, you have lost the case and you have to pay 14 lakhs. It's not 10 lakhs, it is 14 lakhs. Now, the question is, for this 4 lakhs, shall we provide it or not? In the last year financials only, shall we adjust it or not? Is this an adjusting event or not? First of all, tell me, is this an event occurring after balance sheet date, sir? When it occurred, sir? After 31st March and before board approval. Board approval is 30th May, whereas event occurred on 18th May. So, thereby, it's an event occurring after balance sheet date. Is there any condition existing, sir? Is there any condition existing? Yes. What is the condition? Already, case was filed and we have created a provision also. Case was filed, it is sufficient, sir. There is sufficient information. Then, the judgment is giving you further evidence. Thus, all the three conditions are getting satisfied. As a result, this is also which event, sir? Adjusting event. There is the question clear? Okay, right. Now, let me move to the next one, sir. Question number 3. Possibility is there. Now, A Limited closed its accounting year. Be careful with respect to the year, sir. When it was closed, 30th June. And accounts for that period were considered and approved by board of directors on 20th August. So, what is the date of approval, sir? 20th August. Company was engaged in laying pipeline for an oil company beneath the earth, underground, sir, under the earth. They are laying a oil pipeline. While doing the boring work on 1st September 2020, it met a rocky surface for which it was estimated that there would be an extra cost to the tune of 780 lakhs. Very simple. We have entered into a contract for laying a oil pipeline. So, initially we might have agreed for some price, sir, because we have estimated some cost. Now, today when we have started the contract, suddenly during the contract, we have observed that there was a rocky surface. Now, for removing that rocks itself, we have to incur some extra cost. As a result, in the contract, we may face a loss. Are you getting the point, sir? Now, the question is, first, is this an adjusting event or not? First of all, tell me, is this an event occurring after balance sheet date or not? What is the date of balance sheet date, sir? Nothing but 30th June. Date of approval, 20th August. Now, tell me, when the event has occurred, sir? After balance sheet date, that is 30th June, and before board approval, after board approval? 20th August is board approval, sir. So, here the date is after board approval. Hence, it is which event? Adjusting or non-adjusting? Both are wrong. It's not an event at all. That is what I have said, sir. Sir, first of all, to call it as an adjusting or non-adjusting, it should be what, sir? Event occurring after balance sheet date. If it becomes this only, then only it can become adjusting or non-adjusting. So, in this scenario, it is very clear, sir. Now, it is not an event occurring after balance sheet date. So, straight away, no discussion of other two, sir. It is not an event at all as per AS4. Now, you could observe, in this case, the event finding rocky surface became evident after the date of approval. It's not an event occurring after balance sheet date. It is not covered by AS4. In the board's report, it's up to you, sir. Nobody will question you why you are showing in board's report. If it is if you are showing to if you are showing to the users of financial statements, maybe shareholders, then questioning will come. Board of directors report, even though whether it is non-adjusting or not an event also, you can report. The discussion clear? Suppose in the same question, now rocky surface became evident on 10th August. Now can you please tell me which event it will be? Suppose in the same question, rocky surface became evident on 10th August. Now, is it an adjusting or non-adjusting? First of all, is it an event occurring after balance sheet date? Yes, it's an event occurring after balance sheet date. Is there a condition existing as on balance sheet date? Rocky surface is the, I think that's the information we are having. Today we found it. Now, is there any condition existing already? The answer is yes, condition is already existing, but you are not aware. That's all. Do you think some of your competitors suddenly brought the rock and kept it under the ground? Hello, is that possible, sir? I think this rocky surface was already there before 31st March. If it was there before 31st March, that means already condition is existing, but you don't know. Hello. Your awareness doesn't matter, sir. I think we say ignorance of law is of no excuse. Not only law, accounts also. Of course, here, now what I say is, sir, you should be aware, sir. Just because you are not aware, now we cannot stop recording. It has to be adjusted. It is an adjusting event. Logic is also very clear, sir. If we say, okay, board of directors are not aware, hence let us call it as non-adjusting, let us not record it, then board of directors will use this technique in a fraudulent way, sir. What they say is, suppose any big fraud happens, sir, of course, they only might have committed. Hello, what they say, we don't know about that, sir, when it occurred. No, when you have communicated only, we understood that is this event has happened. We never know about that event. Now, because board of directors are claiming, they never know about it. Now, what you will say? Non-adjusting. So let us disclose in the next year. If you say like that, that means they are not trying to disclose the loss and push it to the next year. We will not allow that if there is a mistake on the board of directors side. Sir, when they are taking a contract, it is their responsibility to check whether the surface was proper or not. When they are taking a contract for laying a pipeline, it is their responsibility to check whether the surface was proper or not, whether it is having rocks or not. It is their mistake. For their mistake, now we cannot stop recording it. It's an adjusting event, has to be recorded. Discussion clear? So be careful, sir, in the examination to bring that twist. They may change the date. Actually, the given question is very simple because anyway it occurred after board of approval. So it's not an event. Suppose they give 10th August, then it becomes a adjusting event. So hope everybody have understood, sir. Okay, right. Let me move to another question, sir. Now, sir, this is a specific question. Actually, we have discussed about exceptions. No, what we have discussed about exceptions. Going concern is one exception. Now, proposed dividend, law related. If statute also requires anything, that is also exceptions are actually. So, generally, if there is proposed dividend, hello, what is that? Proposed dividend. Sir, let us say for the last year, that means year ending 31st March 21, we have proposed dividend in April. Now, is this an adjusting event or not? Suppose for the year ending 31st March 21, we have declared a dividend, we have proposed dividend, board of directors have proposed dividend in April. Is this an adjusting event or not? No, sir, because for a dividend, what condition is already existing, because nobody knows whether dividend will be declared or not, whether board of directors will propose it or not. So thereby condition is not existing. It is which event, sir? Non-adjusting. So usually should not be adjusted, should not be disclosed also. Max you can disclose in board of directors report. But as per schedule 3, if you are having any proposed dividend, it has to be disclosed in the notes to accounts. Hello, what, sir? It has to be disclosed in the notes to accounts. So actually as per AS4, nowhere it should be disclosed. But because of schedule 3, statutory, schedule 3 of which act, sir? Companies Act, statute. If statute says anything against, we have to follow, because AS and statute, if there is conflict, which one will prevail? Statute, law will prevail. So thereby, so for proposed dividend, though it is a non-adjusting event, still we will disclose, will not adjust, because only declared dividend will be shown as a liability. So any proposed dividend will be just disclosed in the notes to accounts. It is not to be recognized, only it can be disclosed. That too because of what, sir? Schedule 3 requirement. Usually it's a non-adjusting event, but because of the schedule 3 requirement, statutory obligation, we will disclose in the notes to accounts. So hope this part is also clear. Now, let me take one good question, sir. With this, we'll close the discussion. 7 and 8, similar questions. Look at question number 7, sir. An earthquake destroyed a major warehouse, or first let us go to 8, then it will be so clear to you. The accounting year of delimited on 31st March 2020, okay, ended on which date, sir? 31st March 2020. But the accounts were approved on 30th April 2020. On 15th April 2020, a fire occurred in the factory and office premises. The loss by fire is of such a magnitude that it is not possible to expect the enterprise delimited to start the operations again. State with reasons whether the loss due to fire, is it an adjusting or non-adjusting event? Tell me, sir, adjusting and non-adjusting. Sir, is this an adjusting or non-adjusting? So usually for fire there will not be any condition, sir. It's a non-adjusting. When condition is not existing, immediately we have to check whether going concern is affected or not. From this question, do you think going concern affected or not affected? Affected, because they are telling it is not possible to expect the delimited to start the operations again. Hence going concern is affected. So thereby, though it is a non-adjusting event, though condition is not existing, but still because going concern is affected, we are going to adjust it and we are going to prepare financials on which basis, sir? NRV basis. We will consider this as an adjusting and we will adjust the financial statements on NRV basis. So hope everybody have understood, sir. Okay, right. Next, sir, in this question, in question number 7, what they say is, it destroyed a major warehouse. Almost the question will be same. What they say is, it destroyed a major warehouse. Now they will not say anything that it is not possible for the enterprise to start the operations again. They'll simply say, and they have destroyed a major warehouse. Now what do you say, adjusting or non-adjusting? Here also suddenly earthquake occurred after balance sheet date only, condition is not existing, it's a non-adjusting event. But the question is, going concern affected or not affected? If major warehouse is destroyed, going concern will be affected or not affected? Both are possible, sir. Because some people, they feel that major warehouse itself is lost. To recover this loss, it may take so much of time. So thereby they may close the organization. Some people, no, let us revive it. Only one of the warehouse, one major warehouse may be destroyed. Still other aspects are there. We can continue. In the question, there is no clarity, sir. Then there is no clarity. Then there is no need of clarity in your answer also. Hello. In other words, you are going to write in both the ways. Hello. You will take an assumption that if going concern is affected, what is the answer? If going concern is not affected, what is the answer? But usually, if they simply say major warehouse, first we'll start with the assumption that going concern is not affected, then we'll go for if going concern is affected, then you will be on a safer side. So discussion clear? So in this we have to answer CRD 7. With one last question, we are going to close this standard, sir. Question number 8, regularly asked in the exam, with which we are going to close. Sorry, CRD 9. Now please look into the question. What is year ending, sir? 31st March 2020. What is the board of directors approval date? 15th July 2020. So there are some issues given in the question, sir. Let us look after it. First one, a suit against the company's advertisement was filed by a party on 20th April 2020 claiming damages of 25 lakhs. When the event occurred, sir? After balance sheet date, before board approval. It's an event occurring after balance sheet date. Okay. Is it having any condition? Suit itself was filed after balance sheet date. If case was filed before balance sheet date, if there is some judgment after balance sheet date, then we can say, okay, already condition is existing suit. Now this is a further evidence. But here case itself was filed after balance sheet date, that this becomes what, sir? Non-adjusting event. There is the discussion clear. Next one, the terms and conditions for acquisition of business of another company have been decided by March 2020, but the resources were arranged in April and amount invested was 50 lakhs. Would you, okay, now tell me, is this an adjusting or non-adjusting? Terms and conditions were decided already, sir. What do you mean by terms and conditions getting decided? Agreement. They might have entered into a agreement. Agreement was already entered before 31st March, whereas actual investment was done in April. Shall we record this in the books of accounts or not? Already, first of all, is it an event occurring after balance sheet date? Yes. because it occurred in April, which is after 31st March and before board approval. Is there a condition existing? Yes, agreement is a condition. So thereby definitely it's a adjusting event. Further evidence is also there that you have invested. So thereby it's a what, sir? Adjusting event. Now would your answer change if by 31st March only negotiations were completed? Now tell me, if just the negotiations were completed, will we call it as an adjusting event? The answer is no, sir. Please understand. You may think something happened before 31st March. No, sir. Their agreement, here negotiations. What is the difference? Big difference is there, sir. Agreement is a proper evidence, conclusive evidence to say that in future the acquisition may happen. Negotiations will deal with 100 parties, sir. Will bargain, then will come to a conclusion, sir. So negotiations alone cannot be taken as a conclusive evidence. Negotiations is just the starting stage, sir. First proposal will happen, next negotiations will happen. All these are starting stages. Only a proper evidence is to be considered as a condition existing as on balance sheet date. So negotiations will not amount to two conditions existing as on balance sheet date. So in such a case, it is not a adjusting event. It becomes a non-adjusting event. The discussion clear? So that is what negotiation. Next, theft of cash of rupees 5 lakhs by the cashier on 31st March, but the theft was detected on 16th July 2020. First of all, what is the event for us, sir? Detection of theft. So when it was detected, sir? 16th July. So first of all, is it an event occurring after balance sheet date? No, because board of directors approval date is 15th July. It's event. It is not an event occurring after balance. First of all, it's not an event at all as per AS4 because it is occurring after board approval. Is that clear, sir? Suppose it was detected on 14th July. Now, that is event occurring after balance sheet date because after after balance sheet date before board approval. So it's an event occurring after balance sheet date. Is there any condition existing as on balance sheet date? Is there any condition existing? Already theft was committed, sir. But you don't know it. You are not aware. That is what I have said. Just like rocky surface. Already rocky surface was there. Already cash was taken away by somebody. So thereby already condition was existing. But you are not aware. Your awareness doesn't matter. Is that clear, sir? So thereby, so already condition is existing. Now it's just providing you further evidence. The detection of theft is giving you a further evidence. That this is also what, sir? Adjusting event. The discussion clear? So with one last point, I'll close, sir. Usually first 4 or 5 points only regularly asked, sir. We'll close that. Now company sends a proposal to sell an immovable property for 40 lakhs in March 2020. The book value of the property is 30 lakhs. However, the deed was registered on 15 April. Before 31st March, what happened, sir? Proposal. Hello, what is that? Proposal. Then in April, maybe the deed was registered and everything, sale, consideration, everything was completed. Now tell me, first of all, is it an event occurring after balance sheet date? Yes, because it is before 15th July. Then, is there any condition existing as on balance sheet date? Once again, I am telling, sir, proposal is the starting stage. Next, negotiations. After that, we'll bargain with different people. Then only we'll enter into agreement, terms and conditions. Once terms and conditions are finalized, that is agreement, then only it's a proper evidence. Proposal or negotiations, these are not proper evidence. So that's why no condition is existing. As a result, it becomes a non-adjusting event. A major fire has damaged the assets in a factory on 5th April. Now tell me what happens on 5th April after balance sheet date before board approval. Now a major fire has damaged almost all the assets. So no condition is existing, non-adjusting. Now we have to check whether going concern is affected or not. Affected or not affected? With one single line they are telling assets are fully insured. So thereby going concern is not affected. It becomes a non-adjusting event. So thereby what we have to do? Neither adjust nor disclose. If material, just disclose in the board of directors report. That's all, sir. With this we are closing AS4. Sir, have you all understood? I think we have covered many aspects in the standard, sir. I have covered good theory and questions also. We have covered more than 50%, at least some 60 to 70% of the questions we have completed. This is very much sufficient for the exam. Shall I proceed? Okay, right. So let me move to another standard, sir. AS5. The biggest standard in terms of name, once again, AS5. So what is that, sir? Net profit or loss for the period. All book readers be ready. Net profit or loss for the period, comma, prior period items and changes in accounting policies. And changes in accounting policy. I think this is the name of the standard. Net profit or loss for the period, comma, prior period items and changes in accounting policy. Sir, why you are discussing name always, sir? Why you are writing name? I can tell you one thing. In examination, if you write any answer without quoting AS name and number, it's a crime. We are going to reduce 1 mark for that. In any question, if you just don't mention AS name and number, we are not going to give you full marks, sir. 1 mark will straight away be reduced. Because when we ask any question, are we asking your opinion? We are asking a question. You will say yes or no, do in this way, do in that way. Now, it is not your opinion, sir. It is opinion as per standard. Then you should clearly mention in your answer that this as per so and so standard with so and so name. Sir, is that clear? So please remember, particularly in theoretical standards like this, 4, AS4, AS5, AS9, AS18, there are many theoretical standards. In group 2, compulsorily name and number is required. So that's why I'm just showing you the name also in every standard. Okay, anyway, this is the name, sir. Net profit or loss for the period, comma, prior period items and changes in accounting policies. Sir, in this standard, of course, as per the name, we are going to learn about 5 items. Hello, what is the name? Of course, number is 5. So, Panchatantra, we are going to learn about 5 items. Sir, let us see those 5 items. What are those 5 items? So, let me tell you, it is ordinary, extraordinary. So we are going to discuss about 5 items, ordinary items, extraordinary, but of course not all ordinary items, sir. We say certain ordinary items, which we usually mean here exceptional, ordinary but exceptional. I'll tell you what are those. The next, prior period items. Next, changes in accounting policy. Changes in accounting estimate. So like that, totally 5 aspects we are going to discuss, sir. If these 5 aspects are completed, as 5 over. Totally 5 aspects. What are the 5? Ordinary, extraordinary, prior period items, changes in accounting policy, changes in accounting estimates. Let me start with one by one, sir. First, ordinary activities. What do you mean by ordinary activities? Ordinary activities refers to those activities which are undertaken by an entity as a part of its business and any other activities which are incidental to or in furtherance of the business. Something I have said. What I have said? Ordinary activities refers to those activities which are incurred by an entity, which are done by an entity as a part of its business. That means if an activity is part of its business, we will call it as ordinary. No, sir. It is for incidental to business or it is in furtherance of business. Furtherance means expansion, sir. For expansion of the business. If it is all these 3 scenarios, any of these 3 scenarios, we will call it as what, sir? Ordinary. Now, can you please tell me, salary is paid, which activity? Ordinary or not? Yes. Rent paid. Purchases. Sales. First of all, please remember, I am discussing about P&L items. I am discussing about P&L. In this entire chapter, name itself start net profit or loss for the period. How to arrive proper, how to present proper profit or loss items. So thereby everything is P&L items, sir. So rent, salaries, purchases, sales. Let us say bonus paid. Ordinary or extraordinary? Sir, bonus paid, ordinary or extraordinary? Sir, when you are running a business, I think it is incidental that you give bonus to the employees. Sale of scrap. Ordinary or extraordinary? Ordinary, incidental, sir. These are all incidental to the business. Now let us say dividend received. The dividend received, ordinary or dividend received, ordinary or extraordinary? So tell me, dividend received, interest received, interest paid, dividend paid. Interest paid is okay. Dividend paid is also okay. Interest received, doubt. Dividend received, definitely doubt. Now tell me, what we say, sir, ordinary or extraordinary? Please understand, sir, furtherance of business, na expansions. Either we raising the funds or we going and investing elsewhere. These are all for expansion only, sir. Because for doing the business, sometimes we require the funds. Sometimes we may have excess funds which we don't want to keep idle. Now, raising the funds or else investing elsewhere are definitely for expansion of our business, for getting good return. So thereby, dividend received, interest received, dividend paid, interest paid, everything is what, sir? Ordinary activity. Hello, is that clear, sir? Which activity? Ordinary activity. Don't think over your cash flow statements. Many of you are just thinking dividend received. No, it's a which activity? Investing activity. Dividend paid, which activity? Financing activity. Don't look at your cash flow statements. We don't have anything that all operating items are ordinary, all investing and financing are extraordinary. Like that, we don't have any discussion. So if it is part of the business, incidental or furtherance of business, it is what, sir? Ordinary. Usually extraordinary means something which you cannot visualize in the business, sir. Hello, extraordinary means something which you cannot visualize, which you don't expect it to happen in the business. That is what, sir? Extraordinary. Let me take an example. Let us say sale of fixed asset. Ordinary or extraordinary? Sale of fixed asset. In that case, you will get profit or loss. Ordinary or extraordinary? Sale of fixed asset. Profit or loss on sale of fixed asset. Is it ordinary or extraordinary? Now look here carefully, sir. Suppose you are the shareholder. Now you are given financial statements. In that you see that profit or loss on sale of fixed. Profit or loss on sale of fixed asset. Now if you confuse, what happened to my company? Fixed asset sold, profit or loss. Now if you feel like that, sir, if you are so surprised, how it happened? It never happens. If you are surprised like that, it is extraordinary. Hello, I don't think now you will get surprised by a sale of fixed assets, sir. So please understand, purchasing a fixed asset, using a fixed asset, and later on when the life is completed or when we don't require selling it, these are all common part of the business. Usual in a business, that's why we call all of them as a ordinary activity only. Discussion clear? Sale of investments, ordinary or extraordinary? Will you just look sale of investments, sir? Will you look like that, sir? No, sale of investments also common. Sir, are you getting the point, sir? So thereby, now please observe carefully, purchase, or of course anyway purchase not an issue. We are talking about profit or loss. We are talking about only profit or loss. Profit or loss on sale of fixed asset or on sale of investments. These are all ordinary only. Hello, they are ordinary, but they are not frequent, that's all. They are not frequent, that's all. They are not regular. Just because they are irregular, you cannot call them as extraordinary. Hello, are you getting the point, sir? Because purchasing, using and selling, these things are very much common. Are common in a business, hence we cannot call them as extraordinary. Sir, discussion clear? You might be thinking, sir, everything you are telling, ordinary only. Okay. Anyway, let me take another example, then we'll discuss that extraordinary, etc. Now, look here carefully. Let us say one fine day, a big theft happened in our enterprise. Sir, stock was taken away by somebody. Hello, there was a big theft of stock, or otherwise there was a theft of cash. Cash was taken away or stock was taken away. Ordinary or extraordinary? Sir, ordinary or extraordinary? Because it is a loss only. Okay. Now, once again, the same way, sir. Just you are looking at your financial statements. So you have looked there, theft of cash. Theft of cash, okay. Now will you feel like that, sir? Is it regular in a business? Theft of cash means usual only, okay, one or the other day theft should happen. So will you feel like that, sir? No. Sir, when you feel theft happened, suddenly you will react, sir. It's not something which we expect it to happen in the regular business. So thereby what I can say is, sir, don't think that everything is extraordinary. Few activities are only extraordinary, just like theft of cash or any theft of maybe stock, etc. Or you can say earthquake, or you can say any fire. Sir, fire happened, sir. Your stock destroyed. What you will feel by looking at finance statements? Fire only. Now, will you feel like that? No, sir. These are all some things which you react a lot. By just looking at an item, if you react a lot, it is what, sir? Extraordinary. If it is normal, it is ordinary. Sir, is that clear, sir? So, usually, extraordinary items definition is like this, sir. Extraordinary items refers to those incomes or expenses which arises from transactions or event that are clearly distinct from ordinary. That means you can clearly say it is not ordinary. I think fire or theft, say, never you will feel ordinarily, sir. You will feel in a different manner. So that's why we call them as a extraordinary events. Sir, are you all understanding? Okay, now. Sir, in between this ordinary and extraordinary, there comes another one, sir. Let me tell you. Look here carefully. Sir, do you think ordinary items require a separate disclosure? Shall we disclose it separately to the users? This much salary is paid. That means separately. Shall we highlight it to the users? I think not required, sir. Ordinary items need not be separately disclosed. Whereas extraordinary items should be separate. Disclose them if fire occurred. Disclose them if theft happened. Disclose them if earthquake occurred. Are you getting the point, sir? So there will be these things should be disclosed. Whereas ordinary need not be disclosed. But let me tell you one thing. Let us say in one particular year, usually, let us say the profit is around 100 crores, sir. In one particular year, the profit is 300 crores. Now, what might be the reason for this? Let us say land was sold. Hello, what is that? Land was sold, due to which 200 crores extra income was there. Now, tell me, sale of land, ordinary or extraordinary? Ordinary only. We don't say it is extraordinary. But now the question is, sir, shall we disclose it to the users or not? Do you think it's appropriate to disclose to the users or not? It looks appropriate, sir, because otherwise shareholders will feel our company business multiplied by 3 times. Hello, because last year 100 crores profit, this year 300 crores. No, don't let the shareholders think like that. Give them clearly that, no, it is our regular business only. We have sold land, but it is not frequent. That's all, sir. For that reason, you cannot call it as extraordinary. Ordinary only. But it requires a clear, separate disclosure. Hello, it requires a clear, separate disclosure. Usually, ordinary items are not disclosed, but here we are disclosing. So, please understand, sometimes ordinary items, because of their nature, because of their size, we need to disclose separately. If we are disclosing, it's an exception to our regular ordinary. That's why we call such items are ordinary but exceptional. What we call, sir? We call such items as ordinary but exceptional. Sir, third category comes into the picture, which is ordinary but exceptional, or simply they'll also call it as exceptional items. Sir, 3 items are there. First is ordinary. Next one, extraordinary. I think it is very easy to distinguish between ordinary and extraordinary, because extraordinary are very rare. You don't expect it in the business. Ordinary, most of the activities. Now there comes another discussion, ordinary but exceptional. Usually, ordinary items will not be disclosed separately. But sometimes, because of their nature or size, if we disclose separately only, it will give better understanding to the users of the financial statements. Then we will disclose it separately. Because we are disclosing it separately, though they are ordinary, such items are called as what, sir? Ordinary but exceptional. So what are the examples of that ordinary but exceptional? Now itself I have said you, maybe disposal of fixed assets. Hello, what is that? Disposal of fixed assets. Because usually from sale of fixed assets, sometimes you may get heavy amounts, sir. So thereby disposal of fixed assets is always ordinary only but exceptional, because we are going to disclose. Similarly, disposal of long-term investment. What is that? Long-term. Why we are not telling current investments, sir? Because current investments are usually purchased and sold. Profit or loss also very common. So we need not disclose it separately. Huge amount of profit or loss will arise only in the case of long term, because we hold it for longer period. That's why usually disposal of long term investments is also what, sir? Ordinary but exceptional. Sir, is that clear, everybody? Okay. Now another example may be, sir, usually you value inventories at which value, sir? What is the valuation principle? Cost or NRV, whichever is lower. Suppose cost is 100, sir. Now you have recorded 100 when you have purchased. Now by the year end, let us say now NRV has become 80. Now you tell me you will value at 100 or 80? 80. Now if you reduce 100 to 80, if you reduce the stock value, due to that loss will be booked or not? Who purchases 100 by closing stock 80, debit is more, no? Purchase is more. As a result, loss will be booked or not? Yes. Now such a loss, do you call it as ordinary or extraordinary? Ordinary or extraordinary? Ordinary, sir. We don't say that always stock will be valued at higher than cost. Sometimes we may sell at lower than cost also. So it is possible. We cannot say it is extraordinary. It is what, sir? Ordinary only. Is that clear, sir? Now, shall we disclose it to the users or not? Shall we disclose it to the users or not? Amount may not be so important, but nature is very important. If the market price is lower than cost, what does it indicate, sir? Your products are not having sufficient demand. Sir, usually 100 worth item we may sell at 130. If you sell at 120, okay. 110, okay. 100, not so okay. 90 or 80 means that means your products are not having demand. So it is better to communicate it to the users of the financial. The nature says that go and communicate to the users. So thereby, though it is ordinary, we are disclosing separately. That's why this is what, sir? Ordinary but exceptional. We simply call this as write down of or write off of inventories to NRV. If we reduce inventories to NRV, for that purpose, if there is any loss, we'll call it as ordinary but exceptional. So discussion clear? Okay. Then two more aspects might be there, sir, which are usually considered as ordinary but exceptional. One is litigation settlements. Hello, what is that? I think usually against any entity, cases will be filed and we settle it. That's very much common. Am I right or not? Don't think that if somebody filed a suit against somebody filed suit. Don't think like that. When you are there in a business environment, when you are dealing with number of people, now for one or the other reason, you may need to file a case or somebody may need to file a case. Suppose somebody has not made a payment properly to you. You may file a case against him or not. Yes, required. You may have given some 10 crores or 15 crores amount. Now you have to file a case. If you are not paying properly, somebody will file a case or not. Yes. So due to different reasons, filing a case may be possible. But sometimes the court, what we can say, compensation, whatever they say, the amount may be huge, sir. Or we have to communicate to the users that now they are not being proper or they are not able to collect money from somebody, which indicates about the inefficiency of the organization. Are you getting the point, sir? Maybe about the inefficiency or because of the amount. Usually, somebody filing a case is ordinary only. I don't say it is extraordinary. We can visualize. It's okay. It can happen. But because of the nature or the amount, it is better to disclose it to the users. Hence, we once again call any litigation settlements as also ordinary but exceptional. Sir, is that clear, sir? The next one, last one, with which we'll close this ordinary but exceptional. Any retrospective applications, sir? Retrospective law, etc. Retrospective law. Now, law or what we can say, any retrospective treatment, sir. Now, please observe carefully. Let us say for employees, now salaries was increased with a retrospective effect. Hello, for employees, salaries was paid with a retrospective effect. Retrospective means from the past. Let us say we thought to increase salaries by 10,000 per employee, sir. But this is not from now onwards. This is from retrospective. Relating to last year also, have to pay extra 10,000 per employee. Now the question is this ordinary or extraordinary? Usually, in the case of some government employees or some other employees, sometimes they may repeatedly request the government or somebody to give their claims. They may not give it. Later on, they will accept it. It may take some time, sir. Usually, if you are there in government, you could observe, suddenly they'll get in arrears in salary. Maybe in taxation also, you might get it, sir. Something called as salary arrears. Suddenly, they'll get the salary relating to the past, sir. So, we don't expect that this is unnatural. Possible only, but usually you pay to the salaries only, you pay to the employees only some 10 lakhs or 20 lakhs salary. Suddenly, because of retrospective, your salaries may increase to 30 lakhs or 40 lakhs. Usually 20 lakhs. Now it may increase to 25 lakhs or 28 lakhs suddenly. Then amount is getting increased, sir. Everybody will feel why salary is increased a lot. It is better to disclose to the users. That's why, first of all, salary is ordinary, extraordinary, ordinary only. presentation is important, sir. You will show this under salary payment or not? Yes. Salary is ordinary or extraordinary? Ordinary. But because the amount is huge, it is better to convey what is the reason. So any retrospective application also, all these things are considered as what, sir? Ordinary but exceptional. Sir, is that clear, sir? Hope you have understood what is ordinary, what is extraordinary. Ordinary only but requires a special disclosure to the users, that is ordinary but exceptional. Okay, sir. Then what is prior period items, sir? Prior period items refers to those incomes or expenses that arise in the current year. Hello, those incomes or expenses that arise in current year. Why, sir? Because of error or omission in one or more previous financial years. Error or omission in preparation of previous financial statements. Sir, please observe carefully. If there is an income or expense in current year because of error or omission in the previous financial statements, then, sir, shall we call it as ordinary or extraordinary or exceptional? No, sir, there is separate head. It is prior period item. Which item, sir? Prior. We are recording as an income only or expense only, current year only. But it is not relating to current year, sir, because we cannot go and change last year financials. We are recording in the current year, but that doesn't mean really it is belonging to current year. We need to disclose it. We'll disclose it under a head called prior period items. Let us say in the last year, when they are recording stock details, they have missed one stock book, sir. So as a result, that information was not recorded in the system, or else some few pages were missed. They have not recorded in the system. Now suddenly in this year they have found that. Now tell me, is this a prior period item or not? Yes, last year omission has happened, so thereby it's a prior period item. Let us say last year machinery purchaser, sir, 5 lakhs, but when they are recording in the tally, so somewhere they missed 1 0, they have recorded 50,000. When they are typing, they have missed 1 0, they have recorded only at 50,000. Now due to which depreciation changes, am I right or not? So current year when we are providing, will we provide only current year depreciation? No, we have to rectify. And we know that last year on 5 lakhs, actually 5 lakhs is the asset. They should have provided depreciation on 5 lakhs, but they have wrongly provided on 50,000. Let us say 10 years is the life, sir. So usually we have to provide 50,000 per annum. Last year they have provided only 5,000. Now in this year, when we come to know that mistake, what we will do? We will not provide only current year depreciation of 50. We will provide last year deficit of 45,000 also. Overall 95. Now I can say this 45,000 is called as a prior period item. We are recording as a expense. Why? Because of error in the last financial statement. Because of error or omission in the previous years, if we record today any income or expense, that is called as what, sir? Prior period item. Sir, is the discussion clear till now? Everybody, is that clear, sir? Okay, right. Let me show you 1 or 2 questions quickly. Of course, a change in accounting policy and change in accounting estimates are there. That also we'll discuss. Before that, 1 or 2 questions. Okay. Now, please observe carefully, sir. During the year 1718, a medium-sized company wrote down its inventories to NRV by 5 lakhs. Is there any requirement of separate disclosure? Now tell me, is this ordinary, O or OE or E? O means ordinary. OE means ordinary but exceptional. E means extraordinary. Tell me O or OE or E? This is OE, ordinary but exceptional. Okay, next. Company signed an agreement with the employees union for revision of wages with retrospective effect. I think now it's we have discussed. This is also OE. Sir, is that clear, sir? Okay, right. Next, sir, I'm not reading the solution, just to make you understand the nature. Read it, you will definitely understand. Next, CRD 2 and 3, not so important, sir. Come to 4. X Limited finds that the stock sheets of 31st March 2018 did not include 2 pages containing details of inventory worth 14.5 lakhs. Now, how would you deal in the year 2019? Last year 2 pages were missing. Now record in the current year. It is which? It is what, sir? Prior period item. A Limited company finds that the stock sheets on 31st March 2010 had included twice an item, the cost of which was 20,000. You are asked to suggest how the error would be dealt. Once again, this is also what, sir? Prior period item. Sir, is that clear, everybody? Okay, right. Next. Let me tell you this item also, or else then. Fuel surcharge, sir. Please observe carefully. Sir, I will not explain full details of this question. I will tell you logically how it is O or OE or E. Now, fuel surcharge is billed by State Electricity Board at provisional rates. Final bill for fuel surcharge for 5.3 lakhs for the period 2008 to 2015 has been received and paid in February 2016. Now, please observe carefully. Sir, usually electricity bills in some states, they are not paid on the basis of fixed rates, sir. Usually they pay on provisional basis. Later on, any increase or decrease, government will collect from them at a time. Please understand, every month fuel prices will change. Am I right or not? Power rates may change. But do you think they'll change the unit rates for you? It depends on the state, sir, because I think for every state you'll be having separate electricity board. In some states, they collect a fixed price initially. Later on, for any changes, they'll collect a huge amount at a time from the companies. Are you getting the point, sir? This is a similar scenario where for the past 7 years, they are collecting the extra amount at a time from the company. Now, for 2008 to 15, when they have received the bill, sir, only February 2016. When they have received in 2016, first of all tell me, relating to past, now recording in 2016, prior period item or not? Relating to the past, now record in 2016, prior period or not? No. Sir, is there any error or omission? What is the error? What is the omission? Hello, there is no error or omission because the bill itself came to in 2016. So thereby it's not a prior period item. But now let me continue the question. However, the same was not accounted in 15-16, but it was accounted in 16-7. Now it becomes a prior period, sir. Please understand, if the same was accounted in 15-16, because paid in February 16, that means you should have accounted in 15-16. Because it was accounted in 16-17, it will become now a prior period item. If at all they have recorded in last year itself, 15-16, then it will not become a prior period item. So hope everybody have understood. Okay, right, sir. Let me discuss about two more aspects of the standard also. Last two aspects. One is change in accounting policy. The other one is change in accounting estimate. Hello, what is that? Change in accounting policy and change in accounting estimate. So what is a accounting estimate, sir? First of all. Hello. What is a accounting estimate? What is the meaning of accounting estimate? It refers to those incomes or expenses that cannot be measured with precision but only based on judgment. Something I have said. Sir, there may be some incomes or expenses which you cannot measure accurately, sir. Only based on judgment we will record. Now let me give you an example. Depreciation. Do you think is it an exact value? What you are recording depreciation is the correct amount of usage? No, it's only a estimation. We are taking a judgment, okay? Usage is equal or usage is declining. Like that we'll apply a method and find the depreciation. Is it exact, sir? No. Salary is paid, exact or not? Yes. That's a regular. Rent paid, exact or not? Yes. So depreciation is a estimate, sir, because first of all life itself is a estimation. So automatically depreciation also becomes estimation. Sir, is that clear, sir? Now, provision for doubtful debts. What, sir? Estimate or not? It's an expense, sir. Income or expense. Now, can you measure accurately? No. It's only a estimation. So, please understand, if you are just estimating, it is not accurate, then we call it as an accounting estimate. Sometimes there may be a change in estimation. Suppose useful life changed, sir. Now, is it change in estimate or not? Yes. Suppose you thought till now, whenever you have supplied goods, some debtors are there. Now out of 1 lakh, you thought that 5,000 may not be collected. So you have created 5% provision. But there are few more talented people who are doing something else. They are not giving money. Then what we will do, sir? We will increase the rate. Hello, are you getting the point? Let us say 10,000 may not be collected. Then we will increase the rate from 5% to 10%. Now change in the rate, what do we call this as? Change in accounting estimate. Sir, are you getting the point? If your estimation changes, that is called as change in accounting estimate. The examples are change in, I'll give you the examples for this, sir. Change in accounting estimate. For depreciation, usually change in useful life. Hello, what is that? Change in useful life. For doubtful debts, I can say change in percentage. Hello, what is the change in percentage? Change from maybe 5% to 10%. So this is what's the change in estimate. Let us say provision for warranty is being created. Last year 1%, this year 3%. Change in estimate or not? Yes. Because you are feeling this much loss may be there because I have kept warranty. Warranty means repair costs will be there or not? Yes. So previously we are feeling 1% of the sales value. Today we are feeling 3%. So thereby once again this is a change in estimate. If your estimation changes, it is what, sir? Change in accounting estimate. Sir, discussion clear? Usually change in accounting estimate are accounted for on prospective basis. Which basis, sir? Prospective basis. Change in accounting estimates are always accounted for on prospective basis. So hope it is clear. Now let me come to accounting policy. First of all, what do you mean by an accounting policy? Accounting policy refers to specific accounting principle. Hello, what is that? Specific accounting principle as well as the method used for applying such principle. Something I am telling. Accounting policy refers to specific accounting principle as well as, not only this one, sir, as well as the method used for applying such principle. Let me take an example, sir. Let us say you valuing inventory at cost or NRV whichever is lower. Hello, cost or NRV whichever is lower. Is the principle you follow or not? Yes, that is the principle, sir. Now for finding cost here, what methods you are having, sir? FIFO, weighted average, like that you are having methods or not, sir? So these are the methods used for applying such principle. Sir, are you getting the point? So specific accounting principle, that means you applying at cost or NRV is an accounting policy. Similarly, the method is also accounting policy. Whether you change the principle or whether you change the method, both are what, sir? Change in accounting policies. Is that clear, sir? Now let me take another example. You are recognizing government grant in the books of accounts. Recognizing government grant as income or something is a principle. For recognizing government grant, I think you are having various approaches, particularly if related with respect to fixed asset. Now you are having cost reduction approach. Sir, I think in AS12 you might have seen. Other one may be deferred income approach. Now these are the methods, sir, whereas that is the principle. Change in the principle. Suppose you stop recognizing government grants. Change in accounting policy. No, sir, I changed from cost reduction to deferred income. That is also a change in accounting policy. Either change in principle or change in the method. Both are what, sir? Change in accounting policy. Let us say another example. You providing depreciation in the books of accounts. You providing something for usage is a principle or not? Yes. For providing depreciation, we are having different methods. What are that? SLM and WTV. Now tell me, if I change from SLM to WTV, is it a change in accounting policy or not? The answer is yes, conceptually. The answer is yes, conceptually. But no, because of AS10 amendment. Let me tell you one thing, sir. Providing depreciation is a principle and SLM and WTV are the methods used for such principle. So if you change from SLM to WTV, definitely it's a change in accounting policy as per accounting concepts whatever there. But sir, usually change in accounting policies are accounted for on retrospective basis. Which basis, sir? But let me tell you one thing. Recording depreciation or adjusting the asset values on retrospective basis is a very difficult task practically. Suddenly in particular year you change it from SLM to WTV, sir. You will have hundreds of assets and hundreds of assets will have different lives, sir. Now you changing on a retrospective basis is very difficult practically. So because of practical difficulty, something I'm telling, because of practical difficulty, because we cannot apply on a retrospective basis, there was an amendment in AS10 which says that though conceptually it is a change in accounting policy, for the purpose of accounting, treat it as only change in accounting estimate, then only we can account for on which basis, sir? Prospective. Because change in accounting estimate is accounted on prospective basis. For that reason, though conceptually change in method of depreciation is a change in accounting policy, we have said that no, please account it on a prospective basis by treating it as change in accounting estimate. So today if anybody asks you change in method of depreciation, accounting policy or accounting estimate only because of the amendment, but logically speaking it's a change in accounting policy, but never write in exam as change in accounting policy. I've said you the reason also why we are calling as change in accounting estimate. Sir, discussion clear? So this is what change in accounting policy and change in accounting estimate. Let me give you, ICAI has clearly said that there are two scenarios where you should not treat it as change in accounting policy. Hello, they have given two scenarios which you should not treat it as what, sir? Change in accounting policy. Specifically they have said these two are not change in accounting policies. Like that they have communicated two, sir. What are the two? I'll give in simple language. One is new transactions. The other one is different transactions. I'm giving you in simple language. I'll tell you formally which language we'll use. One is new transactions. The other one is different transactions. What is this new transaction and different transaction? Sir, look here carefully. Till now, in the organization, we don't have any pension payment scheme. Hello, what is that? We don't have any scheme of paying pension. Suddenly, we thought that no, it is required for some employees at least to pay some pension. So we thought to pay pension from current year onwards. Now, when we are paying pension, we should create an accounting policy or not? Yes. Now, I think we have started doing some accounting policy. Till last year, no such policy. Current year, you have brought that policy. Can I call this as a change in accounting policy? Standard says no. This is introduction of new accounting policy, but not change in accounting policy. Change means already transaction is there. Already you are following one principle. Now, if for the same transaction, if you change the principle, that is called as change in accounting policy. Last year pension payment there, not there. Last year the transaction only not existing. So how do you have principle, sir? Don't tell that I am changing the principle. Sir, if the transaction itself is new, if a transaction is occurring which is not at all there in the previous year, then that is said to be an introduction of accounting policy, but not a change in accounting policy. Because of new transactions, if we introduce an accounting policy, it is not a change in accounting policy, but it is only introduction of accounting policy. Hope everybody have understood. Another example, sir. Let us say, sir, till the last year, we are paying gratuity. Hello, we are paying gratuity. Gratuity is a retirement benefit. But what we will do is, usually, if that employee has worked so hard, if we feel that he is a hard-working employee, okay, you are, okay, take 30,000, take 50,000. Like that, we used to give some random amounts, sir. No big discussion. What we thought is, no, many employees are not getting proper benefits in this way. We are giving randomly on some manager's information, so that's not appropriate. So what we thought is, from current year onwards, let us clearly analyze how many years he may continue, what might be the salary at the time of retirement, or how much gratuity we may need to pay at that time. So because the amount of gratuity may be huge, what we thought is, let us record every year. In other words, let us apportion every year some amount. Let us set aside some amount every year. Like that you have thought. Now tell me, till now, what is your gratuity payment scheme? I can say it's random or ad hoc. In some random way you used to pay. From now onwards, you are making a proper gratuity scheme. Now, till last year, tell me, how do you account for? Will you set aside any amount? No. Because your principal itself is to pay suddenly some amount. So, from current year onwards, because you thought to estimate clearly and you thought to set aside some amount, accounting policy will change or not? Yes. Now, can I call this as a change in accounting policy? Do you think transaction is same in last year and current year? Last year a gratuity payment was there, current year also there, but last year you are paying on some random basis, sir. From now you are paying on a proper basis. I think the transaction itself is changed. What is changed, sir? transaction itself is changed. If transaction itself was substantially different, then you cannot call this as a change in accounting. Transaction is exactly same, but still if you change the principle, then only we'll call it as a change in accounting policy. So just even if the transaction is different, that is also not called as a change in accounting policy. Call as a change only if really transaction was same and just the principle was changed. Is this point clear, sir? These are two extra points with which the discussion was completed, all the topics. Let me see one or two last questions and then we'll close this topic. Everybody, are you all there, sir? Okay. So let me do with question number 6. Please observe carefully, sir. In that second one, till now created at 2.5, now they are increasing to 8%. Now what is this, sir? Change in accounting estimate, change in provision percentage. Now, last year provision made is 7 lakhs, but in the current year actual amount is 9 lakhs. Provision created is 7, but do you think provision will become exactly actual? No. In the current year actual expenses was 9. This extra 2 lakhs, what do you call this as? Change in accounting estimate, prior period item. Sir, at that time what we know is 7 lakhs. That's why we created for 7 lakhs. You cannot say last year only wrongly recorded like that. At that time whatever you have now you recorded correctly. So this is not a prior period. This is only a change in estimation. Is that clear, sir? Any provisions for that matter usually only a estimation. Change in accounting estimate. First one, sir. Goods worth 5 lakh were destroyed due to flood. Claim was lodged with the insurance company but no entry. Sir, first of all, when you can file a claim? Only when you have taken the policy. When you have taken the policy, floods was there. I think it is very clear. Floods has affected your entity. Your goods were lost. So you should have recognized some claim amount, but they have not recognized. Otherwise, because it is certain that you are going to receive the claim amount, but may not be exact amount, you don't know. But at least recognize on some randomized some amount. So this is what, sir? Prior period item or not? Yes, we will call that as a prior period item. Because you know that generally when you pay premiums properly and when you file a claim, and that too it is very clear, you cannot cheat anybody because floods only occurred, sir. Everybody know it, what was destroyed. So it's a clear-cut case of error. So it becomes a prior period item. Sir, is that clear, sir? Let me deal with last CRD, which was very, very important for examination. Provision for doubtful debts increased from 2 to 3. Change in accounting estimate. During the year ended 31st March 17, management has introduced a formal gratuity scheme in place of ad hoc gratuity schemes. The same example. So what is this, sir? Not a change in accounting policy because the transaction was different. Let me show you that formal language, sir. So here that adoption of an accounting policy for events or transactions that differ in substance for previous transactions will not be considered as a change in accounting policy. Third one, till the previous year, furniture was depreciated on straight line basis over 5 years. From current year, the life has been changed to 3 years. What is this, sir? Change in accounting estimate. Next, fourth point, management decided to pay pension to those employees who have retired after completing 5 years of service. Such employees will get pension of 20,000 per month. Earlier there was no such scheme of pension. So what, sir? It is not a change in accounting policy. Once again, this is only a introduction of new accounting policy. Next, during the year ended 31st March 17, there was a change in cost formula in measuring the inventory. That means from FIFO to weighted average. Now tell me, what is this? Change in accounting policy. This is a change in method only. So thereby change in accounting policy. That's all, sir. The important questions also completed. With this, we have closed standard 5 also. AS 5. Sir, have you all understood? I think 1.5 hour completed, sir. 2 standards we have completed. Okay, don't worry. Some extra it takes, sir. We'll cover through other standards. Okay. Now, let us move to the next standard. What is that? AS 7. I know I am moving quickly, but this is a revision class. Please be aware of that. Hello. Hope you are all understanding whatever I am discussing. I am moving quickly, but still I am covering almost all the important aspects. Let me move to AS 7. This is a problematic standard, sir. 4 and 5 are theoretical standards, sir. Whereas AS7 is a problematic standards. More and more we deal with numbers only. Okay, right. Anyway, first of all, tell me the name of the standard as usual. AS7 construction contracts. AS7 construction contracts. Okay. So let me deal with some important aspects which will help in solving questions. Shall I start, sir? Okay, listen carefully. Sir, first of all, make it very, very clear. This standard is applicable only to, first of all, two types of parties are there. What are the two types? Contractor, contractee. Hello, who performs the contract is contractor. To whom performance is done is contractee. So usually AS7 is applicable only for contractor. For contractee, it may be a fixed asset or an inventory or a investment. If it is a fixed asset, AS10. If it is an inventory, AS2. If it is an investment, AS13. But AS7 is not applicable. AS7 is applicable only for contractor. Okay, sir. In contractor also, what you are going to learn, what you are going to apply. Usually, sir, construction contracts take more than 1 year. Do you think construction contract complete within 1 year? No, it takes more than 1 year. If it takes more than 1 year, one big problem is, sir, contract price is fixed. Let us say contract price is 100 lakhs. Now contract period is 3 years. Now how do we recognize revenue? Shall I recognize entirely in first year, entirely in last year, or over the year equally, or based on receipts or payment, whatever receipts, or based on work completed? Like the different options are there. That is why this standard is there. So please understand, this standard tells you, sir, for allocating the revenue over the period, you please apply percentage completion method. Which method, sir? And this standard main aim also same, sir. This standard's aim is allocating the contract revenue over the period. Hello, what is that? Allocating contract revenue over the period, for which we are having one standard. Now what is that standard? Sorry, we are having one method. What is the method, sir? Percentage completion method. Sir, is that clear? Okay. Now how to apply this method? That is what we are going to learn, sir. Now please observe, ultimately any method will help you to learn or compute profit or loss. Hello, what is that? Profit or loss. Now profit or loss for a contract for the period is equal to contract revenue for the period. Hello, what is that? Contract revenue for the period minus contract costs for the period. Ultimately, we require profit or loss only, sir. How do we get it? Contract revenue minus contract costs. Now there comes a question. How do you find contract revenue for the period? How do you find contract revenue for the period, sir? It is total contract revenue. Hello, what is that? Total contract revenue into percentage of work completed. Into percentage of work completed. Sir, it is total contract revenue into percentage of work completed. Now, how do you find contract costs for the period, sir? Sir, how do you find contract costs for the period? It is nothing but actual costs incurred. Hello, what is that? Actual costs incurred. Sir, we are going to apply percentage completion method. Under percentage completion method, how do you get profit or loss? Profit or loss for a contract is equal to contract revenue for the period minus contract cost for the period. How do you find contract revenue, sir? Total contract revenue into percentage of work completed. How do you find contract cost for the period, sir? It is actual costs incurred. Is that clear? Now there comes a question. What is total contract revenue? What is percentage of work completed? And how do you get actual costs incurred? Because once we know this, then we can start applying this percentage completion method. Let me quickly tell you, sir, percentage of work completed can be found using 3 methods. How many methods, sir? Percentage of work completed can be found using 3 methods. One is survey method. Hello, what is that? Survey method. What is survey method? An engineer will come and check by looking at the contract how much work is completed. Do you think in exam they'll call for an engineer, sir? No. So thereby this method is not applicable for exam. Second one, proportionate physical work completion method. Hello, what is that? Proportionate physical work. Physical work means by looking at it, we should be able to answer. Let us say 100 kilometers road was there, sir. 70 kilometers road construction completed. I think by looking at it, we can say 70% work was completed. Or otherwise, let us say 10 plant and machineries we have asked for construction, 6 plant and machineries completed. We can say 60% work is completed. Sir, will this be asked in exam, sir? They cannot show you physically any items, sir. So once again, this method also will not be asked in exam. So what is asked in exam, sir? The third method, which is proportionate cost method. Sir, percentage of work completed will be found using the third method, which is proportionate cost method. Under this method, how do you find percentage of work completed? It is very simple. Cost incurred till date. Hello, what is that? Cost incurred till date divided by cost incurred till date plus further estimated costs. Cost incurred till date divided by cost incurred till date plus further estimated cost. Instead of this, together you can use total estimated costs. What is cost incurred till date divided by total estimated cost will give you the percentage of work completed. If they give further estimated cost, you add these two. If they give you total estimated cost, directly you write down in the denominator to find the percentage of work completed. Sir, is this point clear? So this is what percentage of work completed. Now before proceeding to okay, anyway, let us complete this one also, sir. Then contract revenue. Now how do you find total contract revenue? There are some components of contract revenue, sir, which we should know. Usually contract revenue consists of 5 items. How many items, sir? Contract revenue consists of 5 items. What are the 5 items? It is initial agreed price. What is that? Initial agreed price. Then escalation clause. Then variations. Then you may have claims. Then you may have incentives. Hello, everybody. You will be having 5 components of contract revenue, sir. One is initial agreed price. The other one is escalation clause. The other one is variation. Fourth one, claims. Last one, incentives. Initial agreed price means the price which was fixed initially. Escalation clause means, sir, maybe you might have heard in a mall, escalator. Hello, what escalator will do you? It will make you either go up or it will make you come down. This is what escalation clause also will do. Either it will increase the contract price or it will decrease the contract price. Suppose material price increased a lot. Sir, you know, cement bags price, once upon a time the price used to be different. Today the heavy increase was there in cement bags price, sir. At that time, suppose you have started the construction, your estimation of cost will be different. As a result, the contract price quoted also will be different. Suddenly during the course, the cost increased like anything. Sir, if at all such a huge increase was there, to cover such losses, initially at the time of contract itself we'll say, sir, if cost increases beyond a reasonable percentage, then I will increase the contract price also accordingly. If price decreases so much, then I will decrease the contract price also. Like that, they will mention a clause which is called as escalation clause. Due to that also, our revenue may either increase or decrease. If material price increases, that also will increase. If material price decreases, then contract price also will decrease. So this is what, sir? Escalation clause. Then we'll come across variation. Hello, what is that? What is variation, sir? Usually variation means change in scope or nature of the work. Hello, what is that? Change in scope or nature of the work. Let us say you have thought for construction of 3 floors initially, sir. Now you thought to increase it to 5 floors. Or you thought for construction of 15 floors, a big mall. Suddenly after construction of 12 floors, when you gone there, you look down, so you got something, this may be a place for suicides, etc. Immediately you have reduced it to 12 floors, or you have stopped there itself, or one more last floor. Now here you are reducing the number, either you are increasing or reducing. No, suddenly you are changing. If you are changing the scope of the work, contract price will change or not? Yes, this is called as variation. Hello, this is called as what, sir? Variation. It may either increase or decrease. Nature also changes, sir. Sometimes scope, sometimes nature. But anyway, that is called as variation. Can we recognize variation? Yes. For that, two conditions need to be satisfied. First of all, customer should accept that variation. Hello, what is that? Customer should accept. It is probable that customer should accept the variation, and amount should be measured reliably. If these two conditions are satisfied, if these two recognition criteria are satisfied, we can recognize the variation amount. That means we can add or reduce it from the contract price. Sir, is that clear? Next one, claims. What do you mean by claims, sir? I think you might have heard chapter called insurance claim. What is claim? First we incur loss. For that, reimbursement is nothing but claim. So claim means usually reimbursement, sir. If contractor incurs some expenses for which he is getting a reimbursement from the, if contractor incurs some expenses for which he is getting a reimbursement from the contractee, that is called as claim. Hello, that is called as claim. If contractor incurs expenses, tell me at that time he will recognize that as loss or not, recognize that as expenses or not? Yes. Now for the same, if he is getting reimbursement, shall we recognize as income also or not? Yes. Otherwise matching will not happen. Hello, if you are recording the expenses we have incurred as cost, and if you don't record the reimbursement as income, matching will not be there. So when you have incurred, you will recognize as cost. So when you are getting the same as reimbursement, hello, when you are getting the same as reimbursement, so that is said to be what, sir? Claim. Hello, it should be part of contract revenue or not? Yes, provided once again two conditions, sir. What are the two? Claim should be accepted by the customer, amount should be measured reliably. If these two conditions satisfy, you can accept the claim. The discussion clear? That is what claim. Just remember about that insurance claim where you get the reimbursement. Here also similar concept. Let me go to the important aspect which may be asked in examination usually. Incentive. Hello, what is that? Incentive. Incentive refers to any additional amounts payable. Hello, what is that? Any additional amounts payable if specified performance target. If specified, claim means reimbursement, sir. Just write down like that if you are writing. Claim means reimbursement. Incentive means additional amount is payable if specified performance target is met or exceeded. If a specified performance target is met or exceeded, for that if we are paying any additional amounts, that is called as what, sir? Incentive. Let me take an example. Let us say I thought to construct a big mall, sir. Hello, what is that? Mall. Let us something like PVP mall. I thought to construct in 5 years. Hello, how many years, sir? 5 years. I have said to the contractor like this, sir, now I want to start business as early as possible. You could observe the business of PVP. I want to start the business as early as possible. If you complete 1 year quickly, suppose if you are able to complete in 4 years, then I will give you extra 1 crore. So as a contractee, what I am telling to the contractor, sir, if you complete it quickly, I'll give you extra amount. Why, sir? If I give 1 crore, I can do 2 crores business. Because if work is completed quickly, I can get 2 crore business, sir. For that, I don't bother to give 1 crore extra amount. So what is incentive, sir? It is extra amount paid for usually any benefits. So I can say it is additional amounts payable if specified performance target is met or exceeded. Usually it is for early completion of the contract only such incentives will be given. Sir, is that clear, sir? That is what called as incentive. For early performance, for early completion of contract, sometimes they may pay some extra amount which is called as incentive. Please remember, just like variation and claims, incentives is also having some conditions, sir. First, it should be probable that the target will be achieved. Now when I say probable, they are telling one condition, sir. First of all, sufficient period should be advanced. In other words, some period should be completed, then only you can say it is probable the target will be achieved. If the contract is sufficiently advanced, this is what important, sir. One of the conditions is contract should be sufficiently advanced. That means progressed. Sufficiently advanced that it is probable that target will be achieved. If it has progressed in such a way that it is probable that target will be achieved, then you can recognize it. Anyway, another point, amount should be measured reliably. That is common, sir, but these two important. So one is contract should be sufficiently advanced, the target will be achieved. Let us say I have accepted for construction of a bridge, sir. Hello, I have accepted for construction of a bridge. The period is 10 years. How many years? 10 years. Now let us say this year only I have taken the contract. Now, sir, I have already some good experience in this. In the past, I have completed contracts like this number of times within 8 years. It is Lilliput activity for me to complete this within 8 years, or else it is jujube for me to complete within 8 years. Now, can I say definitely I'm going to achieve it? Can I record it as an income? Can I make it part of the contract price? Yes or no? No, that is what they're in. Though you are a great expert, though you say it's a Lilliput for you, still standard says what they're telling, contract should be sufficiently advanced. First, some reasonable period should be completed, sir. Then only you say certainty is there in achieving the target. If 6 years is completed, if you say, sir, within next 2 years it will be completed, it is reasonable, sir. In first year only, without starting the contract, I am a great expert, talented, it will be completed means nobody will accept it. Sir, you have to wait till reasonable period is completed. Then only you can record that incentive. Sir, is that clear, sir? So these are all components of contract revenue. What are that, sir? Initial agreed price, escalation clause, variations, or claims or incentives. So these are all the components of the contract revenue. Let me tell you the components of costs incurred, sir. Usually you will have any directly attributable costs or allocated costs. Hello, what is that? Directly attributable or allocated or allocable. And there may be some costs, sir, which are not allocated at all. There may be some costs which are not allocated at all, which we'll call as unallocated costs also. So usually any material, what is that? Material, labor, these are all required for a contract or not? Can we call them as directly attributable or not? Yes. Material, labor, if we use any machinery, depreciation for the machinery. No, sir, I have taken a machinery on hiring, rental basis, then higher charges for the machinery. Now, all these as considered as what, sir? Directly related. Sometimes you may have some expenses which are related to more than one contract, sir. Let us say I have got a technician who will work for 2 or 3 contracts at a time. Hello, I am having a technician or a supervisor who looks after 2 or 3 contracts at a time. Then for whatever salary I pay to him, shall I record any to one particular contract? No, I have to allocate over the contract. Should be part of this contract, but not full amount, only part. We are allocating. Hello, what we are doing? We are allocating. These are all allocated costs. Let me take another example. Maybe borrowing costs. Hello, what is that? Sometimes funds may be required, sir. If funds are required, will we take for each contract specifically? No. We'll take for all contracts together, sir. Based on the fund allocated to each contract, once again we'll allocate that interest on a reasonable basis. These are all what, sir? Allocated costs. Which costs, sir? Allocated costs. Sometimes we might incur some R&D expenses or selling expenses. Now tell me, are these related to any particular contract? Suppose L&T company is there, will they advertise for any particular contract? No, they will advertise for full company, sir. R&D, if they do any research, will they do for any particular contract? No, sir. Research and development is also done for the company as a whole. Or let us say any head office expenses are there, general administration offices, etc. Expenses or overheads. Now tell me, are they related to any particular contract, sir? No. If they are not related to any particular contract, then we cannot allocate to any particular contract. Sir, that means we will not record an expense. We will record not for any particular contract, but in the overall P&L, in the general P&L. Because you should know one point, AS7 will be applied contract wise. Hello, how, sir? Usually AS7 will be applied how, sir? Contract wise. You will not apply together, sir, because every contract, every asset may have different percentage of work completed. Accepted? Building will have 1% of work completed. Another plant and machinery may have another percentage work completed. So thereby we cannot apply AS7 together, sir. AS7 is to be applied contract wise. When we are telling contract wise, we should know clearly what costs to be considered. Some costs may not be considered for any particular contract, but we will recognize for the entire organization, not for any contract. Sir, is that clear, sir? So that means these two costs we have to consider in the actual costs incurred. Sir, is that clear, sir? So I think we are talking about application of percentage completion method. For that we mainly require three aspects. One is total contract revenue, the other one is percentage of work completed, the other one is actual cost incurred. These three are very, very important. Sir, is that clear, everybody? Now, so let us deal with a question based on this, sir. But before moving to that question, let me give you a small example. You only tell me how do you recognize profit or loss for each year by applying this percentage completion method. Everybody, are you all there, sir? Let us assume 200 lakhs is the contract price. Hello, what is the contract price? 200 lakhs. And let us assume you are having like this 42 lakhs costs incurred in year 1, then 70 lakhs costs incurred in year 2, 28 lakhs the costs incurred in year 3. So these are the cost incurred in each year, sir. Can you please tell me percentage of work completed each year, sir? Percentage of work completed each year, can you tell me? Now just make the total costs incurred estimated how much, sir? 140. Now 42 by 140. Now it is how much? 30%, 50%, 20%. This is the percentage of work completed each year. Sir, accepted. Now can you please tell me profit or loss for each year, sir? Year 1, year 2, year 3. Can you please tell me profit or loss, sir? How do we find? Contract revenue less contract cost gives you profit or loss. Can you tell me the profit or loss? Contract revenue how much, sir? For first year, total contract price 200 into percentage of work completed 30. So we will write 60 lakhs. So here we will write 200 into 50%, 100 lakhs. So here we will write 20%, 40 lakhs less the costs incurred in each year, 42, 70, 28. So what will be the profit or loss? 18, 30 and 12. Sir, have you all understood how to find profit or loss? Costs incurred we will record actual. First we will write total contract price into percentage of work completed. Sir, I think you know there are various factors which will increase or decrease the revenue. Let us assume in second year somewhere contract revenue has changed. In second year, in year 2, contract revenue changed to 220 crores. Now can you please tell me the revised answers? In second year, contract revenue, assuming that contract cost is same, contract revenue alone increased to 220 crores. Can you tell me for all the 3 years, what is the profit or loss, sir? First year, will it change? No, because in that year, what we know is only 200. So thereby 200 into 30%, 60 minus 42, 18 lakhs pakka, sir. Second year. Shall I take a 200 into 50% or 220 into 50%? So it is 220 into 50% because I know 220. So thereby how much, sir? 110. 220 into 50%, 110. We'll reduce the cost. How much, sir? 70. So what will be profit or loss? 40. Now here in the last year, 220 into what is the percentage? 20. So how much, sir? 44. So what is the cost incurred? 28. So profit or loss? 60. Sir, in this way we have to compute profit or loss for each year. But observe carefully. Can you tell me together what is the profit or loss? 18 plus 40 plus 16. How much? How much? Now, can you please tell me what is the total contract price? 220. What is the total contract cost? What should be the total revenue? 80. Now what is your revenue if you add these three? That means there was a mistake. What was the mistake? In year 2, when your revenue changed to 220 from 200, you have applied 220 into 50%, 220 into 20%. Here you applied only 200 into 30%. That means for this 20, have you applied that 30% of first year? Please observe carefully. For that increase of 20, have you applied first year percentage, sir? No. 20 into 30 percentage, how much, sir? 6. That is the difference. Hello, are you getting the point, sir? So thereby, please understand, it doesn't become logical for us to account individually each year. That's why we have a format, sir. This is not correct. What we are going to do is, we are going to do on a cumulative basis. Which basis, sir? Hello, we are going to do on which basis, sir? Cumulative basis. Because just like in ESOP, which chapter? ESOP, where every year employee changes, how do you recognize expense for each year, sir? Cumulative expense to be recognized. From that, you will reduce expense already recognized, then only you will get expense to be recognized in the current year. The same format will be applied here also. Sir, are you getting the point? So let me show you similar questions, sir. 1 or 2 questions like that. You will have a full clarity of answering this. Sir, let us complete these questions, and then another 15 minutes discussion was there that we'll do after the break. First we'll do 1 or 2 problems related to this, the discussion done. Another 15 minutes discussion was there for AS7, that we'll do it after the break. Now first let us complete similar questions, sir. Look at question number 2, sir. Let me read it. Rajendra undertook a contract for 20 lakhs on an arrangement that 80% of the value of work done as certified by the architect should be paid immediately. Balance 20% should be retained until the contract was complete. If any work was certified, sir, some engineer will come and certify this much percentage work was completed. Out of the work certified, 80% will be given to you, 20% will not be given. It will be paid at the end. Anyway, payments doesn't influence the revenue recognition. Hello, because we are not booking on cash basis, we are booking on accrual basis. In the year 1, amounts expended were 8,60,000. Total cost incurred how much, sir? 8,60,000. Now the work was certified by for 8 lakhs. That means, what about balance 60? Work uncertified. Sir, please understand, engineer cannot come exactly on 31st March. Engineer cannot come exactly on 31st March. Let us say he came on 20th March. That means work will be certified only till 20th March. Last 10 days also work was done or not? Yes, but that will be uncertified. Whether certified or uncertified, cost incurred or not? Yes. So what we should consider? Together, both work certified plus uncertified. So forget about what is certified or what is uncertified. Simply take the cost incurred, that is sufficient. So cost incurred in year 1 what, sir? 8,60,000. And what is the further cost we are expecting, sir? 10 lakhs. So first year what is the percentage? 8,60,000 divided by 8,60,000 plus 10 lakhs. So how much, sir? 46.24 something. Sir, is that clear, everybody? That is the percentage of work completed in year 1. Now come to year 2. In year 2, another cost incurred. How much, sir? 4,75,000. Year 1, 8,60,000. Year 2, 4,75,000. Further estimated cost was 4 lakhs. Can you tell me percentage of work completed? 8,60,000 plus 4,70,000. Please observe, from now onwards we'll apply cumulative only. That means in our previous example you could observe how we will do is 220 into 80 percentage. How much, sir? Can you please tell me? 220 into 80, 176 minus already recognized in last year 60, will record 116. As a result, that excess 6 also will be recorded. We'll always recognize on a cumulative basis. So here also we'll do the same, sir. So in the second year, 8,60,000 plus 4,75,000 divided by 8,60,000 plus 4,75,000 plus 4 lakhs, you will get the cumulative total work completed till second year. How much, sir? 75 or something. Hello, is that clear? 70? Not amount, percentage I am telling. 76.2. Okay, right. Now in the last year, you could observe another 3,10,000 was incurred. You know the total cost incurred divided by same, sir. Last year 100% will be there. Once you know percentage of work complete each year, now you will fill the format, sir. Hello, what is the format? Now you could observe up to reporting date, already recognized in the previous years and recognized in the current year. Now please observe in the if I write the similar point in the here in this question, what is the total contract price? 20 lakhs. First year we will multiply with that 46.24 something. You will get something. You will recognize contract costs. You will write profit or loss. First year nothing will be recognized in the past. You will write the same values here, sir. Now when you go to second year, for 20 lakhs into, you will not write 46 point, you will write 74 or something. Then from this you will reduce total costs incurred till now, you will get the profit or loss. Once again we will reduce last year whatever already recognized, then we will get once again current year profit or loss. Like that this statement will continue. Sir, are you getting the point, sir? Just we'll follow the format up to current year, how much to be recognized, that is cumulative expense to be recognized. From that we'll reduce what is already recognized, then we'll get to be recognized in the current year. In this format we have to fill. Sir, is that clear, sir? Let me discuss one more question and let us have that break. Important question. That means usually this question is considered as difficult, sir, many students. So observe this question carefully. Question number 7, CRD 7. Sir, every question like this, main important thing is percentage of work completed. Because once we know percentage of work completed, we can easily apply on a cumulative basis. Now here, look after CRD 7, sir. A construction contractor has a fixed price contract for how much, sir? 9,000 lakhs to build a bridge in 3 years. What is the contract price, sir? 9,000. Initial amount for revenue agreed in the contract is 9,000. What they are doing? Cumulative base. It is not every year 9,000, sir. That is being given on a cumulative basis. Next, variation in revenue. Year 1, nil. Year 2, 200. That means 200 increase was there. So thereby, in year 2, what is the revised contract revenue? 9,200. In year 3, 9,200 or 400? Is this 200 extra 200 or the same 200 of last year? Sir, if that is extra 200, opening should have been 9,200. If that is extra 200, opening should have been 9,200. Because opening is only 9,000. That means the same is being given on a cumulative basis. So thereby, in third year also our contract revenue how much, sir? 9,200. First year 9,000. Second and third year 9,200. Now contract costs incurred first year 2,093. Second year 6,168. Third year 8,000. They are giving something in star marks, sir. 6,168. It includes 100 lakhs for standard materials stored at the site to be used in year 3. Now tell me, sir, will we record cost for materials consumed or materials purchased? Consumed. So if it is still lying in closing stock, we'll record as expense. No, to be recorded in next year. Hence what we have to do? We have to reduce from this 6,168. So 6,068 is the correct cost for second year. Sir, discussion clear? Now similarly, third year, so tell me one thing. If it is not included in this year, actually it should be included in the third year. Because next year that material has to be consumed. Now, what this talented person has done is, maybe in third year, he has understood this mistake. He has reduced it from the second year, but forgot to include in the third year. Half activity only done. So that is what they are telling. In this 8,100, that 100 lakhs was excluded, which was brought from second year. Now tell me, in the third year it should be there or not? Yes. So thereby total should be 8,200. Generally we assume that it was there in third year, but when they give specifically like this, last year removed and current year not included, then we have to add it to the last year also. In this way we will get the revised costs. Sir, is that clear, sir? Now next, estimated profit for each year was given. Sir, how do we find percentage of work completed? Can you please tell me? Cost incurred till date by cost incurred till date plus further estimated cost. Cost incurred till date is available for each year. Now, do you know further estimated costs? Or do you know total estimated costs? Total estimated costs can be found indirectly. How, sir? Total revenue minus total profit should give you cost, total estimated cost, because we know revenue minus cost gives you profit, then revenue minus profit give you cost. So thereby first year 8,050, 9,000 minus 950, second year 9,200 minus 1,000, 8,200, third year 8,200, whereas the costs incurred in each year is 2,093, 6,068, 8,200. In this way, 2093 by 8050 gives you percentage of work completed for first year. 6068 divided by 8200 gives you percentage of work completed for second year. 8200 means 100% for third year. In this way, percentage of work completed should be found. Once you know percentage of work completed, the rest of the aspects is just a table where we record that format. Up to current year, what should be recognized? What is already recognized will get to be recognized. Have you all understood, sir? That's all. Let us have a break. We'll continue after the break. Still 2 or 3 important aspects are there that will complete in the next 15 minutes. So take a break. Okay.
మొన్న ఫండ్ రైజింగ్ వీడియో పెట్టాంగా వడాఫోన్లో ఉన్నప్పుడు. రామాంజనులు గారు అతని గురించి మీకు వీడియో పెట్టాంగా. అది ఫండ్ రైజింగ్ చేయమన్నారు. ఇంకా ఎవరైనా సహాయం చేసేవాళ్ళు ఉంటే వెళ్తా సహాయం చేయండి. అలాగే గూగుల్ పే నెంబరు 998518888045 998518888045 గూగుల్ పే నెంబరు. ఎవరైనా ఉంటే చేస్తా వెళ్ళండి.
Shall we continue? Okay. I think we have discussed percentage of work. Of course, percentage completion method we have applied through one or two questions. Now, let me deal with few questions, sir, where I'll tell you how to follow. Now, look at CRD 4, everybody. A similar question. Uday Constructions undertake to construct a bridge for government of UP. The construction commenced during financial year ending 31st March 20 and is likely to be completed by the next financial year. The contract is for a fixed price of 12 crores with an escalation clause. The cost to complete the whole contract are estimated at 9.5 crores. You are given the following information for the year ended. Cost incurred up to date is 4 and estimated to complete is 6. Can you tell me initially estimated cost how much, sir? 9.5 cost incurred to estimated to complete the whole. Already incurred 4. Further estimated 6. That means there was a change in estimation. Previously it is 9.5. Now it is 10. So there was an increase in cost. How much percentage? I think 0.5. They have expressed it as a percentage of 10, sir. The resultant value 9.5 became 10. They have expressed 0.5 as a percentage of 10. As a result, escalation in cost by 5%. And as a result, contract price is also changed by 5%. So you could observe what is the existing contract price, sir? 12 crores. Hello, what is the existing contract price? 12 crores. Now what we should do, we have to take the revised contract price as 12 into 5%. So that is 12.06. Is it right? 12.6. 12.60 is the revised contract revenue. Now based on that we have to observe. Is that clear, sir? What is the percentage of work completed for this year? 4 divided by 4 plus 6. 10. 40% is the percentage of work completed. So 12.6 into 40% gives you contract revenue for the period minus contract cost. 4 will give you the profit or loss for the current year. I think you might have got how much, sir? 1.04. That should be the profit. Have you all understood, sir? Escalation clause. Due to escalation clause, your revenue will increase, your cost will also change. The application of that point. As the number of MTPs and RTPs, possibilities there. You could observe 3 RTPs. Possibilities there for exam. Just consider the increased revenue and consider the revised costs. Is that clear, everybody? Next, another question. Question number 5. Mr. X as a contractor has just entered into a contract with a local municipal body for building a flyover. Now as per the contract terms, X will receive an additional 2 crores if the construction of flyover were to be finished within a period of 2 years of the commencement of the contract. X wants to recognize this revenue since in the past he has been able to meet the targets very easily. Can we recognize like that? No. I think I have given you the same discussion. So unless some reasonable period is completed, you cannot recognize the incentive. So that's the solution. You have to write what is incentive. You have to record the recognition criteria. Then we have to say because the reasonable period now has not completed, he should not recognize any revenue. Sir, is the discussion clear till now? Everybody, is the discussion clear, sir? Right. Now, one more point is there, sir, that we should learn. A special provision, I can say that let me tell you through CRD 6. Everybody, are you all ready, sir? Okay, right. Now please observe, ACAR Limited signed on 1/4/2019 a construction contract for 150 lakhs. What is the contract price, sir? 150 lakhs. Following particulars are extracted in respect of the contract for the period ending 31st March 2020. What is the material issued, sir? 75. Now materials, is it a part of the cost or not? Yes. Now will we take 75 or any other amount? Adjustment is there. Out of the material issued, material lying 4,000 is unused. So tell me, shall I take 75 or any other amount? Other amount, which is 71. That 4 lakhs should not be considered. So thereby 71 lakhs. Labor charges, is it part of the cost or not? Yes. But If you observe, they have given a point, 2 lakhs are still outstanding. Shall I take 36 or 38? Why, sir? We are not preparing books of accounts on cash basis, but on accrual basis. So I have to consider labor charges as 38. Next, hire charges. Part of the contract or not? Yes, sir. I have said you sometimes for machinery, if we take on rental basis, that rental charges is part of the cost. Next, other contract costs incurred. Will it be part or not? Yes. So this is not other contract costs. In this only other costs. Hello? Other contract costs. Hello? Some dictionary language you will use, sir. You will feel as other contract cost. No. Hello? This is not other contract cost. This contract only. But other contract costs. Talented people. Now this is other contract costs. This is not other contract costs. In this contract only, other than material, labor and that higher charges, there might be some other costs, sir. This is relating to this contract only. In addition, because they are unable to give all the list, they have simply given other contract costs. Clear? Okay, right, sir. So thereby this is also part or not? Yes. So this 15 lakhs also to be added. Now can you please add these for 71, 38, 10 and 15. How much, sir? 134 lakhs is the cost incurred till date. It is estimated by spending further 33 lakh 50,000, you can complete the balance. That means total cost how much? 167 lakh 50,000. How much, sir? 167 lakh 50,000. What is the percentage of work completed? 134 divided by 167.5. Exactly 80. 80 is the percentage of work completed. So can you please tell me contract revenue for the period? So what is the total contract price? 150 lakhs into percentage of work completed 80, which is 120 lakhs. Contract revenue for the period is 120, whereas contract cost for the period is 134. Profit or loss? Loss. So don't think that every contract means you should have profit only. Here there is a loss. Hello, here there is a loss. But please observe carefully. Though I say clearly 120 is the contract revenue, 134 is the contract cost. So loss is 14 lakhs. But I would like to tell you one thing here, sir. Can you please tell me total contract price how much? 150. Total contract costs how much estimated? 167.5. What is the total contract cost? 150. Total estimated cost? 167.5. Sir, let me tell you one thing. Where the total estimated cost is greater than total contract price. Now here you could observe 17.5 lakhs. There was a loss which was clearly visible. Total contract price is 150, whereas estimated cost is 167.5. 17.5 lakhs loss straight away visible. Out of which, how much loss incurred in the current year? 14. 120 and 134 difference, 14. That means we estimate another 3.5 lakhs in the future year. Hello, we estimate another 3.5 lakhs in the future year. So please understand. So because we are estimating in the future years, we have to apply our prudence. What is prudence, sir? Anticipate all possible losses but not any gains. So this 3.5 lakhs also to be booked today only. Hello, with the head called provision for loss. How we are going to record, sir? Provision for loss. Let me show you in the P&L how we will record this, sir. Usually the contract P&L. Hello, what is that? Contract P&L. The format will be like this, sir. So we write by contract price. Hello, what is that? By contract price. Then we will write to construction costs. Sir, usually contract price means not entire contract price, revenue for the year. For this year, what is the revenue? That we will write as by contract price. Then we will write to construction costs. Hello, are you getting the point, sir? Then we will write if there is profit to net profit. Loss means by net loss. Sir, this is the usually manner of preparing contract P&L. Because incomes minus expenses gives you profit or loss. Income is what, sir? Contract revenue. So instead of contract revenue, I'll use the word called contract price. Instead of expenses, I'll use the word construction costs. Then I'll get profit or loss. In this question, it is 120. It is 134. Now what I have to do is, actually there might be a net loss of only 14. But because total estimated cost is greater than total contract revenue by 17.5, this standard requires you to recognize 17.5, of which 14 is already recognized as current year. Sir, when you recognize 120 as income, 134 as expense, there only 14 loss already booked. So balance you will book as provision for loss. To provision for loss 3.5. In this way we will book the income. Loss. There is the discussion clear. This is the special provision, sir. The provision is very simple, where the total estimated cost is greater than contract revenue. Such costs are to be, such expense is to be recognized immediately, irrespective of whether or not work has been commenced, irrespective of stage of completion. Full work is completed or not, doesn't matter. Work started or not, doesn't matter. Profit is there from other contracts, doesn't matter. If your total estimated cost is greater than total contract revenue, prudence will come into picture. Immediately write down that balance also as the loss. Clear, sir? Let me deal with another question, similar but very, very important. Read CRD 3, sir. Maybe 31st December, I think it is. On 31st December 2018, Vishwakarma Construction Company Limited undertook a contract to construct a building for how much, sir? 85 lakhs. On 31st March 2019, the company found that it had already spent how much, sir? 64,99,000 on the construction and received 55 lakhs as progress payment from the customer. Sir, receipts or payment doesn't influence the revenue to be recognized. Only we have to observe that cost incurred. Cost incurred till date how much? 64,99,000. Prudent estimate of additional cost for completion was 32,01,000. Can you tell me total, sir? Total estimated cost 97 lakhs. Still now incurred 64,99,000. Can you tell me the percentage of work completed? 64,99,000 divided by 97 lakhs. 67% is the percentage of work completed. How do you get contract revenue for the period? 85 lakhs into 67% gives you contract revenue for the period. How much? 56,95,000. Out of which current year cost incurred how much, sir? 64,99,000. Profit or loss? Revenue is 56,95,000, whereas cost is 64,99,000. There was a loss. Whenever there is loss in current year, immediately it should trigger you on a overall basis. Are we having profit or loss? Go and check on a overall basis. Are you having profit or loss? Total contract price 85. Total contract cost 97 lakhs. So thereby 12 lakhs loss is visible, sir. Out of which maybe somewhere 8,05,000 or something is current year, the 8,04,000 I think. So the balance 3,96,000 has to be recognized as loss. That means provision. It has to be recognized as provision. If you ask me, it will be like this: by contract price 56.95, to construction cost 64.99, by net loss 12. As a result, I will create a provision of 3.96. In that way, I have to prepare the contract P&L, and total foreseeable loss means overall loss, sir. That is net loss. How much you are showing as net loss? 985 minus 97. 12 lakhs is the total net loss. Of which something is the current year, something is future. We are anticipating and creating as provision. This is one of the important point. The discussion clear? So with this special point also completed, where the total estimated cost greater than total contract revenue. Let me see one or two other points, sir. Let me tell you. Please look here carefully. There is a concept called as combining and segmenting. Hello, what is that? What do you mean by combining and segmenting? Sir, if a contract has only one asset, please observe carefully. If a contract has only one asset, I don't have any problem. One asset, AS7 will be applied normally. Suppose a contract is having more than one assets, then there comes a question: is it one contract or more than one contract? Why we are thinking one contract or more than one contract? Because AS7 is to be applied contract wise. How it is to be applied? Contract. We should know clearly whether it is one contract or more than one contract. Is that clear, sir? So that's why segmenting means if segmenting principles are applicable, we'll treat them as separate contracts. If combining principles are applicable, we'll treat them as single contract. Sir, please observe carefully. Everybody, two types of contracts are there. One is two types of principles we have to apply. One is combining, the other one is segmenting. If combining principles are applicable, we'll treat it as one contract. If segmenting are applicable, we'll treat it as separate contracts. Why we are thinking about that? Because AS7 is to be applied contract wise. Now, what are the principles of segmenting? I don't want to say this as principles also. Usually these are indicators. Hello, what is that? Indicators of segmenting. I can say there are three indicators of segmenting, sir. First of all, separate proposals. Hello, what is that? For each asset, if separate proposals are submitted, usually it indicates that they are separate contracts. Indicator. Second one, you are able to accept or reject part of it. Sir, suppose I have called for construction of roads in 5 different cities. In 5 different cities of AP, I have asked for construction. I am telling, if you want, you can accept only 3, other 2 can be done by other party. If I am giving you an option like that, that means you can accept either of the 5 roads, then what does that mean? We don't feel it as a single. Accept all the 5 or reject all the 5. If I say like that, that means you are treating it as a single contract. If you are able to accept or reject partly, that means you are feeling that work should be done. We don't bother whether it is done by one person or different persons. In such a case, it is not considered as a single contract. It will be treated as separate contract. Is that clear, sir? Similarly, if costs and revenues are identified separately. Hello, what is that? If costs and revenues are identified separately. Sir, Guntur, Vijayawada, Vizag, Rajahmundry, like the different areas we are constructing roads. Now I am telling, for Guntur 30 lakhs, for Vijayawada 40 lakhs, for Vizag 20 lakhs, for Rajahmundry 40 lakhs. Like that, if they are communicating separately, I think intention might be separate contract. Suppose I say overall 150 lakhs for 4 roads. That means I am discussing together, then I will call it as a single contract. I have to observe whether costs and revenues can be identified separately or not. Discussion clear? So thereby these 3 are the indicators, sir, and these 2 are dominant indicators, sir. Sometimes proposals itself may not help you to decide, but these 2 are very dominant. If you are able to accept or reject only partly, we cannot call it as a single contract. It has to be treated as separate. If costs and revenues are also separate, then also we'll treat it as a separate contract. Let me tell you the principles of combining, which are exactly opposite of this, sir. Here we say able to accept or reject part. Here we say it is negotiated as a single package. Hello, what is that? Negotiated as a single package. If it is negotiated as a single package, we'll treat it as a single contract. That means you can accept fully or reject fully. Similarly, suppose it is decided on a overall profit margin. That means no costs separately for each and every road. I am discussing together. Overall, I require 20 crores profits or 20 lakhs profit. This is the contract price. If they say like that, usually these are the principles of combining. Sir, is that clear, sir? So these are some indicators, sir, which helps you whether it is a combining or that is single contract or separate contracts. Let me deal with the question. You will have an understanding, sir. Question number 9. GTI Limited negotiates with Bharat Oil Corporation Limited (BOCL) for construction of retail, petrol and diesel outlet stations. Based on the proposal submitted to different regional offices of BOCL, the final approval for each outlet in region X, Y and Z is awarded to GTI Limited. A single agreement is entered into between the two. Agreement lays down values for each of the 3 outlets, 102, 150 and 130 lakhs separately. Agreement also lays down completion time for each region separately. In 3 regions, they should construct something like petrol bunks, petrol outlet stations. Now, shall we call it as single contract or separate contract? Sir, I have said you, agreement itself may not be the sole activity. We are talking about indicators. Is there clarity between how they can accept, sir? They should accept fully or reject fully? No. They're not giving clarity in that aspect. But you could observe costs and revenues, sir. I think we are able to distinguish costs clearly, which indicate that they are separate contracts. If they are single, overall margin only they might have communicated. So thereby we will treat them as separate contracts, and AS7 is to be applied separately for each, and net income also will be found separately for each. The discussion clear? So this is the concept of combining and segmenting. With one last concept, we'll close this standard, sir. Within 5 minutes we are going to close this. The last concept is computation of gross amount due from or due to customers. Hello, what is that? Computation of gross amount due from or due to customers. Now please look here carefully. Sir, let us say total contract price is 200 lakhs. How much, sir? 200 lakhs. 30% work is completed. And you have received 50 lakhs. Now what do you feel, sir? Actually, how much is receivable? 60. If 30% work is complete, 60 lakhs. But how much is received? 50 lakhs. So thereby, what do you feel? How much revenue you will recognize? Revenue recognized will be 60, because it is not based on actual receipts or payments. What about that 10 difference? We will show it as receivable. Hello, we will show it as what, sir? Receivable. Now similarly, suppose I have received 70 lakhs, then 60 lakhs only receivable, sir, but you have received 70. It's just like an advance received. I will show it as payable. Hello, I will show it as payable. Suppose the first year 50 lakhs received, sir. Second year another 50% work completed. I'm not telling individual, I'm not telling cumulatively, sir. Individually, and second year another 50% work completed. Let us assume I have received 90 lakhs. Now can you tell me overall in 2 years what is the difference? Shall I show it as receivable or payable? I could observe totally how much is completed? 80. How much is receivable? 160. How much is received? 140. Still I say 20 is receivable. In other words, to say how much is receivable or payable, I have to look on a cumulative basis. I have to look on a what, sir? Cumulative basis. I will compare what, sir? I will compare two things. One is contract revenue and the other one is actual receipts. Hello, what is that, sir? One is contract revenue. The other one is actual receipts. If revenue is greater than receipts, I will say it is receivable. If revenue is less than receipts, I say it is payable as a advance. Sir, is that clear, sir? Now revenue they will not find directly in the ICAI material, sir. They will use different format. The information also in the same way. Now do you remember P&L, sir? Contract P&L. How do we prepare? By contract revenue, that is contract price, to construction cost. You will get profit or loss. Am I right or not? Now what we should compare, sir? We should compare contract revenue with receipts or receipts. So instead of directly writing contract revenue, they say cost plus profit. Hello, what is that? Sir, can I write like that or not? Yes. Suppose there is loss, then cost minus loss. Cost minus loss also will give you what, sir? Revenue only. So please understand, they'll write like this, sir. Cost incurred plus profits recognized minus loss recognized. Sir, both are possible, because you are looking on the cumulative revenue recognized. 1 year profit may be there, other year loss. In simple, tell me how much is receivable from the customer? Whatever cost you have incurred plus profit, if any. Hello, how much you will recover from your customer, sir? The cost you incur plus the profit, that is only recoverable. So from this only we will compare with the receipts. Are you getting the point, sir? Instead of using the word contract revenue, they will use this format, sir. Cost incurred till date plus profits means we will add, loss recognized means we will reduce. So hope it is clear. This we will compare with receipts, sir. Actually in the standard they will not say receipts, they will say billing. Hello, what is that? Billings, progress billings. Sir, when I say progress billings, two things you have to observe. Billed and received will be considered. Billed and to be received also will be considered. Now what is this billed and to be received, sir? Actually this is called as retention money. What is that? Sir, sometimes work is almost completed but still we will not give money. We will retain some. Why, sir? Maybe small repairs are there in the house also. What we'll do, we'll not give full money. Because if we give full money, they'll not do work properly, sir. They may escape the balance work. That's why though work is completed, we'll always retain some money till the end. Similarly here also, work completed, invoice also raised, but payment is not done. Such is called as retention money. Hello, what is that? Retention money. It is also called as billed and not yet received. Hello, what is that? Billed. Billing is done, but not yet received. Standard asks you to assume that this is also received. Because standard wants to know work done for which billing also not completed. Hello, what standard wants to know? Work is done for which billing also not completed. That's why this is also compared as a part of the, or computed as a part of the receipts. They'll compare with entire progress billings. They'll take these two, and if A is greater than B, receivable. A is less than B, they say it is payable. Have you understood, sir? Let me take a question and show you. You'll have full clarity. Generally, if they want to ask a difficult question, this question only they may ask in the exam, sir, from AS7. CRD 10. Let me show you, sir. Quickly, let us close this. With this, we'll close the standard. Now, total contract price 1000. Work certified 500. Work uncertified 105. I have said you work certified or uncertified doesn't matter. Together gives you what, sir? Cost incurred till date. This is the cost incurred till date 605. Further estimated cost is 495. Progress payment received. This is progress payment to be received, sir. Nothing but our retention money. Hello, what is that? Retention money. We feel that this is also received, sir. That is what I am telling. I want to know work done for which billing also not received. That only real receivable for me, because this is retained only to ensure better performance of the balance contract. Standard doesn't want companies to show to the users that this is not yet received, because standard feel one or the other day you will receive it. It is only kept aside to ensure the better performance of the balance contract. That's why they make it part of the receipts. Okay, anyway, now can you please tell me in this question, first you should know cost incurred. What is the cost incurred, sir? Hello, what is the cost incurred? 605. This is the cost incurred. Now in this year, are we having any profit or loss? Now you could observe, together how much, sir? 1100. Contract price 1000. I think on an overall base itself loss is there. Your net loss will be 100. Your net loss will be 100. How much loss you will recognize? 100. So can I say 605 minus 100? This is my recoverable amount. Accepted. Cost plus profit. If it is loss minus loss. So cost is 605, sir. So loss I am reducing. So how much is recoverable, sir? 505. How much is received? 540. So thereby what we'll say? It is payable. 35 will be shown as advances received payable. Gross amount due from due to customers. Due from means receivable. Due to means payable. Sir, actually they will ask in this question disclosures, sir. You have to write down contract revenue for the period, profit or loss for the period, then maybe the retention money. These aspects you have to show, sir. Contract revenue, contract costs, profit or loss, progress billings, retention money, gross amount due to customers. Like that you have to make some disclosures. But anyway, in that the aspect that you don't know is computing this 35 lakhs only, which is nothing but gross amount due to customers. For cost, you will add the profit if there is profit. If you will reduce the loss if there is loss. This is the recoverable amount. You will compare with the progress billings, both billed and received, billed to be received. Then you will get that amount of difference, sir. Either you will consider as receivable or payable. Sir, have you understood, sir? With this, all concepts of AS7 also completed. With this, we are closing AS7. Sir, have you all understood till now? AS4, 5 and 7. Is that clear till now, sir? Okay. Sir, I am moving fast, but still I am trying to cover almost all the aspects which is possible of getting asked in exam. Now, let me proceed to the next set of standards, sir. Now in this session, of course, still only 1.5 hours left. So we'll try to complete to the extent possible. Don't worry. So we'll complete 9, then 18, 20. So this is the another set we are going to complete now. 9, 18 and 20. 9 is revenue recognition. 18 is related party disclosures. 20 is EPS, earnings per share. In the afternoon session, we'll complete the balance 6 standards. So first, let me start with AS9, which is what, sir? Revenue recognition. Okay. Sir, in AS9, what we are going to learn mainly? This standard is going to discuss mainly about the timing of revenue recognition. What we are going to learn, sir? Timing. We are not going to learn how much amount should be recognized. Amount is not the focus, sir. Here, what is the focus is timing. Timing of revenue recognition. When revenue should be recognized. Of course, when I say revenue, here we are going to discuss about 3 types of revenues only, sir. In this standard, we are going to discuss about only 3 types of revenues. What are those 3 types of revenues? Revenue which is arising from sale of goods. Hello, what is that? Revenue which is arising from sale of goods. And revenue which is arising from rendering of services. And revenue which is arising from use of enterprise resources by others, which is giving you these 3, sir. IRD, interest, royalties and dividend. That means these are the third set, sir. Interest income, dividend income, royalty income. So only for these incomes we are going to learn timing. So this standard focus on timing of revenue recognition, and that too or not for all types of revenues, sir. We are going to learn about only 3 types of revenues, and that too we are going to focus on only timing. So what are the 3 types of revenues? One is sale of goods, the other one is services, and the last one is use of enterprise resources by others yielding interest, royalties or dividend. In other words, 3 incomes. This is IRD. Let us call it as IRD, interest, royalty and dividend. Okay, right, sir. Let me start with one by one. First, sale of goods. Hello, what is that, sir? Sale of goods. Sir, if you want to recognize income from sale of goods, for that 3 conditions should be satisfied mainly. How many conditions, sir? 3 conditions. What are the 3 conditions that should be satisfied, sir? First one, significant risks and rewards incidental to ownership should be transferred. Hello, what is that? Significant risks and rewards should be transferred. Second one, there should be certainty in amount. Hello, what is that? There should be certainty in amount. So this is what I can say as informal words. Formal wording is there should not be uncertainty with respect to the amount. Hello. This is the formal word used by ICAI. In simple, I am telling there should be certainty in amount. You can write in ICAI language also. There should not be uncertainty in amount. Then the third one is certainty in collection. I am giving you in simple language, sir. Certainty in collection. ICAI formal language is ultimate collection should be certain or probable. This is what the ICAI wording, sir. Should be probable or certain. This is what ICAI wording. For second one, they will use no significant uncertainty regarding amount. This is what the wording used by ICAI, sir. Because we should learn in simple language and also remember the ICAI wordings. Both are important. 3 conditions are there. One is significant, risks and rewards should be transferred. Second one, certainty in amount, certainty in collection. In other words, there should not be uncertainty with respect to amount. There should not be uncertainty with respect to collection. So like the 3 aspects are there. Only if all the 3 aspects are completed, we can say revenue should be recognized. Sir, is that clear, sir? Now in this, let me focus on this aspect, sir, which is certainty in collection, which is common for all the three types of incomes. Now I will do some discussion, sir. This discussion is common for all the three types of income. That means sale of goods or services or IRD, interest, royalties and dividend. Now what is that, sir? Sir, you are telling there should be certainty in collection. Suppose there is uncertainty. What you will do? Hello? Suppose there is uncertainty in collection. What you will do? Now then the issue will come, sir, when that uncertainty arose, is that uncertainty existing at the time of revenue recognition or uncertainty came after you recognizing the revenue? Uncertainty at the time of revenue recognition, uncertainty after revenue recognition. Sir, if it is at the time of revenue recognition, that means till now you have not recognized the revenue, then standard says postpone the revenue recognition. Don't recognize the revenue until it is certain. Until the collection is certain, don't recognize the revenue. Postpone the revenue recognition until it is certain. Until it is certain, postpone the revenue recognition. What if it is after revenue recognition, sir? Hello, if uncertainty arose after, that means sale is completed. After that, we are having some uncertainty whether he may keep this. Hello, he may become insolvent. We are having a doubt after that. Now, what we have to do? Shall we reverse whatever we have recognized already? No. Standard says you need not reverse the revenue already recognized, but just create a provision. Hello, but just create a provision. So, if it is after revenue recognition, need not reverse the revenue already recognized, but have to create a provision. But have to create a provision. Sir, this is applicable for each and every type of revenue. That means before you recognize revenue itself, if there is uncertainty, don't recognize that revenue only. No, sir, uncertainty is not there at the time I recognize revenue. That's why I have recognized the revenue. But after I recognizing the revenue, there came the uncertainty. In such a case, okay, already recognized, no, don't reverse it. But show a provision that this amount may not be continuing as a revenue for future. That is, we'll create a provision. In this way, there is a topic with respect to uncertainty in collection. At this point, clear? Okay. Next, uncertainty amount is very simple, sir. Whenever the amount is certain only, we'll also recognize the revenue. Now, next, first one, significant risks and rewards. Sir, when significant risks and rewards will be transferred? When do you think it will be transferred, sir? Usually along with possession. But we cannot see only possession as the main, sir. Once billing is done and once we say it is transferred, usually risks and rewards are transferred. But for deciding when risks and rewards are transferred, actually we are having different scenarios. That is what we learn as special situations in the time of sale of goods. Normally, it is not based on possession alone, it is based on billing. When you have done the billing, at that time only you feel that sale is complete. But there are different scenarios where you should know how this risks and rewards are said to be completed, when they are said to be complete, or when revenue should be recognized. For learning these things, we are having different scenarios. Let us go and look after those scenarios. Are you all understanding, sir? Okay, right. So let me move to that different scenarios. AS9. Sir, there may be many special scenarios. I will discuss only those which are required for examination. Now, please observe, sir. Delivery is delayed at buyer's request and buyer takes title and accepts billing. So, look at this point, sir. Look at this type of sale. What is happening? Delivery is delayed at buyer's request and buyer takes the title. Sometime it may happen like this, sir. Now, we have ordered some goods, sir. Now they are ready to send it, but what we have said is no, shop renovation is being done. Please keep with you only goods for 1 more week. After 1 week, I'll take your goods. Sir, are you getting the point? Here already sale is completed. You are telling I have purchased it. You made the payment also. But because there is no sufficient space for you, now you are telling please return with you only for 1 week. Or let us say I am purchasing from foreign country or some other distant place. I feel that in the next 1 week big tufans or tsunamis are expected and I am making it through shipping mode. Now my stock may be destroyed. What I am telling is, sir, please keep it with you for 10 more days. Once I give the instruction, you please send it. If billing is completed, if everything is over, just possession is waited, then sir, intentionally I am only telling to delay the delivery. In this scenario, can I say only when delivery is completed, sale is completed? No. Already when risks and rewards are complete, that is when you have accepted the billing, at that time only sale is said to be completed. You need not wait till the delivery of the goods. Risks and rewards are already said to be completed. There is the discussion clear? So this is what point number 1. Let me read the scenario. Revenue can be recognized and need not be postponed till the physical delivery is made, so long as there is every expectation that delivery will be made. You can recognize. The next, another important one, sir. Goods delivered but acceptance subjected to installation. I think some assets require installation, sir, just like plant and machinery, etc. Now tell me, now when do you recognize the revenue then? If they are subjected to installation, when do you recognize revenue? Only when that installation is completed. Only when that installation is complete, we'll recognize the revenue. Next, goods sold on approval basis. Hello, what is that? Goods sold on approval basis. I think you know in foundation itself. Usually, in the case of goods sold on approval, when do you feel sale is said to be completed, sir? If it is goods sold on approval basis, when do you feel sale is said to be completed? Either when he has given a approval or time period is completed. Usually we look after the time period mentioned in the contract. If nothing is mentioned, even if reasonable period is completed, we say that sale is said to be completed. Is that clear, sir? I think I need not explain. Next, consignment sales. Can you tell me when it is said to be completed? In the case of consignment, now I think consignor, consignee, you remember, sir, consignee is like a agent. Now, A is consignor. A has sent goods to B, consignee. He will sell to the final customers. Now, let us say goods are there with consignee. Shall we recognize revenue for that goods? No. When revenue should be recognized? Only when the goods are sold by consignee to third party. Is that clear, sir? Only when goods are sold by consignee to the third party, then only revenue shall be recognized. So hope it is clear. This is goods sold on approval and consignment sales. Suppose cash on delivery sales, when we should recognize? Suppose it is cash on delivery sales, when we should recognize, sir? Only when we have received the delivery, because when we have received, of course, the delivery cash will pay, because most of the times whenever you make that COD orders, what you may do, he will come, but we will not pick up the call. Am I right? Or even we pick up, we say we don't need this good, because sometimes it may happen that we may find subsequently the same item at a lower price. Am I right or not? Or another good quality item. So sale cannot be guaranteed unless you receive the cash. Is that clear, sir? You in the sense either seller or his agent, Amazon delivery agent. Hello? So either of them, if they receive the cash, you can recognize as sale. So like that, some scenarios are there, sir. I'm taking whatever is only important for examination. So let me discuss 1 or 2 issues also. They'll give this one also in the examination, sir. Usually trade discounts. Hello, what is that? Trade discounts, cash discount, and any sales returns. This also we should know. Can you please tell me? Trade discounts will divide into 2, given and trade discounts received. Trade discounts received, first tell me, is it a revenue for us? Trade discount received, is it a revenue for us? Sir, it is a reduction of cost. Hello, our purchases value will reduce, but it is not any revenue, because revenue definition is like this. It is gross inflow of cash, receivables, or any other consideration arising from sale of goods or rendering of services or IRD. It is not because of you purchasing higher quantity. Hello, are you getting the point? So this is not a revenue. So it represents only a cost reduction. This is not a revenue, only cost reduction. Suppose trade discount is given. Will it affect your sale value? Trade discount is given. Will it affect your sale value? Yes, sir. Trade discount given to be reduced from sales, because that amount only you are going to write in the trading account. Sir, in trading, what you will write, sir? Sales value after reducing trade discount, that only you will record. So sales, from the sales value will reduce the sales, that amount only will reduce the trade discount, that only we will show. Next, what about cash discount? Cash discount also may be given. Cash discount also may be received. Can you tell me, cash discount received, revenue? Sir, is it revenue? No. That's why I'm telling only 3 types of revenues are covered. One from sale of goods, or from services, or from IRD. I think it is nothing of these 3. It is an income only, but not a revenue as per AS 9. Thereby, not a revenue. Next, cash discount given. Will it be reduced from sales? No, it's a P&L expense. Hello, trade discounts has to be reduced from sales. Cash discount only in P&L, not reduced from sales. Next, sales return. Will it be reduced from sales? Sir, sales return, will it be reduced from sales? Can I say it will have an impact on the sales revenue to be recognized? Yes or no, sir? Will it have an impact or not? The answer is no. It is not going to change the sales value. Sir, please understand one thing. Will you record in sales ledger account the sales return? No. Actually, you will just show it for the purpose of presentation, sales less sales return, but actually both are separate ledger accounts only. Now observe the difference between trade discount and sales return, sir. Do you show in your trading account sales less trade discount? No. You will directly write the net price. Whereas sales return, what you will do? First you will write sales, next you will write sales return less. To be frankly speaking, our revenue is same, sir, by sales. Whenever there is sales return, I have to record 2 sales returns separately, sir. But for the purpose of better presentation, instead of showing it on the credit side, we will show it as a reduction. Sorry, instead of showing it on this side, we will show this as a reduction from the sales. It is only for the purpose of presentation. Really, sales ledger will not be affected. Sales return ledger also will not be affected. Both are separate ledger accounts. If it is single ledger account, why to create sales return ledger account, sir? Directly you can use sales account only. Is that clear, sir? So it will not be affecting the sales that you record in trading account, but the net amount you present will be changed. I am not talking about that, because revenue definition is like this, sir. Revenue refers to gross inflow of the cash, receivable, or any other consideration. It is talking about what, sir? Gross inflow. So thereby I will not reduce any sales return from sales when I am recording it initially. Later on, for the purpose of presentation, I may reduce it. That is presentation only, not the actual sale value. So discussion clear? So like that, these are some of the important items. Let us see 1 or 2 questions, sir. You will have a better clarity. Okay, please look at this question, sir. A manufacturing company has the following stages of production and sale in manufacturing fine paper rolls. Now you could observe, sir, first it is raw material, then it is in the process of work in progress, then it is finished good, then it is ready for sale, then sale agreement was entered and invoice was raised and delivery was done here. Tell me at which point of time risks and rewards were transferred? Sir, at which point of time, on which date risks and rewards were transferred? I think we need not wait for a delivery date, sir. When the billing itself was done, I think significant risks and rewards are transferred. That is on this date, significant risks and rewards are transferred. So thereby, what is the profit on that date? 1,50,000. That is revenue means sales only 3,50,000. The profit on that date will be 1,50,000. Profit to be recognized is 1,50,000. Revenue to be recognized on 15th March. That should be the net profit. Of course, in this scenario, gross profit also same, sir. But sometimes what they may say is, later on here, delivery costs are 2,20,000. Net profit means at last, finally, what is your profit, sir? So then 3,50,000 minus 2,20,000, 1,30,000 only. If at all there is a change. In this question, there is no selling or delivery expenses. Suppose selling or delivery expenses are there, this will become GP, 1,50,000. 1,30,000 will become NP. In this question, both GP and NP are same, which is 1,50,000. Is that clear, sir? GP is at the time of sale. After sale also you may incur some expenses. That is what I am telling. Anyway, here timing is important, sir. On which date you will recognize revenue? 15th March. You have to write all those three, sir. Reasonable to expect ultimate collection. No significant uncertainty with respect to amount. Similarly, significant risks and rewards are transferred. Those three conditions are very, very important. Now, let me deal with question number, just wait, sir. Question number 5, which is important. Look at question number 5, sir. Goods of rupees 80,000 were sold on 10th March 2019, but at the request of buyer, these were delivered on 10th April 2019. Can you please tell me on which date we'll recognize the revenue? 10th March or 10th April? So I think it is on 10th March that we recognize the revenue. Next, on 25th January, goods of 2 lakhs were sent on consignment basis, of which 20% of the goods unsold are lying with the consignee on 31st March. Can you tell me for how much we should recognize the sales, sir? Only for 80%, which is 1,60,000. For that 20% we should not recognize. Only when it is sold by consignee to the third party we have to recognize. In third scenario, 2,40,000 worth of goods were sold on approval basis on 1st December. The period of approval was 3 months, after which they were considered sold. Okay. Buyer sent approval for 75% up to 31st March, and no approval or disapproval received for the remaining goods till 31st March. Can you please tell me for how much amount I should recognize the revenue? 75% means how much, sir? 1,80,000. For 1,80,000 definitely we should recognize. What about the balance 25%? 60,000. If the time period is completed, we feel sale is completed. Otherwise, no. What is the time period in the question? 3 months. And when the time period starts? 1/12. That means already by 31st March, the time period over. As a result, we feel that sale is completed. For entire 2,40,000, we feel that sale is said to be completed. Sir, is that clear, sir? Next, apart from the above, the company has made cash sales of 9,60,000. Trade discount of 5% was made. Can you please tell me how much I should recognize as sales here? 9,60,000 minus 5%. That is to be recognized. Okay, whatever is there. Is that clear, sir? So if you add all the scenarios, you'll get 13,92,000. That should be the total revenue to be recognized. One of the frequently asked questions, sir. So very, very important. Now, let me deal with some other questions. Victory Limited purchased goods on credit from Lucky Limited for 250 crores for export. We have purchased some goods, sir, for export basis. The export order was cancelled. Hello, we thought to export it. For that purpose, we have purchased goods, but suddenly export order was cancelled. Sir, usually exports will have higher prices. Locally means we cannot sell at that higher prices. Now, Victory Limited, because export order was cancelled, thought to sell the goods in the local market with some discount. Anyway, if you are selling in the local market, usually you have to sell at lower prices. As a result, your profits also will come down. You have requested your supplier, sir, I thought to export it, but today I cannot export it. Could you please reduce the price so that at least it could be a lot of help to me. Like that, we have requested whom, sir? Supplier, to please reduce the payment. Lucky Limited was requested to offer a price discount of 15%. The chief accountant of Lucky Limited wants to adjust the sales figure to the extent of the discount requested by Victory. Discuss whether this treatment is justified or not. Is this correct or not, sir? Can they do like that? The answer is no. Hello? The answer is no. Why, sir? Tell me, is that cash discount or trade discount? If it is trade discount, you reducing from the sales is appropriate. If it is cash discount, you cannot reduce. So cash discount at trade. Sir, trade discount means it should happen at the time of sale itself, that too because of volume. Now here it is not happening at the time of sale, it is happening later on due to some reason. So we cannot call it as what, sir? Trade discount. It is only cash discount and hence should not be reduced from the sales. Hope it is clear. Now let me deal with another question, sir. Question number 2. Usually in this question confusion will be there. Let me read it. The board of directors decided on 31st March 2012 to increase the sale price of certain items retrospectively from 1st January. Hello, he decided to increase the sale price retrospectively. In view of this price revision, with effect from 1st January 2012, the company has to receive 15 lakhs from its customers in respect of the sales from 1st January to 31st March. Please observe, there is a company, sir, who is increasing the prices on which basis, sir? Retrospective basis. Of course, from the last 3 months. Let us assume this is the year end 31st March. They are increasing the prices not only from now onwards but from 1st January. Already from 1st January these 3 months sales was collected. Now what we are telling? No, that price is not sufficient. We should do on a retrospective basis. Now the question is, this increased value, shall we include it in our sales or not? Is the point of discussion. First of all, tell me, amount is certain. Think amount is certain. We can say 10% increase means we can easily find the amount. Risks and rewards already transferred. Yes, when the goods were transferred and billing was done, at that time only risks and rewards also over. Collection is certain. Depending on this only your answer has to behave, sir. If collection is certain, you can recognize this extra 10% also. If collection is not certain, you should not recognize. Tell me, what do we assume? Collection is certain or not certain? If you ask the amount to pay on retrospective base higher amount, do you think your customers will pay? Hello, do you think your customers will pay? It depends on the type of customers. Hello, it depends on the type of customers. Sir, you might be thinking most of the customers will be of one nature only. No, I am not telling among the individual. Sir, if I am doing business, I may be a manufacturer having some traders as my customers. In other words, retailers or wholesalers may be my customers. Or I may be a retailer where I am having some final consumers as my customers. Now please observe, if I am final consumer, if I am purchasing from retailer, suppose retailer increases from retrospective basis, do you think final consumers will pay? They don't look at that shop only. Hello. If you say you have to, for the last 3 months, whatever you have purchased, pay me some extra amount, do you think that customers will return to you? No, they'll go to another shop only. Hello. Because the same products can be available from different persons. They don't bother about it. Are you getting the point? Suppose I am a retailer or I am a wholesaler who purchase from this manufacturer regularly. Now tell me, just because he is asking for increased price of few transactions happened in the last 3 months, would I stop my trading relations with that person? Because if I don't pay, now relations will be stopped, sir. Here it is Lilliput transactions, Lilliput amount. They don't bother. But here, huge number of transactions will happen. The two will look after quality, will look after price, number of aspects will be there. Just because some 5% or 10% increase was there, I think we don't straight away stop our trading relations. We'll negotiate. Maybe we'll say, so this time we'll pay, from the next time onwards, reduce the price considerably. Like that discussions will happen. We don't say, price increased, I'll find a new manufacturer. Like that usually it doesn't happen. So I can say, if your customers are retailers or wholesalers, then maybe this can be considered as collection is certain. Maybe if your customers are that final consumers, they'll never return only. So thereby we can assume as collection is uncertain. What I say is, depending on the types of customers only, your answer should change. No clarity in the question. So that's why no clarity should be there in your answer also. So we'll write in both the ways. In the exam, in the ICAI solution, what they have done is, they have said additional revenue can be recognized if the company is able to assess the ultimate collection with reasonable certain. They have given that conditionally. If you are able to say collection is certain, recognize. Otherwise, don't recognize. Logic for this is depending on the types of customers only, we can decide whether collection is certain or uncertain. I hope everybody have understood. So these are some of the questions, some of the important questions which are based on sale of goods. Hope everybody have understood, sir. Now, let me move to sale of goods, important questions. Some of the questions we have completed. Let me move to services. Hello, what is that, sir? Services. And one more point, usually this question also many people will feel as difficult. Not everything I'll discuss, sir. One point only. Please observe carefully. Sir, sometimes the sales may happen like this. We'll give to our agent or any intermediary some period unlimited right to return, sir. In other words, maybe whenever you go to a shop, any for purchasing any apparel, dress or clothing, something, what they say, sir, take this dress. Now, if you feel it is losing its color or not working properly, bring back within 2 weeks or 3 weeks. I will take the return. Have you ever observed like that, sir? Yes, because they always have a chance that within 1 month of purchase they can return. No extra charges. No, nothing for returning them. Like that, some period will be there for every intermediary person. They can return within some period. They'll have a right to return on a limited period basis. Hello, it is not that unlimited period. If I talk about a consignee agent, I think there is no limitation for him. If he is able to sell, he will keep it with him. Otherwise, he will return. But whereas with such types of intermediaries who are just called as distributors or any other we can usually say as distributors, they'll just distribute that, sir. In such a case, if at all a limited period of return is given, then unless that return period is completed, we cannot actually know how much sales is done. Wait till that return period is over, then only you please recognize the revenue. Have you understood, sir? Because we don't know within that 1 month how many items that our trader or retailer will return back. Then only after completion of 1 month only amount will be certain. Is that clear, sir? In this question, there will be a scenario, sir. One of the conditions for sales is dealers can return the unsold stocks within 1 month of the end of the season. When you should recognize revenue, immediately or after completion of that 1 month? After completion of 1 month, then only you will have a proper understanding, because within 1 month we don't know how many items will return. So thereby wait for completion of 1 month, then only amount will be certain. Discussion clear? So with this, sale of goods completed, sir. Let me move to other 2 types of revenues we are having. What are the other 2 types, sir? One is services. The other one is use of enterprise resources by others. First, let us talk about services. Hello, what is that? Services. Now, let me tell you, sir. Sir, how do we recognize revenue in the case of services? Here also 3 conditions only. What are the 3 conditions? Second and third are same, sir. What are second and third? Certainty in amount, certainty in collection. Only first one is different, sir. First one is when the service was performed. Hello, what is that? When the service was performed. But how can we say the service is performed? Hello, when do we say that the service is performed? It depends on the type of service. Hello, what, sir? It depends on the type of service. Now, we usually divide services into 2 types, sir. In the standard, this language will not be used, but for our clarity, we will use, sir, divisible services and indivisible services. What is that? Services, we usually divide into 2. One is divisible service. The other one is indivisible service. Hello? 2 types of services will be there, sir. One is divisible service. The other one is indivisible service. What do you mean by divisible and what do you mean by indivisible? Indivisible means very simple, sir. You cannot divide it. Now, let me take an example. You will have a better clarity, sir. Let us say, maybe usually I'll take this example in the classroom, but okay, it's okay now. Now, let us say, let us take our professional doctor, sir. Let us say for doctor, surgeries will be there, sir. Surgeries will take how many times, sir? How much time? Usually it may take 10 to 12 hours depending on the type of surgery it takes. Let us assume on 31st March somewhere at 6 o'clock or 7 o'clock surgery was started, sir. By night 12 o'clock body parts was opened. Hello. Now next day, that means after 12 a.m. Balance work was done and body parts was closed. Now is this surgery divisible or indivisible? Sir, if you say divisible, I should recognize half income in last year, half income in next year. If I say this is indivisible, entire income in the next year when the service was fully performed, tell me divisible or indivisible? Sir, if you say this as divisible, that means even if you stop the work on 31st March, they should pay you half amount. Suppose 31st March midnight, you open the body parts, you left, sir. You ask them half income, will they pay? They will not pay the money, they will file a return case on you. Hello, you just open the body parts, half only completed. Sir, is that clear, sir? In other words, this is what, sir? Divisible or indivisible? Indivisible. Let me take another example. Maybe painter, usually you observe, sir. Painters will be there. Let us say we have ordered for painting of a full body of some national leader or somebody, sir. By 31st March, let us say half body was completed. Hello, balance half body was completed in next year. What we will do? Half for half body, half revenue in last year, another half body, half revenue next year. Will you recognize like that? No, sir. Only when the entire body was constructed, we say full work is completed. Let us say chartered accountant services was there, sir, auditing services. Now, let us say we started auditing in the month of March, April, May. 3 months work is completed, sir. Now, can I say this is divisible? Can I divide my revenue into 3 months? Sir, 3 months, March, April, May, internal audit was done. Can I divide my revenue into 3 months, March, April and May? No, usually because auditing will be done during all the 3 months, but report will be provided in the last month. You should know one thing, sir, suppose sufficient staff was there, auditing not done. But in the last day report given, will they give revenue? Will they give revenue? Client, will they give revenue, sir? Will they give money to you? Suppose checking was not done, but you have certified that everything is good. Now will they give revenue? Why not, sir? They require ultimately certificate only. Hello, suppose now you have done everything well, work was done, everything well. Last day said, I will not give you certificate. Now will they give money, sir? No. Sir, please understand, both are not equal level. Out of this entire process, one significant act was there. Only if that is completed, service is said to be complete. Otherwise, no. You giving audit report a true and fair view with that is only required for them. That is the most significant activity. If that is completed only, service performed. Otherwise, no. That's why what I say, all these are indivisible. In fact, most of the professional services are what, sir? Indivisible. Here, how do we recognize? Very simple. Only when service is completed, we recognize the revenue. Hello, is that clear, sir? Only when service is completed, we recognize the revenue. In other words, this we will call as completed contract method. Which method? Only when the entire contract is completed, we will recognize the revenue. Completed contract method. Now, what is divisible, sir? Let me take the example of hotel services. Hello. Now you have gone for accommodations or something. Now maybe you have gone to some other state. You have stayed in a lodge for 4 days. 2 days 30th and 31st March. Another 2 days 1st and 2nd April. Can I allocate my expense over 4 days or not? Yes. Comfortably in a hotel, 2 days and 2 days there, 2 days here, easily accommodation is possible. The nature itself is divisible. Every day same type of service can be divided. Is that clear, sir? So take any tuition fees or coaching fees, sir. Now if you our management will be taking some revenue, can they allocate it over number of months, sir? Absolutely yes, because over the period only they are providing. For each month equal types of services are only provided. It is not that first month only more important, last month not important. Every month are equal. And if suddenly coaching is stopped due to corona or some other reason, can you give back the can we collect the balance money? No. Or will you give back the already money done? Nothing will happen. It is proportionate. Hello, each act is related. In other words, this is what, sir? Divisible. Hello, this is what, sir? Divisible. If it is divisible, how do we recognize? It is simply just like our AS7 percentage completion. Based on the percentage of work completed only, we'll recognize Based on this only revenue will be recognized. Sir, have you all understood, sir? Basically, depending on the type of the service, we recognize the revenue, whether it is divisible or indivisible. Standard doesn't use this word, sir. They'll use some other words, but ultimately they say these two methods will be used. One is completed contract method, the other one is percentage completion method. Anyway, there are different scenarios where we should decide when service is said to be completed. Hello? There are different scenarios where we should decide when service is said to be completed. Let me show you those scenarios, sir, which are important for the examination. Now, first, usually this is important, sir. Insurance agency commission. Already tuition fees now itself I have discussed. When do you think tuition fees will be recognized? Over the period of coaching. Hello, over the period of instruction or coaching. Now, insurance agency commission. I think insurance agents will be there. Now, number of times you might have come across, sir, agents will be coming to your house for policies. Please take one policy, will get some commission. Hello, insurance agents will get commission. When do you think they should recognize the revenue? When do you think they should recognize the revenue? Is it over the year or when the policy, on the date of policy? Yeah. I think I can say it is renewal date, sir. If the premium, every year you are paying premium, based on premium payment only, they'll receive some commission, sir. Either if it is first time they are taking the policy, maybe we can say commencement of the policy, or if it is getting renewed, renewal date. Either the commencement date or renewal date, on that day they can recognize the revenue. Because, sir, premium payments may be half yearly, quarterly, monthly also. You could observe whenever you are paying premium, insurance premium, sometimes monthly payments will be there, sometimes quarterly, sometimes half yearly. So we cannot decide simply based on payment, sir. We have to look at renewal date. If you accept for renewal, that means for entire year you are going to pay the premium, but not at a time. You will pay slowly through the number of months. So it is not whenever you pay, you have to observe that commencement date or renewal date. So in the case of insurance agents, it is commencement date or renewal date. Suppose if I talk about this admission fees, what is this admission fees, sir? Maybe if you enter any events, sir, special events, entry fees will be there, admission fees. Now how do you recognize? Based on the event. If that event takes place, you can recognize that revenue. Any magic show or any other musical performance. When that event is completed, or any other cricket match, sir, when that event is completed, you can recognize the revenue. Let me discuss this example which is possible of getting asked in examination. Advertisement income. Hello, what is that? Advertisement income. So usually when advertisement income should be recognized, sir? Can you tell me when advertisement income will be recognized? Because you know, sir, TV channels will get advertisement income. Newspapers also will get advertisement income. TV channels will get advertisement income for what, sir? Sale of time. Newspapers for sale of space. They are doing some sales, sir. Sale of time and sale of space. Okay. When they should recognize the revenue? Very simple. When that advertisement appears before public. So, suppose I have paid huge money, sir. Maybe let us say this week ending, and Narendra Modi ji has thought to make a big announcement. Like that he has mentioned in the Twitter. Coming up a big announcement on this Sunday. Like that is mentioned on the Twitter. Now usually what will happen, sir? For TV channels, there will be companies who will be advertising. At that time, prime time, when Modi ji is telling something, the currency ban or something else. Hello? Or something else. Now you have to give my advertisements and so slot. So take this much amount. Am I right or not? Suddenly Modi ji thought, no, this decision not required. Cancelled, sir. That meeting was cancelled. Now tell me, whatever revenue was there, will that can I recognize that revenue? No. Only when that really ad is displayed before the public, you can recognize the revenue. Maybe last year, sir, I don't know how many of you follow that matches, not required now, IPL matches. Last year, what happened is, maybe half of the matches was done, sir. Half of the matches was done. Half of the matches were postponed to somewhere in September or October. Now, sir, usually for IPL matches, 2 or 3 months before, when that schedule was announced, Sir, they'll do 1 or 2 days that bidding. Later on, that schedule will be announced. Once that schedule is announced, immediately various companies will ask for that, maybe Star Sports or whatever TV channel was there. They'll go for advertisement, sir. If it is after power play, or if it within first 6 hours means per second this much, or for 5 seconds this much revenue, or if it is last 5 hours of the match means per second this much. No, sir. If it is just at the time of toss, this much amount. Like that, for the ads communicated at different times, they will charge the revenue. Now the point is, in the last year, when the matches are shifted, half matches are shifted from May to September, now half advertisement revenue, which was already for which advances might have been given, when that revenue should be recognized? Is that half advertisement revenue also in May, or half advertisement revenue should be recognized in September month? September. Logic is very simple. Only when that advertisement is displayed before public, only revenue should be recognized. The same matters even for newspaper also. Let me show you the same through a question. There is one question, sir. Now, this question number 7. Old Era Publication publishes a popular monthly magazine on 15th of every month. The publication sells the advertising space on terms of 90% payable in advance and balance 10% payable within 30 days of the release of the publication. Sir, advance money only 90%, 10% is payable after the release of the publication. Now the space for March 2020 issue of the magazine was sold in Feb. That means at that time only advance 90% might have been paid. Okay, the magazine was published as per schedule on 15th of the month. The amount of 2,70,000 has been received up to 31st March, and 30,000 was received in 10th April, because within 30 days of the release of the magazine it can be paid. Now what is the question is, please tell the accountant as the amount of revenue to be recognized. Tell me for this year how much revenue should be recognized. 2,70,000 entire 3 lakhs? 2,70,000 or 3 lakhs? I think the magazine was published. Hello, the magazine was already published. If the magazine was published, you can recognize the revenue. You need not wait for actual payment. If the ad was displayed for public, it is sufficient, sir. Hence, entire 3 lakh is to be recognized. Suppose in the same question they say date of publication of magazine is in April. Suppose shifted to April, then entire revenue to be recognized in April. It is simply based on when the ad is displayed before the public, the revenue will be recognized. Is that clear, sir? So this is services. Now let me move to the last type of income. What is the last type of income, sir? Hello, everybody, what is the last type of income? Use of enterprise resources by others, that is IRD, interest, royalties and dividend. Sir, royalties means don't think something new. It is for use of intangible assets. So it is for what, sir? Use of intangible assets. Now you may have invented some things for which you will have patent. You may have created something for which, of course, books etc., for which you will have copyrights. Like that, you will have different intangible assets. Now you have created books, sir. Now you will allow others to sell your book or make a copy of that, for which I think you will charge some amount. Now whatever amount you charge, you get is called as royalty. Sir, are you getting the point? For patents or trademarks or copyrights are intangible assets. By using that intangible assets, if you get that revenue, any revenue, that is royalty. Is that clear, sir? By using that invention or by using that copyright, whatever products you are having, if you get any amount, if the others use this intangible asset, and if they pay any amount for that, that is called as royalty. Now the question is, sir, when interest to be recognized as revenue, when dividend should be recognized as revenue, when royalty should be recognized as revenue? Tell me when interest should be recognized as revenue, sir? Hello, when interest should be recognized, sir? When it is earned. Hello, in other words, on time basis. Hello, which basis, sir? Time basis. Suppose I have invested in debentures of one company, sir. Due date is, let us assume, I have purchased on 1st October. Now the due dates of the company is 30th September and 31st March, or else 30th June and 31st December. Now can you please tell me last time when I might have received interest? 31st December. Now by the year ending 31st March, shall I recognize the balance 3 months interest or not? Yes. Months are completed or not? Yes. Due date may be 30th June, but still we will recognize the income for entire 6 months if time is completed, because we are earning it. Maybe it is called as interest accrued but not due. Due will be there on 30th June, but it is already accrued. You can recognize as a income. Is that clear, sir? Interest income will be recognized on time basis, that is based on number of months. Now how do you recognize dividend, sir? When it will be recognized? When the right to receive payment is established. This is the formal wording, sir. When the right to receive payment is established. But when this right will be established? When the dividend is declared. Hello? When the dividend is declared. If the dividend is declared, you will have the right to receive the payment. So then you can recognize the dividend. That is the date when the dividend is declared, sir. Now, when you can recognize the royalty? Royalty means, let us say copyright, sir. Book was there. Now you have given for, let us say you are an author, sir. Author was there, MPV, or otherwise for accounts MPV author was there, let us say. Now he has created a book, sir. Now some publications we have taken it and selling those books. Now how do you give the revenue to that author? How do you give revenue to that author? It may be fixed amount, or it may be percentage per unit, per book this much amount. Hello? Or sometimes fixed amount plus per unit. I think it is done on different basis. So what is the answer? How do we recognize royalty? First of all, tell me, cash base or accrual base? Accrual only. Okay. Then how? I say because of this informal discussion only, standards also use proper wording for this. Royalties has to be recognized in the books of account as per agreement. Over. Hello? How it should be recognized, sir? Royalty as per agreement. However, on accrual basis, not on cash basis. This is what the simple language they use. They say as per agreement. However, not on cash but on accrual basis. To be frankly speaking, interest also accrual basis only, but to show the difference, there we write on time basis. Here we say as per agreement, both are on accrual basis. So this is what the three, sir. Here also, first this should satisfy, sir. The balance two conditions remains the same. Amount should be certain. Collection also should be certain. These things are common. That's all, sir. With this, these aspects also completed. Let me deal with one or two questions and then close this standard. Now, Y Limited uses certain resources of X Limited. In return, X Limited received 10 lakhs and 15 lakhs as what, sir? Interest and royalties. You are required to state on what basis revenue can be recognized. Interest will be recognized on which basis, sir? Time basis. On a time proportion basis, interest will be recognized, taking into account the amount and the rate. Next, how do you recognize that royalty, sir? In accordance with agreement, of course, on accrual basis. In the same question I have given, Y Limited has declared interim dividend which was not received till 31st March but received on 20th April. Shall I recognize this year or next year? This year only, because declaration was already done. Receipt only was done later. It was only interim dividend, not a problem. You can recognize before 31st March. Sir, is that clear, sir? So that is what question number 8. Now let me deal with last question with which we will close. SCL Limited sells agricultural products to its dealers. One of the conditions of sale is that interest is payable at the rate of 2% per month for delayed payments. Percentage of interest recovery is only how much, sir? 10% on such overdue outstanding due to various reasons. During the year ending, company wants to recognize. Very simple, sir. Sometimes what may happen is, we may sell the goods and they have to make the payment. If the payment is delayed, usually we give some normal credit period, sir. 10 days, 2 weeks, like that we give credit period. If after the credit period they pay, suppose we have given credit period as 2 weeks, they are paying after 4 weeks. Now we will pay some, we ask them to pay some interest or not, because we are losing something. So that is what they are telling. If you are making delay, you have to pay at the rate of how much, sir? 2% per month. This is what the instruction they are giving in the invoice. But What is happening really is, suppose a particular party was there, has not paid, he is requesting, sir, from next time onwards I'll pay properly, this time you please excuse me. So like that many customers are requesting, though we are charging interest, how much we are actually recovering? Percentage of interest recovery is only 10%, other 90% giving some good words to you and they are escaping. Hello, in other words, amount is not certain, they are telling, sir, next time I will not do, this is the last time, if next time I will do, please do that. Of course, next time I will do same words, he'll say on the same word. Hello, sir, are you getting the point, sir? So thereby, in such a case, now shall we recognize that interest revenue or not? Can I recognize, sir? Can I recognize? Risks and rewards are transferred or not? Of course, this is interest income, sorry. If it is interest income, first of all, time is completed or not? Yes. Collection is, amount is certain? Yes. Collection? No. So thereby you cannot recognize the revenue. If interest recovery is probable, then you can recover, sir. Here they are telling only 10% people are paying. So thereby you cannot recognize the revenue. Recognize only it is received. When it is received only you can recognize the revenue. Hence the company is advised to recognize interest receivable only on receipt basis. That's all. With this, AS9 is also completed. Sir, is that clear, everybody? Sir, hope you could observe in every standard how many questions we are discussing. Almost the time is less, but still we are discussing at least 60 to 70% of the questions. So listen well, definitely this will be useful. Okay, right. Shall I continue, sir? AS9 completed. So as per the discussion, let me move to AS18. Let me move to the next standard, AS18. What is the name of the standard, sir? Related party disclosures. AS18, related party disclosures. First of all, what is this standard, sir? What is the objective of this standard? This is a disclosure based standard. Simply they say in the question only, what I require from you is only disclosures. Hello, you disclose me. What I should disclose is the point. Now look here carefully, sir. Sir, generally if you are transacting with an outsider, now I think no discussion comes, because usually transactions happen on a arm's length base. Which basis, sir? Arm's length. What is arm's length? Reasonable. Let us say on reasonable basis, reasonable price only, the transaction will happen between what, sir? The company as well as an outsider. Whenever a related party is involved, sometimes the transaction may happen at substantially lower value, or they may show dummy transactions also. Really the transactions may not happen, but still they show as dummy transactions. It may be like this, sir. If the parties are related, now just to show more and more turnover to the departments so that they can claim more and more loans. Actually for loans, bank require more and more turnover. How they can show more and more turnover? They'll take two related parties, sir. A limited, B limited. Now what A limited will do? Of course C limited also will involve. Sometimes A limited will sell to B limited, B limited will sell to C limited, C limited will sell to A limited. Of course both three are related parties. Now everybody will increase their sales, everybody will increase their purchases. Nobody will look after purchases, sir. Logic is profit is not a big point here. Everybody will try to show more and more sales, though they are not having any big business. Business will not be there. Dummy entities. B and C are a dummy, sir. Only one company will be there. They'll be routing the same through different companies to increase more and more sales, to get more and more loans from the banks. Are you getting the point, sir? But these are all cheating the shareholders. So that's why. But anyway, one more point I can say, you cannot expect that every related party is a cheater. Hello? Related party means sometimes this may happen. Now you may sell at a very lower value, or dummy transactions may be there, but you cannot say that related party, dummy only always. Related party, price very lower. So like that we cannot take the assumption. But usually every shareholder will have a doubt, sir. If at all related party is there, something might have happened. Something might have happened. Like that every shareholder will have a doubt. So thereby what standard says? Related party means immediately tell to the shareholders what happened between you. Hello, if there is a related party, tell them the transaction happened. Of course, what is the name of the related party? What is the nature of relationship you are having? And what are the transaction details? Like that you disclose to the shareholders. Then they will have a better clarity. Sir, sometimes transaction may not happen, sir. Related party only, transaction will not happen. Shall I disclose anything to the shareholders? Yes. Sir, I am a holding company. I am having a subsidiary. Now what I will do, let us say some other competitors are there. Competitors came to me and said, no, if you stop your company from doing some trading in my areas, I'll give you some good revenue. Now what I will do, I will not do any sales, sir. Just because I will be having majority, I may be having 55% or something, I'll instruct, I should stop operations in so and so areas. Now, if I say like that, the other party will be benefited. Don't think, sir, you are only losing. No, you are only having 55. Other 45% shareholders are there who are losing because of your decision. Sir, are you getting the point? If sometime because of relations alone, your activities may be changed, sir. There need not be a transaction. I am holding your subsidiary. My decisions itself will influence you. There need not be transactions between me and you. Are you getting the point, sir? That's why what standard says is, if you are having related party, give the list of related parties and tell me what transaction happened between you. Like that, both they require, sir. It is not just only if transactions occurred, even if transaction doesn't occur also, if you are just a related party, sufficient. Tell me what is your name, how you are related, what is the transactions which happened. Like that, the disclosures we are going to do. That is the main aim of this chapter called related party disclosures. Shall I continue, sir? I've given you the main objective, what we are going to do in this chapter, either the relationship or transaction details, depending on the scenario, we are going to disclose. Okay, sir. Now, sir, you are telling related party. When do you say we are a related party? Usually, if you have control, hello, what is that? If you have control or significant influence over other party, if one party is having control or significant influence over other party at any point of time, it is not required that throughout the year you should have control or throughout the year you should have significant influence. If you are having control or significant influence at any point of the time, in other words, if you are a related party at any point of the time, it is sufficient for this chapter. So if you are having control or significant influence, you are related party, and that relation need not exist throughout the year. Even if that relation exists at any particular point of time, it is sufficient. Then disclosures are required. Okay, sir, what do you mean by control? When do you say one party is having control over other party? Usually it is voting power. Hello, what is that? Through voting power, or if you are having a control over composition of board of directors. Similarly, significant influence will generally, if it is greater than 50, we say control. If it is 20%, hello, generally, if it is 20%, we say significant influence. Is that clear, sir? At least 20% if you are having significant influence is said to be there. If you are having greater than 50%, we say control is said to be there. Anyway, though you are having control or significant influence, you may be related party, but standard has given the list of relations which you should consider for disclosure purpose. Standard has clearly given 5 relations. How many relations, sir? 5. If any of these 5 relations are covered, immediately AS18 will be applicable and you have to disclose. Is that clear, sir? Now, this is the most important part of the standard, sir. Just if you remember those 5 relations, standard over, sir. Main part of the standard focuses on only those 5 relations. What are those 5 relations, sir? I'll tell you those 5 relations which are given in AS18. Totally 5 relations are there, sir. The first relation is, suppose, first understand you are an entity, sir. Hello, you are a company, E Limited. Now observe carefully. Sir, entities which are controlled, hello, which are what, sir? Controlled or which are being controlled or which are under common control with the reporting enterprise, they are the first relation, sir. By or with reporting entity, they are said to be related parties, sir. Reporting entity means our company, sir, A Limited. Reporting entity means the entity for which we are doing reporting. We are giving the reports, that is nothing but A Limited. For A Limited, as per point 1, what are related parties? Which are controlled by reporting entity means our subsidiaries. Hello, what is that? Our subsidiaries. If we are having any subsidiaries, let us say C Limited or D Limited, that subsidiary said to be is what, sir? Related party. Not just subsidiary, being controlled, which is under control. So one we can say controlled by subsidiary, or which is being controlled by another party, sir. Either we are controlling or we are being controlled by another party. If we are being controlled by another party, our reporting enterprise being controlled, that means there is a holding company. Hello, what is that? Holding company. If there is a holding company, for us that holding company is also related. No, sir. We are there under common control. Hello, we are there under what, sir? Common control. That means, let us say B Limited is there, E Limited is there. All these are subsidiaries of holding company. Now B and E also related. Sir, please understand, our holding company will be related to us. Our subsidiaries will be related to us. Our fellow subsidiaries also related. In simple, in short, I can write holding, subsidiaries and fellow subsidiaries. These three are the relations given in the first point. Holding, subsidiary and fellow subsidiaries. For our entity, if there is any holding company, related. If there is any subsidiary, related. If there is any fellow subsidiary, related. Holding, subsidiary, this is fellow subsidiary. Okay, this is the first relation, sir. Next, second relation, sir. It is simply, I can say, investor and associate and comma venturer and joint venture. So these are the related parties. Please observe carefully. What are that? Investor and associate. What is an associate? Usually, if you are having that significant influence, we'll call them as a associate. If you are having the 20%, we'll call them as a. At one point, you should remember, sir, here. Let us say B Limited is having in C Limited another 30%. Now tell me, B Limited and C Limited related? Yes. Now A Limited and C Limited related? No. Because when I say significant influence, sir, indirectly it is possible, but indirect in the sense they'll use the word, sir, either directly or indirect. You can have a direct control or indirect control. You can have a direct significant influence or indirect. The word indirectly means in the same scenario, A Limited is having 60% in B Limited, sir. B Limited is having 30% in C Limited. Now A Limited, B Limited related? Yes, due to first point. It is a holding and subsidiary. B Limited, C Limited related? Yes, due to second point. Now A Limited and C Limited related? Yes. Now here indirect significant influence was there. Indirect is just like an associate. Sir, are you getting the point, sir? Because if we are able to take 60% decisions, if you are having 60% voting power in B, every decision of B will be taken by A. So automatically, indirectly, we are having 30% in C. That is what the sense, sir. Though you are having greater than 50, each and every decision of B Limited will be taken by A only. Hence indirectly they are having 30%. So here they are related parties. In fact, this word is used as, this is used like this, sir. Associate of an associate. Something I am telling. Associate of an associate is not a related party. This is what happened here, sir. Associate of an associate is what, sir? Not a related party. The next, subsidiary of a subsidiary is a related party. Because this is indirect control, sir. Hello, what is this? Indirect control. Because I have said control is required. When I say subsidiary of a subsidiary, through subsidiary anything can happen, sir. Through subsidiary you can have control. Through subsidiary you can have significant influence also. So thereby intermediary should be subsidiary. That is what important. If A limited is having 60% in B and B limited is having 55% in C, now A and C also will become related, sir. This is indirect control. This is indirect significant influence. This is not indirect, because through associate you cannot do anything. Only through subsidiary you can have a control or significant influence. Sir, have you understood these points, sir? So this is what important. Now similarly, let me talk like this, sir. Please observe carefully. A limited is there. It is having 25% in B. It is having 30% in C. B and C related, Sir, B and C related, not related, because they are here. They have said common control. We have not said common significant influence. Hello, there we have said only common control. So thereby we can give one more conclusion, sir. Co-associates are not related. Hello, what is that? Co-associates are not related. B limited and C are not related. Whereas co-subsidiaries are related, sir. Co-subsidiaries are related. That means A limited is there. It is having 60% in B. It is having 70% in C. Now B and C related, yes. This is common control. Common control concept is there, sir. But common significant influence is not there. Similarly, indirect control and significant is there, but indirect means only through subsidiary. So thereby associate of an associate is not a related party, whereas subsidiary of an associate is a related party. Co-associates are not related parties, but co-subsidiaries are related. So these are some interpretations which are required from point number 2, the two party A. Now let me move to venturer and joint venture. Now I think generally you know what is a joint venture, sir. If single person cannot do an activity, two or more will come together for completing that purpose. Once that purpose is over, they will withdraw that organization. That is what joint venture. Now let us say, when I say venturer, it may be an individual, it may be a company also, sir. Now A limited and B limited together formed a joint venture named C limited. Now A limited and C limited related, yes. B limited and C limited related, yes. Because venturer will always have an impact on the joint venture. Now A limited and B limited related, no. Because never we have said both of them are having control or significant influence over other. In other words, co-venturers are not related. Something I have given, sir. What I have given? Co-venturers are not related. Sir, co-venturers are not related. So venturer and joint ventures are related. A limited and B limited are venturers, sir. In other words, they are participants. A participant may have an influence, but one participant cannot have an influence on other, because they just have common decision making only for the purpose of the joint venture and not in any other scenario. That's why they are not having control or significant influence over each other. So we say co-venturers are not related, whereas venturer and joint venture are related. So this is what explanation of point number 2. Sir, is this clear? 1 and 2 very, very important for examination, sir. Now, let me proceed to the third one, sir. Third one, individuals having control or significant influence over the entity. Not only individuals, sir, and their relatives. This is also covered. Sir, individuals having control or significant influence over the entity. Control or significant influence, you means you already know, sir. Mr. A is having 30% in B limited. Significant influence is there. Mr. A is having 60% in A limited. Control is there. So, an individual or a an individual may have control or significant influence. Sir, is that clear, sir? Now those will be covered, and not just that, their relatives also will be covered. Now what do you mean by relative here, sir? You are telling relative. No, if I am the individual, my father and mother are considered as relatives. Similarly, my son and daughter will be considered as relatives. Similarly, spouse will be considered as relative. Similarly, sister or brother will be considered as relative. Just everywhere one relation here and there, sir. Only one. One upper, one lower. Of course, parallel also. Parallel in the sense, sir, our brothers and sisters are same generation, sir. Our generation, upper generation, lower generation. What is there? Our generation in the sense either spouse or brother or sisters. They are all one generation people. Okay, right. Now, but I usually tell one thing, sir. Brother-in-law is one such relation which is exploited by many people. Brother-in-law is one such relation which is exploited, which is taken as a loophole. Because brother-in-law in the sense, in the real world, we have some belief over him, sir. Our sister's brother or somebody, that brother-in-law, definitely we have some good relations only, sir. So we feel a good only, but still in the law, nowhere brother-in-law will be considered as relative. If I do something with brother-in-law, that will not be considered as related party, nowhere disclosures are required. Hello. Brother-in-law is nowhere a relative. So that is, sir, that is what used as a loophole by many. But anyway, I am just making you cautious because you are an auditor. You have to check all these things. They may do frauds like this, but you have to be ready and check all those aspects. That will be used as a loophole, sir. In the law, nowhere they have mentioned, particularly for our standard, nowhere they have mentioned brother-in-law as a relative. Okay, anyway, leave it, sir. Now, for standard, father, mother, son, daughter, spouse, son or brother. Okay, sorry, sister or brother. Okay, right. Now let us continue. This is the third one, sir. Fourth one, KMP and their relatives, sir. KMP and their relatives. KMP in the sense key managerial personnel. Key managerial persons. Usually, sir, actually there is a big definition for KMP in CA final. In law, there will be one chapter itself for KMP, sir, where discussion of almost 20 to 30 hours will happen relating to KMP. Now, we will not require all those things. Simply, KMP means anyway, you will do, that's a choice. Okay. KMP means a person who is having authority and responsibility for planning, directing and controlling. Sir, he should be in a planning position. He only should direct everybody. He only should control whether they are working properly or not. If these three are there, they can be said to be a KMP, sir. Usually the bigger authorities will have like this. Maybe generally we can say manager or MD or any whole-time directors. Usually they have all these positions. They will only do the planning. They will only direct everybody to in this way. Then similarly they will only control whether they are working properly or not. If these three are available, you can call them as KMP. Usually that managers, whole-time managing directors, CEO, these people are usually considered as key managerial personnel. And not just that, their relatives also. What is relative? Same, upper, lower and parallel. Hello? Sir, is that clear, sir? Now, so with this fourth one also completed, let me move to the fifth one. Sir, please remember these words. I think in one of the latest RTP, somewhere they have given, he is having planning and directing, but he cannot control. Is he a KMP or not, like that they have asked. Hello? So please remember. So thereby, all the three are important. If one of the thing is missed also, we will not call him as a KMP. Planning should be there. Directing, he should only directing, he should only be controlling. If all the three are there, only KMP. Okay, right. Next. Last one, enterprises in which 3 or 4 have control significance. 3 or 4 have control or significant influence. Who is 3 or 4? Above individuals. So sometimes individuals directly will not do anything. Through their entities, they will do a lot of things. That's why this point was introduced. You may have significant influence or other party. Now, you may not be having a direct control over an entity, but you will be having significant influence. That entity and the other entity in which you are having control, these two entities will be doing some manipulations, sir. That's why just individual is not considered. Entity, if he is having any control or significant influence on any entity, when I say individual here, everybody will be covered. KMP or individual having significant influence or their relatives, all these three. Now, if they are having control or significant influence over any entity, now that entity also will be considered as related to us. Are you getting the point, sir? Let me take an example. Let us say I am A Limited, sir. Now, for me, Mr. B is MD. Now, Mr. B is having 40% in, let us say, C Limited. Now, A Limited and C Limited related. Yes. That is what I am telling. B and A are anyway related through point number 4, KMP. Now, A Limited and C Limited related through point number 5. For A Limited, it is the entity in which the KMP is having significant influence. So, thereby it is considered. Is that clear? So, in this way, totally how many relations are there? 5 relations are there. Any of these 5, they are said to be a related party. But they have given clearly some 3 exclusions, sir, from these principles. Not exclusions, they have given something called as not deemed to be related parties. Some scenarios, they are not usually deemed to be related parties. They may have control or significant influence, but usually not deemed to be related parties. Because we have said, though you have control or significant influence, in this way only you should have. These 5 ways only you should have. Even if you are having control or significant influence, unless you are able to prove it, now we cannot call you as a related parties. I'll tell you some scenarios. Just by looking at that scenarios, you cannot call them as related parties. If they have any of the 5 relations I have discussed, then you can call them as a related parties. What is that, sir? Let us say 2 companies having a common director. So just there are 2 companies which are having a common director. Now, are they related parties, sir? The answer is straight away no, sir. A person can be there as director in 5 or more companies, sir. Any company, in number of companies, he can be there as a director. Now, you cannot say all these companies are related parties. But sometimes it may be possible that this director may have influence on this company and another company. Then we should say those 2 might be related. Just because a director is common, we should not call them as related. But if they are able to show any of the 5 relations, if really any of the 5 relations are exhibited, then definitely we have to call them as a related. What we are telling is, generally they are not deemed, that's all. They are not related parties generally, but if they exhibit those relationships, we'll call them as a related party. This is one thing, sir. The next, a single supplier or customer or franchise, etc. Sir, sometimes we may have a single supplier, we may have a single customer. If we are having a single supplier, we'll have a good trading relations. Sometimes whatever decision he takes, we will follow. Sometimes whatever we say, they will follow. Are you getting the point, sir? Then can we say control is there, or at least significant influence is there? Yes, maybe generally. But if I speak as per this standard, are you having any of these 5 relations? No. Sir, what we say is, just having normal is not sufficient. Generally, logically speaking, single supplier means they may influence your decision, but that is because of trading relations. I cannot call you as a related party for that reason. Because if I call you as a related party, whatever I do transaction with you, everything I have to disclose detailedly. That becomes very, very difficult. That's why usually single supplier or any dependent parties are there, that we don't call them as related. But if they exhibit any of the 5 relations, then we'll call them as a related party. Okay, right. One third point is providers of finance, trade unions, or any public utilities, etc. So generally, if bank has provided you loan, if you are not repaying it, generally they will take some good decisions. You are not allowed to take whatever decision you want. That means they will have some control over you. Am I right or not? For that reason, we cannot say AS 18 is applicable. If they are bank providing finance, they may have control, but we will not say AS 18 is applicable. But if you are having suppose 40% in that bank, and if you have taken a loan, can I say they are related? Yes. So hope you are understanding. Generally they are not deemed to be related parties, sir, but if they exhibit any of these relationships, once again they are considered to be related. So this is also one important point, sir. Now with one last point we'll close this standard, sir. Of course we'll deal with one or two questions, but later. First, now let me close with one last aspect, disclosure requirements. What are to be disclosed? First we should know 5 relations, then we should know what are not deemed to be related parties. Now the last aspect is disclosure requirements. For that, let me show you a chart, sir. In the material I have done it well already. Just wait, sir. Okay. Please observe this chart, sir. A simple chart to make you understand. Disclosure requirements. Sir, first of all, when disclosure requirements will start in 2 scenarios, either when you have control or when you have significant influence. Sir, suppose you are having significant influence. Hello, what is that? Significant influence. That means you are having 30%. Now, point is, first of all, have you entered into any transaction with that company? Because transaction details itself are main. Am I right or not? Now, what they say is, suppose, let me take the example also and show you, sir. You have acquired 30%. A Limited acquired 30% in B Limited on 1/7/2021. That means first 3 months relation is there, not there. Only relationship is there for 9 months, that is from 1/7. Suppose a transaction is entered in this 9 months, a transaction entered in this 3 months also, because sir, only if associate the transaction should happen. No, even if it's not an associate also transaction may happen. Now tell me about which transaction details should be mentioned. Both or only that happened in the 9 months? That happened in 9 months, because during this time you cannot manipulate, sir, because you are not having any significant influence. Hope you are getting the point, sir. Now let me show you, sir. Whenever significant influence is there, first of all, if transaction has not occurred, no need to disclose anything. Is that clear? Transaction occurred, sir. Then there comes a question, is it during the period of relationship? That means when you are having significant influence, the transaction entered. Or when you are not having that significant influence, transaction is entered. If you are not having, that means either before your relationship or after, because it may happen like this. You may sell your 30% on 1st Feb 2022. Now in that case, in the last 1 month are you having, or last 2 months are you having the relation? No. Suppose in that period transaction occurred, should we disclose separately? No. What we are telling is, during the period of relationship, hello, what is that? During the period of relationship, if transaction is entered, then only detailed requirements are required. Otherwise, no need to disclose anything. But this is applicable only for significant influence, sir. In the case of control, I have said you at the beginning of the chapter, I am holding, you are subsidiary. No transaction is entered, but still possibility is there that I can manipulate and make you do something. Am I right or not? I may stop you to do trading in particular area. I may ask you to increase the price. I may ask you to decrease the price, which will affect the others. So if you are having control over other person, then it doesn't matter whether transaction occurred or not occurred. At least if transaction not occurred, tell you who are you, what is the relation with the company. If transaction occurred, then give the transaction details. Something I have said, sir, during the period of relationship, if transaction occurred, same logic, you have to disclose everything. What everything? I'll tell you, sir. Suppose no transaction occurred or transaction occurred but not during the relationship period. That means I am having 60% for 6 months in the year. Then remaining 6 months, if transaction is entered, still I cannot do big manipulations. But at least what standard says is just to disclose 2 aspects. If you are having control, one is name, the other is nature of the relationship. If the transaction occurred during the period of relationship, whether control or significant influence, detailed requirements are there. What are the detailed disclosures? Name, nature of relationship, nature of transactions, volume of transactions, any other elements you want to explain for better understanding, and any reversals which happen or any provision for doubtful debts etc. created. Like that, some 7 items will be there, sir. These 7 items you have to disclose if the transaction occurred during the period of relationship. If the transaction has not occurred during the period of relationship, then what we should do, sir? If control, just do 2 things, name and nature of relationship. Significant influence, nothing. Is that clear, sir? So these are the disclosure requirements. Shall I take 5 minutes, sir? So within 5 minutes, we'll deal with some good 3 or 4 questions and then close this AS 18. Now, look at this question number 1, sir. A Limited, 5 minutes, sir. Let me complete it. A Limited holds 51% of B Limited, sir. Try to always frame a diagram. It will be so simple for you. A Limited, B Limited. Now, B Limited holds how much, sir? 51% of O. Now Z holds 49% of O. It is not O is holding somebody. Now Z holds 51. Now I will write the percentages. 51, 51. So this is 49. A and B related, ah? Yes, control is there. First point, holding and subsidiary. B and O related, ah? Yes. Now A and O related, ah? Indirect control is there. Okay. A and Z related, ah? A and Z. No control or significant influence. Now because if O Limited is having in Z this 49%, then control is there. Here O Limited is not having in Z, Z is having in O. So thereby A cannot influence Z, even B also cannot influence Z. Sir, is that clear, sir? So for Z, who is related? Only O. For A, B and O. For B, A and O. For Z, only O. So these are the related parties. Sir, is that clear, sir? So like that, we'll discuss the related parties. Of course, for O, if you ask me, everybody is related. For O, everybody will be related. So you have to mention whether subsidiary or holding or something and tell what are all the related parties. Let me take some good questions, sir. Now, look into this question, sir. SP Hotels Limited enters into an agreement with Mr. A for running its hotel for a fixed return payable to the later every year. Sir, I have given my hotel for you to manage it, sir. Okay, the contract involves day-to-day management of the hotel while all financial and operating policies are taken by the board of directors. Sir, generally, if you are having power to participate, significant influence is said to be there. Generally, power to participate will be gained through 20% shareholding. Sometimes without 20% also through agreement, if they say you are only having the power to participate in the financial or operating policies, then you are also said to have significant influence. Here, that person is only management, day-to-day management. He is also not having financial and operating policy because that is being there with board of directors. And Mr. A does not own any voting power in SP. Voting power is not there and he is not having financial and operating policy, policy decision making. Is he said to have control or significant influence? No, he is nothing, sir. Now, what principles you apply there is important. He is not considered related. You have to say. So, individuals related, what point we are having, sir? Either control or significant influence, point number 3 or point number 4. Apply both the points and tell them both are not applicable here. That's why they are not related. So, like that, this question is asked, sir. Important question. Then, question number 6, very, very important. Narmada Limited sold goods for 90 lakhs to Ganga Limited during the financial year end 31st March 2017. The managing director of Narmada owned 100% of Ganga. Okay, the sales were made to Ganga at the normal prices only. Narmada and Ganga, are they related, sir? I could observe. This is Narmada. This is Ganga. Okay, the managing director of Narmada, he is MD, sir. He owns 100% of Ganga. Narmada and Ganga, are they related, sir? Yes, because these two are related because of point number 4, because he is MD. Now these two are related because of point number 3, because he is having directly control. Now these two are related because of point number 5. Enterprises in which KMP or individuals are having significant influence. If I say for N, my KMP is having significant influence over G, control over G, that's why N and G are related. Sir, have you all understood, sir? One of the important questions. Okay. So let me discuss this last question, question number 8, with which we'll close, sir. Okay. Goods sold amounting to 50 lakhs to associate company during the first quarter ended on 30th June, sir. Okay. When the relationship ended, sir? 30th June. After that, related party relationship ceased to exist. However, goods were supplied as supplied to other ordinary customer. Discuss whether entire transaction has to be disclosed. First of all, which type of relationship? Through control or significant influence? Significant influence. How many months? 3 months. So now tell me what transactions details are required, sir? Only for those 3 months. After that, even if transaction happen, we will not disclose anything. Nothing is required. Only during the 3 months, everything we have to disclose, all the 7 details. Is that clear, sir? Next, second point, Ram held 70% of share capital of Lakshman. During the year, Ram sold 60% of shareholding in Lakshman. There were transactions between Ram and Lakshman before and after. Now what we will do, sir? Only during the period we have to disclose everything. Other than that period, because he is having control, name and nature should be disclosed, because control whenever is there during the period of transactions, everything. The other period, nature and name, those two should be disclosed. Last one, Ram Limited exercised significant influence in the operating decision of Lakshman during a certain financial year. No transactions happened at all. Disclosure required. Significant influence was there, but no transaction. Nothing needs to be disclosed. Significant influence means only during the transaction period disclosure is required. Control means during the transaction period full, other period only name and nature. That's all, sir. With this, some good questions we can cover. Of course, other aspects also looks very simple, because in my discussion I have given examples, sir. Through examples only I have discussed. That will be definitely sufficient for you to write or solve the questions. With this, we are closing AS 18. So totally how many standards are completed? 5. We'll complete the balance 7 in the evening. Don't worry, sir. AS 24 is a shorter standard which takes only 15 to 20 minutes. No big discussion required. So thereby, definitely we'll try to complete all the standards. That's all for now. We'll continue in the afternoon session. Hope you are enjoying. I know difficult for you to listen for this many hours, but still many aspects we are covering. Okay, sir. Thank you.
ఆఫ్టర్నూన్ వచ్చేవాళ్ళు టోకెన్ తీసుకెళ్ళండి. ఆఫ్టర్నూన్ వచ్చేవాళ్ళు టోకెన్ తీసుకెళ్ళండి. బాయ్స్ రండి బాబు, బాయ్స్ రావాలి. బాయ్స్
Good afternoon, everybody. Sit down. Everybody, shall we proceed? Okay, totally how many standards we are going to discuss? 12. In that, how many completed? 5 are over. Still 7 standards are left. What are the 5 standards completed? 4, 5, 7, 9, 18. So these are the 5 standards completed. Now let me start with one big standard, AS 19 first. Then we'll complete that AS 20 also, don't worry. Always big standard has to be started at the beginning. Then only the other 2 can be completed quickly. So let me start with AS 19, sir. Then we'll proceed to 20, then 26, 29. And in the last session, another 3 standards, 17, 24 and 22 with a good focus on AS 22. Okay. First, let me start with AS 19. Okay. Sir, what is the name of the standard AS 19? Smallest in terms of name. Okay, right. Biggest in terms of size. Okay. Now look here carefully. In AS 19 leases, mainly 3 aspects we are going to learn for examination purpose, sir. So what are the 3 aspects, sir? First one, classification of lease. Hello, what is that, sir? Mainly 3 aspects only we are going to learn. First one is classification of lease. Second one, accounting treatment for the types of lease, that is finance lease as well as operating lease. The 2 both in the books of lessor as well as lessee. The same in the case of operating lease also. We have to learn accounting treatment for operating lease in the books of lessor as well as lessee. In the last concept we will discuss is sale and leaseback. These are the 3 prima facie issues which we are going to learn in this standard. First one is classification of lease, next accounting treatment, and then third one is sale and leaseback. First let me start with classification of lease. Sir, leases are divided into 2 types. How many types, sir? 2 types. So what are the 2 types of leases, sir? One is finance lease, the other one is operating lease. Hello, what are the 2 types of leases? One is finance lease, the other one is operating lease. Okay. When do we call a lease as a finance lease? When do we call a lease as a operating lease? Sir, finance lease is a lease where substantial risks and rewards are transferred. And operating lease is a lease where substantial risks and rewards are not transferred. Sir, we simply say finance lease is a lease where substantial risks and rewards are transferred, whereas operating lease is a lease where substantial risks and rewards are not transferred. But that is not sufficient for classification, sir. ICAI in the standard they have given 5 indicators, sir. So if any of these 5 indicators are there, we'll call it as a finance lease. If none of these 5 indicators are there, then we will call it as a operating lease. No big discussions, or only 5 indicators given by the ICAI. So we look after those 5 indicators. If any of the 5 indicators are there, we will call it as finance, otherwise operating. So what are those 5 indicators, sir? First one, automatic transfer of ownership. Hello, what is that, sir? Automatic transfer of ownership at the end of the lease period, sir, usual. Now, this you might have heard in the time of hire purchase. Sir, generally, in the case of hire purchase, what will happen, sir? Ownership will be transferred on payment of last installment. Am I right or not? Ownership will be transferred on payment of last installment. Now, during the period of hire purchase, who is using the asset? Hire purchaser. On the payment of last installment, who gets the ownership? Hire purchaser. From then onwards, who will use the asset? Hire purchaser. That means most of the benefits and the risks, everything are borne by hire purchaser. So thereby, asset should not be recorded by lessor. It should be recorded by lessee. That's why we say it's a finance lease. Substantial risks and rewards are transferred. That is the first one, sir. Second one, it provides an option to purchase at a substantially lower value. When I say lower, it is lower than fair value, sir. Substantially lower value. When I say lower value, it is lower than fair value. Sir, let us say I have taken an asset having 10 years life for almost 6 years, sir. I have taken on lease for 6 years or 7 years. Now what I have said is, after 7 years, sir, I'm giving you option, or the lessor is telling like this, I'm giving you option. At that time, usually market price or fair value of the asset might be 3 lakhs, but I'll give you only for 1,50,000. Market price might be 3 lakhs, fair value might be 3 lakhs, but I'll give you only for 1,50,000. If you are interested, you can exercise that option. I'm giving you only a option at the end of the lease period, 7 years. If you want, you can take it at just 1.5 lakhs. You may think, why lessor is giving that option, sir? That it's not so easy to find any other lessee or any other buyer for an asset which is used for 7 years. Hello? It's not so easy to find a lessee or a buyer for an asset which is used for 7 years. Though worth may be 3 lakhs, but we cannot find anybody, sir. We'll miss some value on it in the due course. So thereby usually we give that option to the lessee only to take it at some good lower value. If at all that option was given, and if we feel that it is probable that option will be exercised, when we feel it will be exercised, if the value is very, very lower, usually the other party will exercise. Then we feel that definitely risks and rewards are transferred. Why, sir? Till that period, who is having the asset? Lessee. After that period, because we are feeling he will exercise, who will have the asset? Lessee. Entire life, who is having the asset? Lessee. That's why risks and rewards are already transferred. Is that clear, sir? That is the second indicator. Now, third indicators covers major part of the life. Hello, what is that? If the asset you have taken, the contract period, if it covers major part of the life, in other words, life is 10 years, if I takes for 6 years, is it covering major part or not? Yes. That's why when definition is there, they say substantial risks and rewards are transferred. What they say? Now out of 10, 6 years who is using the asset? Lessee. Who is getting the benefits from that asset? Lessee. If suppose that asset doesn't give proper production units, who will bear that loss? Lessee. So thereby risks and rewards majority for 6 years are borne by lessee. So thereby once again it becomes a finance lease. It is a lease where substantial risks and rewards are transferred. So even if it covers major part of the life also, it is an indicator of finance lease. Then another one, major portion of the value, sir. Major part of not life, it is value. Now when I say major part of value, what, sir? Lease payments should cover. Hello, what should cover? Lease payments. If your lease payments is covering major part of the fair value of the asset. Sir, fair value of the asset is 10 lakhs, sir. I am giving you on lease basis for 5 years, but within 5 years, I am collecting 7 lakhs from you. Sir, the asset life is 10 years. I am giving you on lease basis for 5 years. Within 5 years, I am collecting how much, sir? 7 lakhs from you. Now that means I am covering most of the amount from you only. I am recovering most of the amount from the lessee. When lessee will accept for this? Only if he is using to that extent. When lessee will accept to pay 7 lakhs, sir, only if he is going to use to that extent. Am I right or not? That means substantially who is using the asset? Once again, lessee. That's why this is also called as finance lease. So hope it is clear. The last one, sir. If the leased asset is of specialized nature. This is the last one. If the leased asset is of specialized nature. Specialized nature in the sense customized nature, sir. It is customized. Sometimes, sir, our lessee will ask us to manufacture specifically for that person. But because he is not money, he is not having money, he will take on a lease basis. Now tell me one thing. Suppose this period is completed, will we sell to any other person, sir? Is that possible? No, because this is customized and specialized. In such a case, usually we will try to recover full amount from the lessee only. So generally it will be used by what, sir? Lessee. So thereby here also substantial risks and rewards are transferred. So totally how many indicators, sir? 5. Any of these 5 satisfied, we call it as a finance lease. Even if only if none of the indicators are satisfied, then only we call it as a operating lease. Let me deal with one question quickly based on this, sir. You will have a clarity. CRD 1, sir. Quickly. Classify the following into either operating lease or finance lease with reason. Economic life of the asset is 10 years. Lease term is 9 years. Now tell me which lease, sir? Finance or economic? Sorry, finance lease or operating lease? Finance lease. And tell me which because of which of the indicators? First or second or third or fourth or fifth? Because of third indicator covering major part. Now second one, lessee has an option to purchase the asset at lower than fair value. Finance or operating? Finance. Which indicator? Second indicator. Lease payments should be recognized as expense in the statement of P&L. This is operating because nowhere we have discussed about this indicator, and usually we are telling for lessee it's an asset, sir, if it is a finance lease. For if it is an operating lease, it will not be recorded as an asset in the books of lessee. It will be considered as asset in the books of lessor. So thereby this scenario will be for operating lease. Next, present value of MLP is equal to X and fair value of the asset is Y. What I have said, sir, the present value of the lease payment should be at least covering majority of the value of the fair value. That telling X equal to Y. That means which indicator? Fourth indicator covering value. So thereby once again finance lease. Life of the asset is 5, lease term is 2, but the asset is special nature. Now tell me once again finance lease because of fifth indicator. Discussion clear? So this is what the first one, sir. Classification of lease. Now before proceeding to the accounting treatment, let me give you one clarity. We should have clear knowledge about what is MLP. Hello, what is that, sir? MLP. Minimum lease payments. Sir, MLP consists of ALP plus GRV. Hello, what is that? ALP plus GRV. ALP means annual lease payments, sir. Regularly, whatever lease payments were paid, that is called lease rentals are paid, that is annual lease payments. Now, what is GRV, sir? Guaranteed residual value. Sir, let us say the life of the asset is 10 years and we have given for on lease basis for 7 years. Suppose 5 years is completed or 6 years is completed. You are there in the 7th year and you are lessee. Now tell me, you know after 1 year period is going to be completed. And if you are aware of this point and you know the lease rentals we pay also fixed. How you will use the asset in the last year? Hello. Now when you know that the life of the asset is 10 years and you are there in the 7th year and you know very clearly after 1 year asset is not going to be with us. Now how you will use the asset, sir? Optimum. I think you will use for 24 hours a day. Previously if you are using 8 hours, now you will use for 24 hours a day, because after this 1 year asset will not be there and anyway lease rentals will be same for us. So usually we try to exhaust full value of the asset. Am I right or not? I don't think that lessee is only always talented or jadoo. Lessor also will behave like this. He will think all these aspects, sir. What he says, sir, after 7 years, suppose the asset value is 10 lakhs, you are expected to use 70%. After 7 years, asset should give me a value of 7 lakhs. In other words, you should asset should give me a value of 3 lakhs. You should guarantee me 3 lakhs. What do you mean by guaranteeing? Suppose after 7 years, if I want to sell the asset, if sale value is only 2 lakhs, he has to compensate balance 1 lakh. Suppose sale value is only 1 lakh, he has to compensate balance 2 lakhs. Why, sir? Because we feel because of your usage only today value is less. I have already said you after this many years this should be the value. Like that, lessee has to give the guarantee for the residual value. Usually, sir, this will be exercised only when the asset doesn't give proper value, because 3 lakhs is the guaranteed at the time of at the end of that lease period. If it is giving 2 lakhs, then he has to compensate 1 lakh. If it is giving 1 lakh, he has to compensate 2 lakhs. If it is giving 0, he has to compensate 3 lakhs. Is that clear, sir? But let me tell you one assumption taken by AS 19, sir. AS 19 take one assumption that lessee, all lessees are talented lessees only. As a result, all lessees will use 100% value of the asset. As a result, whatever GRV is there, entire amount is expected to be compensated by the lessee. Are you getting the point, sir? Standard assumes that each and every lessee is a talented lessee. He'll use 100% of the asset. As a result, entire value, whatever guaranteed, has to be paid by lessee, because we feel that share value is going to be 0, because 100% use is going to be done by lessee. The discussion clear? Okay. So in this way, MLP will be there, sir. One is annual lease payments, the other one is GRV. Okay, right. Guaranteed residual value. With this terminology, now we are ready to go for accounting treatment. First, we are going to look after accounting treatment for finance lease, that too in the books of lessee. Then later on, we'll see in the books of lessor. First, sir, what is the entry that we write at the inception of the lease? Hello, what is that? At the inception of the lease, tell me. Now you should record the asset or not? Yes, you are lessee, sir, finance lease. You are only going to get the asset because substantial risks and rewards are transferred. Entry will be asset account debtor to lessor, or you can also write lease payable. Sir, is that clear, sir? At the inception of the lease, we have to record the asset. If we are making payment, we will write to bank. As we are not making the payment, we will write to lessor or lease payable. Okay, sir, these at the inception of the lease. Then every year later on, what he will do, sir? What are all the transactions which will be there, sir? Please tell me. So first, depreciation may be there because we are having the asset. Then interest may be there because in whatever lease payments we make, just like hire purchase, both installment, both principal portion will be there, interest portion will be there. We have to segregate interest portion and we have to book it as a expense. Similarly, installment payment. So these are the 3 transactions which will happen later on, sir. In the first year 0 at the inception, asset to lessor or lease payable. Later on, every year we have to record entries for depreciation, interest and installment. Entries for depreciation will be depreciation to asset, P&L to depreciation. Entries for interest will be interest to lessor, lessor to bank. Hello, payment for installment will be already due was made, sir. Now we'll simply pass the entry lessor account debtor to bank. Sir, is that clear, sir? At the inception, we'll simply write asset to lessor. Later on, every year, we'll pass the entries for depreciation, interest and installment. So this is what will happen in the books of lessee. Hello, in the books of lessee. Now if I talk at the same time in the books of lessor, hello, the entries in the books of lessor at the inception of the lease, what entries will be passed, sir? Hello, what entries will be passed? Lessee or lease payable to asset, because asset has to be removed from his books, sir. Asset has to be removed from his books and has to be incorporated in lessee's books. So thereby it will be removed from lessor's book, lessee to asset, or you can also write lease receivable to asset. Later on every year, what transactions will be there, sir? Do you think depreciation will be there? No, because it is being recorded by lessee. So thereby interest will be there, installment will be there. For interest, what will be the entry, sir? Sir, it's an income for us. So lessee account debtor to interest. For installment, what will be the entry? We are going to receive the amount bank account debtor to lessee. The discussion clear? A very simple accounting, sir. So in the books of lessee and lessor, in the books of lessee at the inception, asset account debtor to lessor or lease payable. Then every year we have to record entries for depreciation, interest and installment. Now in the books of lessor, at the inception, lessee to asset, every year we have to record interest entries for interest as well as installment. Sir, accounting treatment clear? The complexity of AS 19 doesn't lie in journal entries, sir. It lie only in the amount. At what value you should record these entries. In fact, these entries are simple only. Inception entry only we have to be careful. Which entry, sir? Inception. At the time of inception, at what value we have to record. If we know that, accounting treatment over, sir, for finance list. What is that value, sir? If I talk about lessee, we are writing asset account debtor to lessor or lease payable. So what should be the entry, sir? Sorry, what should be the value, sir? It is fair value of the asset. Hello, what is that? Fair value of the asset or present value of MLP from the viewpoint of lessee, whichever is lower. Hello, what we are going to look after is fair value of the asset or present value of MLP from the viewpoint of lessee. Sir, logic is very simple, sir. Tell me, usually asset will record at which value? Whatever payments we are doing for that present value. Am I right or not? So what payments you will do? ALP and GRP. Now if you bring that to present value, whatever is there, that should be your cost. Am I right or not? Yes. Let us assume your present value of MLP from the viewpoint of lessee is 2 lakhs, sir. But let us assume fair value of the asset is only 1,70,000. What does that mean, sir? They are collecting extra amount from you. Am I right or not? Asset value is 1,70,000, but a present value of MLP is 2 lakhs. That means they are collecting extra amount because present value of MLP is nothing but the present value of the payments you make. If it is higher than fair value, that means you are making extra payment. I can say, why you are making extra payments, sir? Because of your credit worthiness, lack of credit worthiness. Because you might be risky, they might charge higher interest rate for you, because of which now the total value will increase, sir. In every installment, what will be there, sir? Principal portion as well as interest portion. Higher the interest, installments will go higher or not? As a result, total value will go higher or not? Yes. Now what I say is, if present value of MLP is higher, it is because of your lack of credit worthiness. So it should not be recorded as asset value. That extra 30,000 should be recorded as interest only. That extra 30,000 should be recorded as interest. Today if we write as asset, how it can be recorded as interest, sir? So thereby today we record only at whichever is lower. As a result, asset will be recorded at proper value. Today we'll start with this price, sir. Balance will anyway be recorded in the form of interest only in future. Because today this is cash price, 0 present value. From this, whatever difference is there with the installments, entire difference will be charged to P&L as a interest. So if you don't recognize today as an asset, that amount will go to interest. That's the logic. So if at all present value is higher, in such a case, what you should do, sir? You should record only at fair value. If present value itself is lower, simply you will record at the present value. Sir, discussion clear? Hope you have understood the logic also. So this is what in the books of lessee. Now if I talk in the books of lessor, at what value he has to record, sir? He has to record at simply the present value of all his future receipts. Sir, lessee has to pay ALP and GRV. Lessor will not receive only ALP and GRV. He receives UGRV also, because he might sell to some third party and he may get some excess value. So thereby when he is removing the asset from his books of accounts, he could not see the benefits only from lessee. He should see also the benefits from residual value, entire residual value. So simply for in lessor's book, it should be present value of all his receipts, sir. Nothing but ALP plus GRV plus UGRV. Sir, have you understood, sir? It has to be recorded what, sir? Present value of ALP plus GRV plus UGRV. This is what the value at which it has to be recorded. It is simply called as nil. Hello, what is that? Nil. Net investment in lease. Hello. This is called net, because on a net basis, how much money, this is the asset we are giving. That means this much money only indirectly we are giving. This is the future receivable for us. If we are giving that asset, indirectly that much money only we are giving. So that is the net investment in lease. This is nil. There is also something called as GIL. Hello, what is that? GIL. Gross investment in lease. Net means present value. GIL means without present value. Without applying that present value. ALP plus GRV plus UGR. The difference is what, sir? Difference between present value and future value is what, sir? Interest. But because we are there at year 0 and we have not yet earned this interest and we will earn over the period, this is called as UFI. Unearned financial income. Sir, this is income only, finance income, because we are at year 0 and this interest is not yet earned, we will earn over the period. This is called as unearned finance income. How do you compute UFI? GIL minus nil. Hello, gross minus net will give you that UFI, sir, unearned finance income. That's all, sir. Accounting treatment over. Sir, have you all understood? Entries first of all should be simple, sir. Then we should know how to we record in lessees, sir. What amount? It is fair value of the asset or present value of MLP from the viewpoint of lessee, whichever is lower. Actually, further discussions are there, sir. How do we compute this rate, which is called as implicit rate of interest? Sorry, implicit rate of interest in lease. Whatever rate of interest was there in lease, that is called as implicit rate of interest in lease. Sometimes they may not give in the question and they give some lessee's incremental borrowing rate. Like this, some discussions are there, sir, but it takes lot of time. For solving the questions, all these things are not required, sir. Because in exam, ultimately what rate they give, will take. Hello? In exam, ultimately what rate they give, we will take. Whether it is implicit rate of interest in lease or whether it is incremental borrowing rate, whatever is that, we'll simply take it. So I'm not going to focus on that aspect. Sir, is that clear, sir? Okay, right. So with this completed, sir, let us solve 1 or 2 questions based on this quickly. One of the regularly asked questions, sir. Question number 4. Question number 4. I'll not do calculations, sir. I'll just tell you the procedure. Time will not be sufficient for calculations. ABC Limited took a machine from XYZ Limited, the fair value being what, sir? 10 lakhs. Then the economic life of the machine as well as lease term is how many years, sir? 4 years. At the end of each year, ABC Limited pays 3 lakh 50. Lessee has guaranteed a residual value of 50,000 on the expiry of the lease to lessor. However, XYZ estimates that residual value will only 35. Sir, what we will take, 50 or 35? When already guarantee is given, it is definite that 50,000 has to be paid. So we need not consider that 35. We have to consider only 50. The rate of interest they have given, sir, 60%, 16%. You are required to compute the value of the machinery to be recorded by lessee ABC Limited. What is the fair value? 10 lakhs. Now we have to compute what? Present value of MLP from the viewpoint of lessee. That means what you will take, sir? Every year, totally how many years are there? 4 years. 4 years you have to take 3 lakh 50. Hello, every year lease rental is what, sir? 3 lakh 50. Then in the last year, you should take a GRV of 50,000. Hello, he has given a GRV of 50. Now what you can take, sir? For 4 years, you can multiply with annuity factor. Now 50,000 you can multiply with present value factor of the last year. If you add that, you will get present value of MLP from the viewpoint of lessee. Sir, is that clear? Once you know that, whichever is lower you will apply. In this question, there is no UGRV. Even if UGRV is given, will we consider? No. UGRV is relevant only for lessor, not for lessee. So we will ignore when we are recording in the books of lessee. So that's all, sir. This is, they are asking to record finance charge also, sir. You will start with the cash price, of course the asset value, and finally every year you will book the interest just like your hire purchase. Hello, what, sir? Just like your hire purchase, but take it as granted. No fool will test you to compute the interest. Anyway, completed in hire purchase chapter only. For interest computation, they have to give 5 marks, sir, because it will take some time, and no fool will test hire purchase interest charges, sir. Particularly, they will test only the value of asset. For examination purpose, you can ignore that, sir, happily. Computation of finance charges, wherever it is given. In the exam time will not be sufficient, sir. That's all. Now, question number 5, sir. XYZ Limited has taken an asset on lease from ABC Limited for a period of 3 years. Annual lease rentals are what, sir? 6 lakhs payable at the end of every year. Residual value guaranteed is 2 lakhs, whereas ABC expects the salvage value to be 5 lakhs. So total GRV how much? 2. UGRV 3. Total residual value is 5 lakhs, sir. So GRV is 2. UGRV is 3 lakhs. If the fair value of the asset at the inception is 15 lakhs and the interest rate is 12%, compute the net investment in lease and annual finance income. This is relevant for whom, sir? Lessor. So net investment in lease means what, sir? Present value of ALP plus GRV plus UGRV. 3 years is the lease rental, sir. ALP how much, sir? Every year 6 lakhs. So 6 lakhs you will multiply with 3 years, sir. Then you have to multiply GRV 2 lakhs as well as UGRV 3 lakhs with the present value factor of third year. Sir, are you getting the point? Then you will get present value of ALP plus GRV plus UGRV. So this will be the amount, sir. Anyway, gross amount, how do you find, sir? Jill, sir, how do you find? In 6 lakhs into 3, will not multiply with present value factor. 3 years, 6 lakhs into 3 plus GRV 2, UGRV 3, total 23 lakhs will be Jill. For the same, if we apply present value, this will be nil. The difference is UFI, unearned finance income. Sir, is that clear, sir? We have to record asset at which value? Sorry, we have to record the receivable at which value? Lessee to asset will write no. At what value? Nil. That is 17,97,040. I hope everybody have understood. And one of the important and tricky question, let me discuss. With that, we'll close this accounting treatment part, sir. Now, what is that? Look at CRD 2, sir. Usually, many students will confuse in this question. Akshat International Limited has given machinery on lease for 36 months and its useful life is 60 months. Cost and fair value of the machinery is 5 lakhs. The amount will be paid in 3 equal annual installments and lessee will return the machinery to the lessor at the termination of the lease. UGRV is how much, sir? 50,000. Interest rate is 10%. You are required to comment whether the lease is finance lease or operating lease. If it is finance lease, you should compute UFI. First of all, lease finance or operating? Out of life of 60 months, lease is given for 36 months, 3 years. So thereby finance lease. Just by period only we can say. Anyway, if you want, you can compute the amount also. That is fourth indicator. What is the fourth indicator? Present value of the lease payments covers major portion of the fair value. You know the fair value of the asset is how much, sir? 5 lakhs. So if you compute present value of the lease payments, then you may get it. So first of all, anyway, they are asking some more information. For that, I should know the installment amount, sir. Can you please tell me installment amount in this question? That is the biggest point of this question. They have said the amount will be paid in what, sir? 3 equal annual installments. Can you please tell how much amount lessor will recover from lessee? At least in present value terms. Forget about that interest, sir. Can you please tell out of 5 lakhs, how much will recover from lessee? Can you please tell me? 5 years is the life, sir. In that we are giving for 3 years. There is some UGRV. Now tell me, out of 5 lakhs, how much we will try to recover from lessee? How much we will try to recover from lessee? 50,000 anyway we will get it by UGRV. Now ALP plus GRV will get from lessee. Balance we will try to get from outside. That is what concept, sir. Now tell me, how much we will try to recover from lessee in present value terms at least? Out of 5 lakhs, how much you will recover? You cannot say 4 lakh 50. There itself a big issue will come. 5 lakhs is today's value. 50,000 is not today's value. Please observe carefully. They are telling the unguaranteed residual value at the end of 3 years is 50. 5 lakhs is present value. 50,000 is future value. You should bring that 50,000 also into present value by multiplying 50,000 into third year present value factor. Then if you reduce that, then you will get the amount to be recovered. Sir, are you getting the point, sir? This amount we will recover. How we will recover, sir? In the form of 3 installments. Hello? In the form of 3 installments. Sir, are you getting the point, sir? Now, whatever amount we recover is equal to Hello, can I say like this, that installments value into present value factor or annuity factor should give me that 5 lakhs minus present value of 50,000. Am I right or not? Because this amount only we are going to recover from lessee. So this is the annuity factor, sir. You have to simply add whatever is given there, 3 years. Let us say it is 2.6. Now whatever installments into that annuity factor should give you what's their present value of what you are recovering. So installment will be found by dividing this amount by annuity factor. In that way you will get the installment value. Sir, have you understood, sir? You will first find 5 lakhs minus that present value, which is 4,62,450. You divide by annuity factor, you will get the annual lease payment. Sir, once you know annual lease payment, of course, here in this payment, not only ALP, GRV also there. Because GRV specifically not given in the question. So we feel that together is there in that installment. So this is what, sir, have you all understood, sir? This is what ALP. Now how do you find UFI in this question? Very simple. UFI means JL minus NIL. What is JL? Gross investment only. You will simply add ALP, GRV, UGRV, ALP plus GRV plus UGRV without applying any present value factor is how much? Hello? Is how much, sir? Now, no. That is today's value. That is today's value. Gross is future value, sir. So whatever installment is there, installment into 3. Hello? Because installment into present value gives, into annuity factor gives you present value. Installments into 3. Let us say installment is 1,50,000, sir. Then 1,50,000 into 3 plus 50,000. Because that is also should be taken at gross value only. That gives you what, sir? Gross investment in lease. Are you getting the point, sir? From that we will reduce that 5 lakhs because present value of ALP plus GRV plus UGRV is 5 lakhs. In that case we will get the UFI, which is unearned finance income. Sir, hope everybody have understood. So computing installment amount itself is the main issue in that question, sir. If you are able to understand that, we will recover only other than present value of UGRV from the lessee, the concept is completed. We will try to recover only something other than present value of UGRV from the lessee. So installments into annuity factor should give you that present value. That is the discussion clear? Hello, everybody, is the discussion clear? Okay, right. Now next, let me go to the next type of lease accounting treatment. What is that? Operating lease. Hello everybody, what is that, sir? Operating lease. Sir, operating lease, first of all, please understand, it's like a regular rental transaction. Hello, what, sir? It's like a regular rental transaction. I don't want to write the entries also. In the case of regular rental transaction, what will be the entries, sir? If you make the lease payment, rental payments, what will be the entry? Lease rental. First you will pass the due entry, sir. Suppose you are lessee, lease rental to lessor, lessor to bank, P&L to lease rental. Over. This lease rentals has to be charged to P&L. Suppose you are a lessor, then what you will do, sir? You are receiving lease rentals. No. First of all, you will write a due entry. What is due entry? It's an income for you. So you will write lessee to lease rentals. Then your bank account debtor to lessee, lease rentals to P&L. You will book as a income. First due entry, sir. Next payment entry. Next expense or income. Like that entries will be very, very simple in the case of operating lease. But one point you have to observe, sir. Generally, why we will charge lease rentals for anybody, sir? Hello? Why we will charge lease rentals, sir? For usage of the asset. Am I right or not? Now tell me one thing. Do you think payments and usage will be in the same manner? Payments and receipts as well as usage of the asset, do you think will be in the same manner? No. So when you are telling usage is one way and payments is another way, now my question is, you writing due entry and payment entry is absolutely perfect, but discussion will come about amount to be charged to P&L or amount to be credited as income, because generally usage is expected to be equal. So thereby what they say is, your due entry and your payment entry you do as usual. I don't disturb it. When you are writing the last entry, what is the last entry? Of course, when you are charging to P&L to lease rental, suppose Now what you will do, sir, you have to write the payment entry. Now usually let us assume payments are like this, sir, 50, 30 and 20. Now what do you write, sir? P&L to lease rental 50. That is what you usually write. Now what I say is, sir, payments may be in different manner. Ultimately, for usage only we are paying lease rentals. So P&L also should be charged in the same way, because usage is expected to be equal. I say P&L has to be debited 1 lakh by 3, 33,333 only. Is that clear, sir? Then what about the difference, sir? Because we are trying to record equal income or expenses, the difference is temporarily transferred to an account called lease equalization account. Which account, sir? Temporarily that is transferred to an account called lease equalization in the form of 16,667. In the next year what will happen, sir? Here I will write 30,000, there 33,333, but because now the difference is on credit side, I will credit lease equalization by 3,333. In the third year, payment will be 20 only, due and payment. Now P&L I will debit by 33. So here I will credit another 13,333 or 334. As a result, you could observe whatever created is getting cancelled by the end of the lease period. It is only a temporary account which is being created. Why we are creating? To equalize the amount of expense or income we are creating. That's why it is called as lease equalization account. Sir, have you all understood, sir? Due entry, payment entry as usual. Only the last entry will have a change, because payments and receipts cannot influence the income or expense to be booked. So it should be based on usage. So you have to debit or credit the P&L based on usage. Due amount anyway you will write as per the agreement. Balance you will transfer to lease equalization. It will tally, because anyway total lease amounts only just we are distributing over the period. Sir, discussion clear? Generally we assume that usage is equal. In some questions they may say usage is not equal. I will give you the production each year. First year 40,000, second year 30,000, third year another 30. That means usage is very clear. It is not SLM. When they give any usage pattern other than SLM, then in that ratio you will debit to P&L or credit to P&L. Once again same, the difference has to be transferred to lease equalization account. The discussion clear? So in this way operating lease has to be recorded. Let me show you with one question, sir. You will have full clarity. So this is question number 6. Everybody please observe. Suppose outputs from the machine on a 3-year operating lease are estimated as what, sir? 10,000, 20,000 and 50,000 units in each year. Ratio is what, sir? 1:2:5. Agreed annual lease payments are 25, 45 and 50,000. They are clearly declaring it's an operating lease. Now every year you will pass due and payment entry on this amount, sir. 25, 45 and 50. Third entry how you will write, sir? So we are telling in the books of lessee, P&L account at R to lease rental. Lease rental you will credit 25. How much we will debit? Total lease rental how much, sir? First of all 25 plus 45 plus 50, 1,20,000. This 1,20,000 we will divide in this ratio 1:2:5. So they say 15,000 in the first year, 30,000 in the second year, 75,000 in the third year. In that way expense to be booked. So we will book the expense in that manner. The difference will be transferred to lease equalization. Sir, have you all understood, sir? So in this way, I know I am going a bit fast, sir, but without going even this fast, now I think we cannot complete all the standards. But I think you are understanding. Is that clear? Because it is not regular class, it's only revision class. Okay, right, sir. Now, let me give you one last clarity and then close this issue, sir. Sir, actually, lessors will be of two types. Hello, who is that? Lessors will be of two types. One is normal lessor, the other one is manufacturer or vendor lessor. Usually we deal with normal lessors whose business itself is what, sir? Giving on lease basis and earning some rental income. Sometimes there will be a manufacturer or vendor, sir, who usually sells the assets. They don't give on lease basis, but because there was no sufficient parties now for buying, so I may thought to give it on a lease basis. Sir, please understand, sir, if I have got parties, I will sell only. Why I'll give on lease basis? I don't have sufficient parties. So actually I am a manufacturer or a vendor who sells the assets normally. I don't give it on rental basis. But because sufficient buyers are not there due to corona or some other reason, now I am giving on a rental basis. Are you getting the point? And that too, I am talking about a vendor lessor or a manufacturer lessor giving on operating lease. Because rather if nobody is buying, at least we should earn some rental income by giving it temporarily. We should not keep the asset idle. Our funds are blocked. So first we will give on operating lease. Later on if we find a buyer, after that operating lease we will sell it. So sometimes it is possible that a person who usually sells the asset also may give the asset on a operating lease basis. This is called a vendor lessor giving the asset on a operating lease basis. In that scenario, a separate accounting treatment. Only one extra point, sir. Sir, when you have purchased this asset, how you might have treated? I think it might be a purchases for you, goods. Because your business is to what, sir? Sell that item. So it is a good. You might have recalled it as purchases. But once you thought to use it for earning rental income, it is no more purchases. It is no more a good. It is a fixed asset for you. Because using that fixed asset only, you are earning the rental income. Are you getting the point, sir? So immediately, because you might have already debited to purchases, credit the purchase. Now because it is no more a purchase, it is a fixed asset, I will write fixed asset account or a machinery account debtor to purchase. So that now I am converting a good into a fixed asset. From now onwards, balance accounting treatment same. Because once he converted into a fixed asset, he is like a normal lessor, the regular accounting treatment will continue. Only one extra entry will be there. That too, if he is what, sir? Vendor lessor or a manufacturer lessor, and he is giving on a operating lease basis. Have you all understood, sir? Usually normal lessor gives okay, sir. But if seller, vendor lessor itself gives like that, then we say first convert that purchases into a fixed asset, then proceed with your accounting treatment. In this question you will get the same, sir. A machinery was given on 3 years operating lease by a dealer of the machine. He is not a regular lessor. It is given by what, sir? Dealer. A vendor lessor or a dealer lessor. So for equal annual lease rentals to yield 30% profit margin on 1,50,000. Sir, are you getting the point, sir? Now first what we have to write? We have to write one entry in this scenario because it is by dealer lessor. Anyway, they are not asking entry, sir. If they ask the entry, first entry that you have to write is machinery account debtor to purchase account. Of course, you will write machine taken on lease. A machine given on lease basis, because you have to distinguish normal fixed assets with these assets. That's why. Sir, is that clear, sir? Now anyway, in this question they will ask the rental income, depreciation. Depreciation has to be based on cost, sir. And in this question annual lease rental is also important, sir. What is the cost of the asset, sir? You should know how much you should recover, sir, always. Cost of the asset is 1,50,000. Profit margin is 30%. So can you please tell me that means how much we will recover, sir? 1,50,000 plus 30%. 1 lakh? Now tell me one thing. When we are giving on operating lease, will we recover entire amount from the lessee only? No, they will not agree also. Now how we have to recover from him? Based on the usage. Hello, what's the based on the usage? You know the life of the machine is 5 years and they have given output of each of the 5 years, sir. Now can you please tell me total usage how much? 40 plus 50, 90, 1,50,000, 2,30,000, 3 lakhs. Now in the first 3 years, how many assets, how many units are manufactured? 1,50,000. So that means how much usage was being done? 50%. So what we recover from his is also 50%. Is that clear, sir? 130% of 1,50,000 into output during lease period given by divided by total output, that will only give you the lease rental of each year. Anyway, you don't have any present value factor, etc. because here income, normal rentals, incomes and expense will be there. Interest income or interest expense will not be there. You need not worry about any present value factors. Is that clear, sir? Once you find that, rest of the aspects are simple. Is that clear, sir? With this, operating lease also completed. Let me move to the last concept in this chapter, which is sale and lease back. Sir, have you all understood till now? 3 aspects: classification of lease over, accounting treatment also over. Let me move to the last one, sale and lease back. Listen carefully, sir. Many of the students ignore this concept or just try to remember the rules and answer it, sir. If you know the logic, this is a simple concept only. You can remember for long. Let me tell you quickly, sir. Please observe carefully. A limited is there, B limited is there. A limited is selling the asset, sir. Once again, it is only taking back on lease. What is happening here, sir? Giving the asset, once again taking it back on lease basis. What is happening here? What is happening here? We are giving the asset, sir. We are selling the asset. Once again, we are only taking it on lease basis. What is happening here? Sir, it's a way of raising the finance. What is that? Because if we sell, we'll get the money. But will we pay this money back, sir? If we take on lease base entirely at a time? No, we'll pay over the period. Please observe, it is just like today we raising some money by selling the asset and we still want to use the asset. So thereby we are taking it on lease basis and slowly we'll pay in the form of lease rentals. Here it's a way of raising the finance by just giving the asset as a security. Are you getting the point, sir? Sale and lease back. But many people try to use this in a fraudulent manner, sir. Raising finance is a genuine activity. But many people don't restrict that to for that purpose, sir. They'll use in a fraudulent activity. Maybe I have said, suppose A limited and B limited are somewhat known to each other. Hello, A limited and B limited are known to each other. What he may do is, observe carefully. Today, let us assume book value of the asset is 10 crores. How much, sir? What he will do is, he will sell the asset for 15 crores and he will take the asset on lease basis also for 50. That means every year over the period he will pay. Now tell me what will happen, sir. If we do like that, can anybody come and check really is this genuine transaction or not? Suppose this is finance lease, sir. I have sold the asset and I am taking back on finance lease. Now tell me, before that sale and lease back, asset will be with whom? I'll just tell you one point, sir. Please observe carefully. Always to understand any impact, we have to see before sale and lease back, after sale and lease back. Can you please tell me, before sale and lease back, asset is with whom, sir? Sir, asset is with whom, sir? First tell me physically, then we'll talk about books of accounts. Asset physically with whom, sir? A limited. After sale and lease back, A limited only. Okay. In books of accounts, asset is with whom, sir? Before A limited. After lease, A limited. Why, sir? This is finance lease. This is which lease? Finance lease. If you take on a finance lease basis, now what is happening, sir? You are only getting. Now, physically before and after with you. Books of accounts also with you. Sir, if the transaction is like this, I can say it might be a dummy transaction. Why, sir? Can you come and check? Really transfer happened or not? Really consideration was settled or not? He will transfer through some other black manner, he will receive the money. Sir, are you getting the point, sir? In other words, real transaction may not be there. Then what he is trying to achieve here? Fraudulently, he is trying to book some profit. 10 crore worth asset he is selling for 15 crores and today itself booking 5 crore extra profit. You may say, sir, if 5 crores extra profit is there, then when he take the asset on lease basis, he had to record the asset at 15 crores. Then every year depreciation will be higher. No, sir. What he is trying to do, current year huge profits, expense slowly over the period. Is it not a fraud? Biggest fraud. Hello, trying to book the entire 5 crores in this year, whereas extra expense of that 5 crores over the period every year 0.5. Because usually anyway, 10 crores will be depreciated every year 1 crore. Now what he will be doing? Extra 0.5. But income in 1 year, expense over the period. Are you getting the point, sir? So this is pakka fraud, sir. Usually in the case of finance lease, it is very, very difficult to identify whether it is a genuine transaction of raising funds or it's not a genuine transaction. That's why we don't check also. We simply give them one principle. If you are giving an asset on if you are selling an asset and getting back on lease, the two finance lease basis, no big discussion, sir. You cannot recognize any profit or loss. What I have said? You cannot recognize. Standard itself has said you will not be allowed to recognize any profit or loss because it seems it's a dummy. So that means what they are telling? Sale value has to be book value of the asset only. Though it is any other value, you have to record the new value of asset also at old value. That means everything has to be recorded 10 crores. As a result, you cannot book any profit or loss. Sir, is that clear, sir? This is if it is finance lease. Now, another scenario is we have sold the asset, but we are receiving it back on operating lease basis. Which basis, sir? Operating lease. Can you please tell me once again, if it is operating lease, before the lease, asset is with A Limited. After the lease, asset is with physically, A Limited only. Books of accounts, before the lease, asset is with, after the lease, B Limited. Now, sir, in this scenario, first scenario, in finance lease, other party will not have any problem. Why, sir? Look at the other party scenario. Just if you look at him, what is happening? He will record a purchase of an asset. Once again, he will immediately record like a sale of an asset. Asset will be recorded, asset will be removed. Is there any impact on P&L for him? No. In fact, he may get interest income extra every year. Hello? Are you getting the point, sir? No big problem for the third party. He will help you easily, even if it is a fraud. Third party will easily help you, even if it is a fraud. But when it comes to operating lease, what will happen is, sir, are you going to take it on finance lease or operating lease? Operating. That means who will record the asset, sir? Sir, who will record the asset? B Limited. Now observe carefully. If B Limited records the asset, he has to record a depreciation of 5 crores extra. Of course, he has to record a depreciation of 15 crores, sir, actually over the period. Unnecessarily his P&L will be getting debited by more amount. Is he getting any extra for that? Hello? Unnecessarily his P&L is getting debited or not? So some people may not agree for it, sir. Though you may say, sir, lease rentals he will receive as income. No. But as he is taking on operating lease, how many years you will get, sir? 3 or 4 years. Do you think that will be sufficient to recover or make equal 15 crores expense? No. So usually this will impact the third party called the other third party, sir. That means lessor. So thereby, usually if it is an operating lease, we feel to some extent it is genuine. Hello, we feel to some extent it is genuine. But still, frauds can happen in the case of operating lease also. Why, sir? Sir, you need to book maybe a net expense of 10 crores extra. Am I right or not? Lease rentals will be there. Let us assume the other party has to book a net expense of 10 crores. I think third party usually doesn't agree. But I am telling, sir, you please book 10 crores extra. I'll give 1 crore cash. Now the third party agree. 10 crores expense is dummy, whereas 1 crore cash is real. Hello? If I give 1 crore cash for him, then he will be ready to incur 10 crore expense, sir, because that expense is dummy. This 1 crore is real. Sir, are you getting the point? Like that, by giving some money, still doing some fraud is possible. But usually, prima facie, we feel that operating lease means it is genuine. Have you understood, sir? With this discussion, I'll give you the profit or loss principle, sir. Whenever there is sale and lease back, everybody please observe, if it is resulting into finance lease, don't recognize any profit or loss. It should not be recognized because generally it is treated as a dummy transaction, and it is not possible also to check clearly. If you are genuine, then your aim should be raising funds, not booking profit or loss. Simply don't book any profit or loss and record the sale and lease back. That is what we say. Suppose if it is operating lease, prima facie it may be genuine, but still possibility is there that fraud may be done. So that's why we check now the sale value with fair value. What we are going to do? We are going to compare sale value with the fair value. Suppose sale value and fair value are equal. Hello, what is that? Sale value and fair value are equal. Then I think the transaction might be genuine only, sir. Because operating lease means, first of all, third party will not agree. Okay, suppose he has agreed, then if you try to sell at fair value, market normal value, I think you are really genuine. Then any profit or loss can be recognized immediately, sir. I don't disturb you. Profit or loss can be recognized immediately. When, sir? If sale value is equal to fair value. Now, suppose sale value greater than fair value, then, sir? Suppose sale value greater than fair value. Now maybe in this scenario, book value is how much, sir? 10 crores. sale value is 15 crores. Let us assume fair value is 13 crores. Now tell me, you don't have any problem if the sale value is 13, but because it is 15, 2 crores extra, some fraud might have happened. Now you will have doubt on 3 crores portion, on extra 2 crores portion, 2 crores. I think if the sale value is 13, we feel it as genuine. So what we say is profits up to fair value, we don't have any problem. Recognize immediately. Profits up to fair value, recognize immediately. Whereas in excess of fair value, whatever profits are there, which is in excess of the fair value, and that is not correct. What we say is you have to amortize over the period. Sir, here also when I say profit or loss should not be recognized, that doesn't mean you should never recognize, sir. You have to recognize it over the period. Immediately you cannot recognize it. They are telling amortize profit or loss also over the period. Because if it is over the period, extra expense will be there, extra income also will be there, extra depreciation and profit or loss also every year extra, net impact will be 0. So that's why it is not that profit or loss you cannot recognize at all, sir. Immediately you cannot recognize. You have to recognize over the period, because depreciation will be higher, this income also will be higher. On a net base, impact will be 0. Now anyway, leave it, sir. Only two things, sir. Either recognize immediately or amortize. Genuine means immediately. Otherwise, you have to amortize over the period. Now, this is second scenario, sir. Last scenario, if sale value is less than fair value. Sir, tell me, if sale value is less than fair value, generally, what might be your intention, sir? Is your intention to book profit or loss, sir? Because frauds can be done to book profits or losses both, sir. Suppose you are doing some fraud, and if sale value is less than fair value, what might be your intention of doing fraud? Booking loss or booking profit? Loss, because we can sell to the extent of fair value. If it is profit, we might have booked till fair value. If we are selling less than fair value, even if you are doing fraud, it might be of which type of frauds are booking? Losses. So what I say is, suppose in this scenario you are having profits, I think you might be genuine. Hello? In this scenario, if you are having profits, you might be genuine. So recognize immediately. Recognize what, sir? Immediately. No, sir. Sale value is less than fair value. And I am having loss. Hello, I am having loss. Now tell me what we will feel. That means they might be trying to book the fraud, but I cannot say it is definitely fraud, because sometimes buyers may not be readily available, sir. So as a result, I cannot sell at fair value. I may need to sell at less than the fair value. Sir, possibility is there or not? If buyers may not be readily available, can I sell at the fair value? No. Sometimes properties will sell below the government value. Why, sir? Buyers are not readily available. So I cannot say immediately whether that is genuine or fraudulent. So on an optimistic note, what we say is, okay, recognize immediately. We don't bother. We feel still it is genuine only. But we say that suppose today if I am giving at lower value, now when I am taking on lease basis also, I have to take at lower value only. Suppose today I am giving at lower value, when I am taking back on lease, if I take at a higher value, some fraud might be there. The same value if I take, good only. If I take with a different value, then fraud might be there. So that is what we say, sir. That discussion will be there. Anyway, so these aspects you have to observe, sir. In the case of operating lease, you have to compare sale value with fair value. Depending on that, you will feel whether it should be recognized immediately or not. Sir, have you all understood? Anybody, have you understood, sir? I know, sir, this is not a concept which can be said so quickly, but still I've just taught to revise it. Let me quickly apply to this question and close this, sir. You will get some clarity. Now, first of all, what is the lease back, sir? Operating lease. Only 3 scenarios. Sir, learning concept is one thing, remembering is another thing. Hello? Learning concept is one thing, remembering is another thing. I'll make you simple in terms of remembering. Shall I say that, sir? Examination, ultimately we have to do something. Now if you observe, profit or loss can be recognized immediately, can be recognized immediately, can be recognized immediately, can be recognized immediately. Only in one case amortization is happening. Which case, sir? If sale value is greater than fair value, that too in excess of, that means in all other scenarios, what you will do? You have to recognize immediately. Only in that case you will amortize over the period. Sir, I'll tell you, sir, examination wise, you can do it very simply. Only in one scenario, you are going to amortize over the period, sir. That is where sale value is greater than fair value, and that too in excess of fair value. In all other scenarios, when it is operating lease, you are going to recognize immediately. With this knowledge, let me apply this question. Now you will answer this very, very quickly. Okay. Now, you could observe WDV is 40 lakhs, sir. Sold for 50 lakhs and sale value is equal to fair value. No big discussion. 10 lakhs is what, sir? Sale value equals to fair value. Should be recognized immediately. Sir, over, sir. No big discussion. Apply one principle. Only in one case, amortization. In all other cases, immediately. Okay. Fair value is 60. Sale value is 50. Now, I think sale value is less than fair value. No big discussion. Recognize immediately. Immediately recognize. Third scenario, fair value is 45, sale price is 38. I think sale price is once again less only, so thereby recognize immediately. Immediately should be recognized. We have to give a note, sir. I think I have said you, sometimes possibilities that they may do the fraud. But anyway, you can take that assumption and provide. It's not a big issue. Then fair value 40, sale price 50. Now tell me, sir. Sale value is greater than fair value. Now observe what is the book value 40, fair value also 40. So nothing up to fair value, everything in excess of fair value. So what you will do? Amortize. Hello, it has to be deferred and amortized over the lease period. Next, fair value 46, sale price 50. So here sale price is greater than fair value. So up to fair value 6 lakhs immediately, excess 4 lakhs to be deferred. That 4 lakhs only to be deferred, 6 lakhs immediately. Sir, clear? Last one. Fair value 35, sale price 39. Sir, generally asset book value and fair value to be compared, sir. If at all fair value is lower, first this 40 lakhs should be brought down to fair value, sir. That is called as impairment loss. Which loss, sir? If recoverable amount is lower, first we have to bring down the amount. So because in all above scenarios, you could observe minimum fair value is 40. Here only fair value is 35. If at all fair value is lower, first bring down the WDV itself to fair value by recognizing a loss of 5 lakhs. Then apply your principle. So if it is now 5 lakhs loss, WDV also 35. Sale price is greater than fair value and everything is in excess of fair value. So thereby amortize. So 5 lakhs to be recognized immediately loss. 4 lakhs to be amortized. Over. Sir, I have done good discussion. After good discussion, I have given you simple Lilliput technique also. What is the technique, sir? In examination, only in one case you have to amortize over the period. In all other cases, you have to recognize immediately. What is that one case, sir, where sale value is higher than fair value? Because ultimately this is, sir, sale value is greater than fair value and that too in excess of fair value. In that scenario only, you have to amortize. In all other scenarios, you have to recognize immediate. Now, I think everybody might have understood. Sir, now everybody understood. Have you understood? Okay, right, sir. If you want technique, sir. Otherwise, concept, both are given. Okay, right. Now, let me continue, sir, with this almost 1 hour, 7 minutes discussion we have done on leases. So, let me close the discussion on leases with this AS 19 verse over. Sir, shall I proceed? Everybody, shall I proceed? Now, let us move to AS 20, sir, EPS. At least 2 more standards we should complete in this class. AS 19 alone, big standard, sir. It will take time, okay? Now, AS 20 EPS. Hello, what is that? EPS. Sir, in this standard, we mainly try to learn about computation of 2 types of EPS. Hello, how many types of EPS, sir? 2 types of EPS. What are the 2 types of EPS? One is basic EPS, other one is dilutive EPS or diluted EPS. Sir, are you getting the point? 2 types of EPS will be there. One is basic EPS, the other one is dilutive EPS. Now, in the case of basic EPS, first of all, what is the formula, sir? Formula is for basic EPS, it is First of all, what is the formula for EPS, sir? Earnings divided by number of shares. Well, what is that? Earnings divided by number of shares. But what earnings, sir? I can say it is pace divided by wins. Hello, what is that? Pace divided by wins. What is pace, sir? Profit attributable to equity shareholders. Hello, what is that? Profit attributable to equity shareholders. I can say it is PAT minus preference dividend. Hello, out of PAT, if you reduce preference dividend, that is what available to the equity shareholders. So PAT minus preference dividend gives you profits available to the equity shareholder. Suppose there is any transfer to reserves, any reserve for that matter, will be reduced? No, because any reserve belongs to whom, sir? Equity shareholders only. So out of profits, if there is any transfer to reserves, never reduce it, sir. Only one element to be reduced from PAT. What is that? Preference dividend. Any other element need not be reduced. PAT minus preference dividend gives you what, sir? Pace. What is WANS, sir? Weighted average number of equity shares. What is this weighted average number of equity shares? Very simple, sir. Sir, during the year, equity shares may be issued at different dates. Let us say 1/10/21, 50,000 equity shares are issued. 1/12/21, another 30,000 shares are issued. 1/2/22, 20,000 shares are issued. Now tell me, total year end, how many shares will be there closing? 1 lakh will be there. But should I compute entire 1 lakh as wins? The answer is no. Why, sir? I have not used their funds throughout the year. Hello, if I use 50,000 throughout the year, I will consider 50,000 as my wins. If I use 30,000 throughout the year, I will consider 30,000 as my wins. But because I am using only for half period or some other period, I have to apply that period weights. Which weights, sir? Period weights. So usually I have to write like this: 50,000 into 6/12 plus 30,000 into 4/12 plus 20,000 into 2/12. Like that I have to multiply. Sir, sometimes in the question they may say not just period weights, paid up value weights also may be there. In other words, these 50,000 shares may be rupees 10 fully paid, sir, and this may be only rupees 5 fully paid. If they have paid only 5, now will I give full amount, sir? No, I have to give proportionately. I'll write into 5/10. If at all there is any paid up value which is different, then I have to multiply with that paid up value also, paid up value weights. In other words, how do we compute WANS, sir? It is number of shares into number of months outstanding divided by 12. Because this gives you what, sir? Period weights. If at all paid up value weights are there, we write into paid up value by face value, because face value is the maximum amount, no, maximum liability. So if at all both are same, no big effect. If both are not same, then only effect will be there. In this way only we have to compute weights, sir. For each number of shares, if we add separately like this, we'll get the weighted average number of shares, which we call as wins. So pace by wins gives you what, sir? EPS. Sir, have you understood? Now the question comes, sir, from which date period has to be computed? Is it from the date of issue or any other date? Usually we consider from date of issue, but there are various issues, sir, where various other scenarios where date of issue may not work out effectively. We have to take something called as effective date. Which date, sir? Effective date. Reason is very simple. Suppose I have purchased a machinery on 1/7/21. When, sir? 1/7/21. I have gone there. The price of the asset is 10 lakhs. I thought to pay cash, but unfortunately in my bank account zero balance or insufficient balance. What I have said, sir, I don't have funds, but I'll give you equity shares. Will you take my company equity shares? They have agreed for that equity shares. But the problem is, today I have came here, I looked at the asset, I bought it. Can I issue shares today itself? Take my shares? Can I sell it like that, sir? I have to issue the shares. Legally it will take some time. Let us assume by 1/8 I am able to issue my shares. Now tell me, shares should be considered from which date, sir? This is date of issue, whereas this is the date of purchase of the machinery. Tell me, I should give them earnings from which date, sir? Purchase of machinery, 1/8. 17 or 18? 17 only, because I have already started using the asset. I should give him earnings from 17. That's why I cannot take as date of issue. I should take some other date. That date is called as effective date. That date is called as what, sir? Effective date. It differs from scenario to scenario. Effective date, that means from which date we should consider those shares for our earning purpose. It differs from scenario to scenario. Let me show you what are the scenarios and what you will get there. Quickly let me show you, sir. So these are the different scenarios, sir, where we should observe effective date. Generally, if you have issued shares for cash, the date on which last application due date, that is cash is receivable, that only will be considered normal. If the shares are issued because of conversion of debt into equity, so then what we will take? Date of conversion, because from that date only we should take them as eligible for our EPS. Next, suppose I have given for any settlement of liability, then date when settlement becomes effective. Principal interest also is the same scenario, sir. Suppose I have taken for purchase of any asset. For purchase of asset, I have given shares. Then I should take the date of purchase of the asset. Are you getting the point, sir? Like this, some issues will be there, sir. Let me take two scenarios which is usually important for examination. That is, one is bonus, the other one is rights. Hello, what is that, sir? Bonus issue, the other one is rights. If it is bonus issue, when do we feel, or in other words, how do we compute EPS in the case of bonus and in the case of rights? Tell me, bonus issue means what is the effective date? Current during the year somewhere we have issued bonus shares. Tell me when we should consider that shares are effective. From the beginning of the year, from the middle of the year? It is from the beginning of the previous year. Why, sir? Please understand one thing. Due to bonus, our resources increased? No. Our earnings increased? No. It should remain the same. So, but if you observe logically, last year 1 lakh shares are there. Today I have given 2:1 as bonus. That means now shares will become 1,50,000. But really my earnings came down? No. So to show everybody that my comparison is, my earnings has not reduced. Let us assume previously this is the earnings, sir, last year. This is the number of shares. Earnings is 20 lakhs. Number of shares is 1 lakh. This is last year, sir. Current year also earnings is 20 lakhs. Now current year somewhere bonus issued, sir, due to which number of shares became 1,50,000. Now if I find EPS, last year EPS will be 20, current year EPS will be 20 by 1.5. That means how much, sir? 20 lakhs by 1.5. It will be somewhere around 16. 13.5. Now tell me, really our earnings changed? No. Is this shares issued for any resources? Have we got any amount? No. So this is bad comparison, sir. So what we have to do, these shares we'll assume are there from the last year only. As a result, now last year shares also we will change, which we say make it 1,50,000. Now last year also will become 13. As a result, comparison will be proper. For the purpose of comparison, we assume that these shares are there from the beginning of the last year. Sir, are you getting the point, sir? So that is the point. So actually, whenever there is bonus, 3 types of EPS we have to present. Hello, how many types, sir? 3 types. What are the 3 types? Basic EPS of last year. That is in our scenario 20. Basic EPS of last year. In our scenario 20. Similarly, basic EPS of current year, which is 13. Because current year already shares are issued, we are computing based on 13. Now what we will write is adjusted basic EPS of last year, because we are adjusting basic EPS of last year for comparison purpose, which is how much, sir? 13. So this is, we are restating the EPS of last year, which we call as adjusted basic EPS of the last year. Sir, have you all understood, sir? Based on this, a question will be there, sir. Bonus issue, important from the examination viewpoint. This is the bonus. Net profit for the year 18 lakhs. Net profit for the next current year 60 lakhs. Number of equity shares issued until 30th September 20. Bonus issue was 2 for each equity share. The ratio is 2:1. First of all, what is basic EPS of current year, sir? Total earnings is 60 divided by 20 plus bonus is not 1:2, it is 2:1. That means number of bonus shares will be 40 lakhs. So thereby current year basic EPS 60 divided by 20 plus 41. What is last year basic EPS? Last year earnings 18 lakhs divided by last year number of shares 20, which gives you 0.9. What is adjusted basic EPS of last year? Last year earnings 18 divided by last year number of shares 20 plus 40. We'll change the shares of last year also. It is 0.30. In this way you will have a correct comparison. There is a really good increase because earnings increased from 18 to 60. Now here also good increase has to be there from 0.3 to 0.9. This is the comparison. Sir, have you all understood, sir? This is what? Bonus issue. What is that, sir? Bonus issue. Now let me proceed to rights issue. Hello, everybody. We are going to look after what, sir? Rights issue. Sir, usually what we are going to do in the case of rights issue is, what is rights issue, sir? Shares offered to the existing shareholders at a concessional price. Am I right or not? Shares offered to the existing shareholders at a concessional price. Because we are offering at a concessional price, we feel that some bonus element is involved here. What is involved, sir? Because 1,50,000 shares, actually the market price might be 50, sir. I am issuing at 40. Now tell me, generally how much fund you require here, sir? Let us say 1,50,000 right shares you are issuing. Now exercise price is 40. How much fund do you require? Because based on fund requirement only will issue shares, sir. 1,50,000 into 40. How much, sir? 60 lakhs. Am I right or not? This is the fund required. This is the fund required. Now, how many shares actually might have been sufficient, sir? If you have issued at 50 rupees, 60 lakhs divided by 50. How much, sir? 1,20,000. Please understand, if I have issued at normal price, 1,20,000 shares might have been sufficient. Because I am issuing at a reduced price of 40, how many shares I am issuing? 1,50,000. Standard considers these 30,000 shares as bonus shares. That's why the same concept will be applicable, sir. For these bonus shares, we will assume that these bonus shares are there from the beginning of the last year. Are you getting the point, sir? Because some bonus element is there. That bonus element standard is seeing in terms of number of shares. As a result, that bonus element will go and apply in the last year. Sir, is that clear, sir? How do we find that bonus element? For that, small computation is there. Actually, detailed discussion will be there. But because it is revision, what I'll do is I'll give you a simple logic to remember how to apply it, sir. Look here carefully. Usually, sir, generally, you should know the share price movement in the case of rights. Whenever rights is announced, do you think is it favorable to the shareholders or not? Either they can purchase at a lower price or they can sell that right. Usually, it's a benefit. Any benefit means generally share price will increase. Later on, when that right is exercised, do you think once again any more benefit? No. Sir, are you getting the point, sir? Because either you might have already purchased at a lower price, that means benefit was over, or you might have already sold the right, that means no more benefit, sir. Share price will come back to normal. Hello, share price will come back to normal. In other words, can I say like this, sir? Now, they'll use a word called TERP. What is that? TERP, theoretical X-right price. I think you know computation of X-right price in your bonus chapter, sir. X-right price, cum-right price, like that will be given. So generally, please understand, whatever value is there prior to exercise of rights. Hello. What is that? Whatever value is there prior to exercise of rights. So which we call as TERP into bonus. Because of bonus, share price will increase or not? So please understand, because now here exercise they will compare, sir. Exercise they will compare. Two things you have to observe. Because of bonus, first share price will increase. Later on, share price will decrease. Immediately prior to exercise of rights, what is the share value? This is called cum rights price. This is called as what, sir? Cum right price. Now, because of bonus element only, actually share price will increase. So we can say like this, sir. Now bonus element is equal to, I'll show like this. Bonus element is equal to come right price, that means value prior to rights divided by X right price. How do you get it, sir? We can simply remember in this way, sir, this is exclusive of bonus. If we multiply with bonus, this should be inclusive of bonus. Sir, are you getting the point? Which we call as come right price. Sir, are you getting the point? TERP, X right into bonus gives you come right. Because what is the difference between X right and come right? The discounted portion only. What is the discount? Bonus. That's why we say X right into bonus gives you what, sir? Come right. So thereby, how do we get bonus? Bonus is equal to come right by X right. What is come right value? Nothing but fair value prior to rights by theoretical X right price. In this way, we'll compute something called as bonus element. Sir, have you understood anything? Please observe two things you have to remember. First thing, for bonus element, we should feel that these shares are there right from the beginning of the last year. Second thing, you should know how to compute the bonus element. The X right into bonus should give you come right, because of bonus only that rights value is higher, that share price might be higher. X right into bonus gives you come right, so thereby bonus is equal to come right by X right. Come right means nothing but fair value prior to rights divided by theoretical X right price. Sir, have you all understood this? Now, once we know this, we should know how do we compute our EPS, sir? The two veins. Hello, the two what, sir? Veins. Because earnings will be common, sir. We should be careful with respect to veins. Please observe carefully. How do I write? Veins I will compute in this manner, sir. Number of shares. Sir, I think after rights shares will increase. Hello, after rights shares will increase. Number of shares prior to rights. Please observe carefully, sir. Now I'll observe number of months outstanding before rights here divided by 12 plus number of shares after rights into number of months after rights by 12. Sir, actually for computing veins, two approaches will be there. One, we will look after period wise. The other one is transaction wise. What is period wise, sir? Sir, let us say first 9 months we are having 50,000 shares. Last 3 months, another issue of 30,000 is there. We will be having what, sir? 80,000. Instead of telling 50,000 is there for 12 months and 30,000 is there for last 3 months, I can say like this: 50,000 into 9 by 12 plus 80,000 into 3 by 12. In that way also I can communicate. Are you getting the point? The same logic I am applying. Sir, are these shares inclusive of bonus or not? Because these shares are after rights. I don't need anything. So into just the number of months divided by 12. But whatever shares are there before rights, these shares are existing from the last year. And here, after this right, whatever bonus is there, we'll assume that this bonus is there right from the beginning of the last year. That's why we multiply with bonus element. Just for before rights, we'll multiply with bonus element. That's the only change, sir, in the denominator. Sir, usually number of shares before rights into months by 12. That is common. Number of shares after right into number of months by 12. That is also common. It is simply period. We are doing one extra thing, because before shares are not inclusive of that new shares bonus element. We are making it inclusive of bonus by multiplying with bonus element. That is what the small thing we are doing, sir. Actually, lot of logics will be involved. I'm just quickly reducing it or digesting it like anything. So just let me go to a problem. Then only we'll get some clarity. Rights itself is the only difficult aspect, sir. Now, let me clear you. A net profit for the last year, how much, sir? 30 lakhs. Current year, how much, sir? 50 lakhs. Number of shares outstanding prior to rights issue, 20 lakhs. Rights issue price, 20. Last day to exercise rights is 1st June. What is the rights issue ratio? 1:5. Hello, what is the ratio? 1:5. Existing, okay, because existing shares are 20 lakhs, how many right shares will be there? 4 lakhs. Now, please observe, fair value of one share prior to rights was 26. That means this which price, sir? Come right, X right, come right. Because prior to rights only we call as come right. So compute basic earnings for current year. Of course, basic earnings for last year, restated EPS for last year. Why we are giving restated EPS for last year? Here also bonus is there. Whenever bonus is there, last year also to be adjusted. How to convert last year shares into inclusive of bonus, sir? Multiply with last year shares also bonus element. Multiply with bonus element, then that also will be inclusive of bonus. First, for that we should find what, sir? Bonus element. If we find bonus element, everything will be clear, sir. In this question, what is come right price? I think I have said you, X right into bonus gives you come right. Bonus is equal to come right by X right. Come right price is 26. We have to find X right price. How to find X right price? Bonus issue chapter. That means number of shares before into before price plus rights shares into rights price divided by number of shares before plus rights shares. I think you will do something like this, sir, in your X right computation. The same we will do here. 20 lakhs is before, sir, into 26. 4 lakhs is new shares into 20 divided by 20 lakhs plus 4 lakhs. In simple, existing plus wealth plus new wealth divided by total number of shares over. Hello, what is that? Existing wealth. What is existing wealth before rights? 20 lakh shares you are having. Each share is worth 26 plus new wealth. What is the new wealth? 4 lakhs into 20. That is the existing wealth plus new wealth divided by total number of shares after rights over. That is where you will get X right price. What is come right price? 26. 26 divided by 25 is equal to 1.04. This is what, sir? Bonus element. Hello, this is what? Bonus element. Now what I will do? Current year. How do I find EPS, sir? We have to be careful in veins only, sir. Can you please tell me first of all, what is the date of exercise of rights, sir? 1st June 2017. That means how many months before rights and how many months after rights? Before months is 5 months. After rights is 7 months. Can I say like this, sir? 20 lakhs into 5 by 12 plus 24 lakhs into 7 by 12. Sir, can I write like this? Have you all observed? Simple, sir. First 5 months, how many shares are there? 20 lakhs. After 5 months, how many shares are there? 24 lakhs. So 20 lakhs into 5 by 12. 24 lakhs into 7 by 12. This is common. Just what I will do is, for the shares which are before rights, I will multiply with bonus element, which is 1.04. That's all. You will get the denominator for current year EPS. You could observe, sir, 20 lakhs into 1.04 into 2 by 12. What is the year? Okay. Sorry. I have taken different months. April and May, only 2 months, sir. So 2 months and 10 months. Concept is same, sir. It is just 2 months and 10 months. The same way. Sir, are you getting the point? So earnings will be same. Earnings divided by these shares give you the current year EPS. How do you adjust last year EPS? Last year earnings divided by last year shares into bonus. Into bonus, if you multiply, you will make it inclusive of bonus. In that way, last year basic EPS will be common. Last year normal divided by last year normal equity shares. Have you understood to some extent at least? Hello, have you understood to some extent, sir? Okay, right. So with this, rights shares also completed. Now let me move to the other aspect of the standard, sir, which is dilutive EPS. With this basic EPS important aspects completed, sir. Now let me move to dilutive EPS. Hello, what is that? Dilutive EPS. Sir, usually dilutive EPS refers to potential reduction in EPS. What is that? Potential reduction in EPS with increase in veins but without increase in resources. Something I have said. What is dilutive EPS means? It is potential reduction in EPS due to prospective increase in veins but without corresponding increase in resources. What is this, sir? Sir, usually if number of shares increases, your EPS will dilute or not? Please observe carefully. What is the EPS formula, sir? Everybody, what is the EPS formula? Earnings divided by number of shares, that is pace by veins. Sir, if veins increases, EPS will reduce or not? Sir, EPS may reduce because of two reasons. Either pace should reduce or veins should increase. I am not considering this factor. I am considering only one. Decrease in EPS due to increase in veins. Sir, When veins will increase? If you issue the shares. Sir, if you issue the shares, definitely I think I will issue for some price. I will get the funds also. Then wealth will increase. Then my earnings also will increase. Then EPS also will increase. I am not talking about that. I am not talking about that. I am talking about such issue of shares where number of equity shares will increase, but our resources remain the same. If there is such a type of decline possible in future, communicate to the shareholders today only. Shareholders, your EPS is going to reduce. Be ready for that. Sir, are you getting the point? Let me tell you one example. Let us say convertible debentures are there. What is that? Convertible debenture. I think long ago only you have raised the funds from debentures. Suddenly in the next year conversion happens. Equity shares will increase or not? Yes. Funds will increase with the company. Equity shares will increase. Funds will increase with the company. No. Definitely EPS is going to reduce. Definitely EPS is going to reduce because our earnings is going to be the same. But still number of shares will increase. EPS will reduce. That is what we are talking. Convertible preference shares. Already previously only we might have raised the funds. Now today in the next year, now veins will increase or not? Yes. But correspondingly resources increases? No. Because already increased in the past only. So due to which our EPS will reduce or not? Yes. Because earnings remains the same, but number of shares increases. Like this, there are some dilutive instruments, sir, due to which what will happen, sir? Our earnings remains the same. That means not earnings, sir. What we say is without increase in resources, if there is any new shares, such instruments are called as dilutive instruments. Usually 3 such dilutive instruments are there. One is convertible debentures. One is convertible preference shares. The other one is options, sorry. Just like ESOP. Hello. The other one is option. In all these scenarios, number of shares will increase, but resources will not increase. As a result, your earnings may remain the same, but still your number of shares will increase. Your EPS reduces. If there is any such a decline, that has to be reported, which we call as dilutive EPS. Let us take one example for convertible debentures as well as options. Because almost convertible debentures and convertible preference shares will be same, almost. Now let me take an example. Now look here carefully. CRT 7, sir. Net profit for the year is 12 lakhs. Weighted average number of equity shares outstanding during the year is 5 lakhs. So sorry, this is option, sir. First let me move to debentures. Net profit for the year is 100 lakhs. Number of equity shares outstanding is 50 lakhs. What is basic EPS, sir? 2. Now they are not asking you to find basic EPS. You have to compute dilutive EPS. That means if suddenly conversion happens, what will be your new EPS? That's all. Hello? Dilutive EPS means if conversion happens, what will be your new EPS? Now, number of 12% convertible debentures of 100 each, how much, sir? 1 lakh. Each debenture is convertible into 10 equity shares. Interest expense for the year is 12 lakhs. Tax expense relating to the interest is 3 lakh 60. Anyway, tell me, if at all conversion happens, what is the new EPS? Tell me, denominator, will it have a change? Previously, what is the denominator? 50 lakhs. Now tell me, denominator, will it have a change if this conversion happens? Yes, increase is going to be there. How much increase will be there? 1 lakh debentures are there. Each debenture convertible into 10 shares. I think denominator will increase by 10 lakhs. Accepted? Sir, simply if conversion happens, what will be the new equity shares? Find it, that's all. So 50 lakhs plus 10 lakhs gives you what, sir? 60 lakhs. Numerator, previously it is 100 lakhs. Now it will have a change. It will have a change. Sir, actually we are not considering any changes, but due to what we are taking an assumption that if conversion happens, now relating to conversion, if there is any cash flow, that you have to consider. Now relating to conversion, because of that conversion, will your net profit change? Yes. Previously, when the debentures were existing as debentures, now interest might be recorded as an expense. Now if the debentures are converted into equity shares, that expense will not be there anywhere. So as a result, your profit will increase. Am I right or not? If your interest is not there, profit will increase or not? Yes. But the problem is, if interest is there, tax saving will be there. Today interest is not there, so tax saving also will not be there. That means addition will be there to your net profit. How much, sir? Interest net of tax. Can I say like this, sir? Interest into 1 minus tax rate. This much addition will be there in your profit that you have to add. So what is your regular interest? 12% into 1 lakh of 100 each, 12 lakhs. So 12 lakhs into 1 minus tax rate, 12 lakhs into 70%. I think 8.4 lakhs has to be added in the numerator. Then you will get 108.4 lakhs is the numerator. Denominator will be 60 lakhs. If you divide, you will get the EPS. Is that clear, sir? Everybody clear? Now, if it is preference shares, tell me what is earnings available to equity shareholders? PAT minus preference dividend. If preference converts into equity, now preference our pace will increase. Because previously preference dividend used to be reduced. Now if it is no more there, preference dividend we have to add. Because tax effect will not be there, you need not consider. Simply we will add preference dividend. In the denominator we will add the increase in number of shares. That's all, over. Sir, is that clear, sir? Now, in the case of ESOP, formula will be there, sir. We have to apply, but we have to be little bit careful, sir. In the case of ESOP, sir, do you think shares are issued at zero value? Do you think increase in resources is there or not? In the case of ESOP, increase in resources will be there or not? Yes. But standard what it is telling is, standard is not asking you to take entire shares, sir. Let me take an example. Let us assume 1,50,000 shares are there. Your actual price is 50. Suppose you are offering at 20 rupees. You are offering at 20. Now tell me, what is the fund you actually require? 1,50,000 into 20. That's why you are offering at 20. Sir, based on the fund required only, we increase the number of shares, sir. So actual fund required is 30 lakhs. If you have offered at 50, how many shares might have been sufficient? 60,000. That means standard feels 60,000 shares are issued for cash. 90,000 shares are issued without cash. This 90,000 shares alone we should consider for our dilutive EPS. Have you understood, sir? 60,000 into 50 we assume as issued for cash, sir. 90,000 into 0, this is what bonus, this is what issued freely. Increase will be there, but without increase in resources. This number of shares alone to be considered. Is that clear, sir? Which we call as bonus in option. We should not take entire options. We should consider only bonus in option. How do we consider bonus in option? Very simple. Instead, we need not do all these things like things, sir. Simply, I can say 1,50,000 into, what is the bonus portion? 30. Because 50, we are giving at 20. What is the bonus? 30 divided by 50. I will get that number, sir. 90,000. Are you getting the point, sir? Concession per share divided by fair value per share gives you the bonus portion. That bonus portion only we have to consider, not everything. And due to options, do you think any increase will be there in profits? No. Because for debentures we pay interest. For preference dividend, employees nothing other than salaries. Hello. And salaries will anyway be paid even if we give options. So there will be no change in the numerator. Only denominator will increase. Let me see this question number 7, sir, with which we will close AS20. So net profit for the year 2017, how much, sir? 12 lakhs. Weighted average number of equity shares outstanding during the year 2017, how many shares, sir? 5 lakhs. Average fair value of one equity share during the year is 20. Weighted average number of shares under the option is 1 lakh. Exercise price for shares is 15. Now please observe, sir. Now totally what is the fair value? 20. You are offering at 15. Can you tell me the concession portion? 5. Now what we are going to do, sir? Basic EPS is 12 lakhs by 5, which is 2.4, sir. No big discussion. When we are computing dilutive EPS, what we should do, sir? Now actually number of options issued, how many, sir? 1 lakh. Number of shares issued under the option, how many, sir? 1 lakh. Now shall I consider entire 1 lakh for this dilution purpose, sir? No. Out of 1 lakh I should take only bonus portion. So 1 lakh into 5 by 20. Because fair value is 20, concession portion is 5. So into 5 by 20 if I multiply, how many shares? 25. We assume that 25,000 shares are being given freely. 75,000 shares are issued at that may be 20 rupees. In that way we'll assume. Are you getting the point, sir? So anyway, how many shares to be considered? 25. Earnings will be same. Denominator will increase by 25. 5 lakh plus 25. In that way we'll compute dilute to EPS in the case of options. Sir, have you understood, sir? With this EPS is over, sir. Mainly remember the regular formula, pays divided by vains. Then in the case of bonus, just multiply with last year. In the case of rights, first find bonus element, come right into x right into bonus gives you come right. Find the bonus and just multiply bonus element with the shares which are there before rights. That's all, over. Entire process is same. Whatever shares are after rights, for that you please don't apply. Number of shares before rights, whether it is current year or last year, you simply multiply with bonus which you found now. That's all, process will be over. Now dilutive options we have seen in the each case, sir. Denominator will add the increase. Numerator, if it is debentures, we'll add interest net of tax. If it is preference, we'll add preference dividend. If it is options, nothing. So in this way EPS also completed. Sir, shall I proceed to another standard? Hello, AS20 is completed. Now let me move to another standard, sir. AS26. Hello, which standard? AS26, because that's a shorter standard. We can complete within 5 o'clock maybe, or 5 at least. AS26, sir. Sir, one thing I am telling, I'll try to complete all the standards. If at all time is not permissible, the standard which I am going to leave is AS24, which is generally not asked in exam. Or even if only 1 or 2 questions will be there, just by looking at that you can understand. If at all time is not permissible, because dealing with entire standards, that too with covering many questions, may not be possible. So I'll try to cover, sir. If at all not possible, the standard that I am going to leave is AS24. Now anyway, let me start with AS26. What is AS26, sir? Hello, what is AS26? Intangible assets. In this chapter, mainly we are going to learn about 3 aspects, sir. If the 3 aspects are over, that's all simple. Of course, we can say 4 aspects maybe. One is recognition criteria. Hello, what is that? Recognition criteria. Definition will be there, but generally not required for exam. Definition will be there. We have to learn it, but not required for exam. That's all. Next, measurement will be there, sir. Hello, what is that? Measurement. Measurement means both will be there, self-generated as well as acquired. Then subsequent expenditure, and at last amortization. So these are the 4 important aspects. If you are good at these aspects, that's all, standard will be over. Let me start with one by one, sir, and simultaneously we'll solve with questions also, related questions also one by one. Wherever required, we solve with simultaneous questions also. Okay, please look into the question. Please look into the standard. AS26. First, what is an intangible asset? The definition will be like this, sir. It's an identifiable non-monetary asset without physical substance. This is what the definition. Hello, what is that? It's a identifiable non-monetary asset without physical substance. But anyway, definition part usually not required for answering various questions of exam, so I am leaving with that. Now, sir, if it satisfies the definition, that means it should be identifiable separately as goodwill or patents or trademark. Somewhere you are identifying, it should be non-monetary. Monetary means, you know, debtors, creditors, etc. It is non-monetary. Fixed asset only, that means asset only, and without any physical substance. Okay. 2 recognition criteria, if it is satisfied only, we will recognize in the books of accounts, sir. What are the 2 recognition criteria? One is FEB should be probable. Hello, what is that? Future economic benefits should be probable. Next one, amount should be measured reliably. Only if both the conditions are satisfied, reliably measurable. Only if both the conditions are satisfied, we will record intangible assets in our books of accounts. One is what, sir? FEB should be probable. Second one, amount should be measured reliably. or reliably measured. Let me deal with this question. You will have a clarity, sir. K Limited launched a project for producing X in October 16. Company incurred 40 lakhs towards R&D expenses, sir. Due to prevailing market conditions, management came to conclusion that product cannot be manufactured and sold in the market for next 10 years. We have incurred lots of expenses, sir, but product cannot be sold. Now tell me, is it FEB is probable? No, FEB is not there. That's why we will not record it as a intangible assets. An intangible asset should be derecognized when there is no FEB. When FEB is not there, we should not record, sir. We have to fully charge it to P&L. Entire expense has to be charged to P&L. Sir, is that clear, sir? That's the first point, recognition criteria. Next one, measurement, sir. Here we'll divide into two, self-generated and acquired. Sir, if it is self-generated, once again we'll divide into two, goodwill and others. Hello, what is that? Goodwill and others. Goodwill, very simple, sir. If it is self-generated, don't recognize. Hello, if it is self-generated, don't recognize, because usually cost cannot be measured. Hello, for generating goodwill, what factors contributed? Nobody knows. So cost cannot be measured reliably. One of the recognition criteria is not getting satisfied. Amount cannot be measured reliably. As a result, if amount cannot be measured reliably, tell me, if amount cannot be measured reliably, can we record that, sir? No. So thereby usually self-generated goodwill cannot be recorded because cost cannot be measured. Sir, clear? That is goodwill. Now others. Now how we should recognize with respect to others, sir? We should divide into two. Others. Sir, if we are generating self, that means may it be patents or any other copyrights, etc. How we should record? Now very simple. Whatever expenditure we incur, we will divide into two phases. How many phases, sir? Two phases. One is research phase, the other one is development phase. What are the two phases, sir? One is research phase, the other one is development phase. Research phase means what we will do there? It is just planning, sir. Everything we'll think, oh, whether it will work out or not. We'll think all the possible aspects. Once we feel this may be worked out, then we'll start applying it. Application is nothing but development. Planning and investigation or doing some investigation, research, etc. is nothing but your research phase. Two phases will be there, research phase and development phase. Tell me, if you incur any expense in research phase, shall we add it to the cost of the asset? Are you incurring for intangible asset or not? Yes. So shall I add it or not? No. Why? At the stage of research, now you never know whether the product will be successful or not. FEB is not probable. So as a result, any expense should be charged to P&L. Sir, any expense incurred during research phase should be charged to P&L. If it is development, sir, research completed, sir, we have started development. Can I add it to the cost of the asset? No. Even when you have started development, ensure that it will be successful and it will have some good FEB. Now only then you can recognize. For that, actually standard has set some conditions, sir. If that conditions are satisfied, you can capitalize. If conditions are not satisfied, once again you have to charge to P&L. So what are those conditions, sir? 6 conditions they have said. First of all, it should be technically feasible to complete the project. Hello, technical feasibility should be there to complete the project. Second one, not only technically, sir, resources should be sufficient to complete the contract. In other words, some financial resources may be required. No, technology wise, it should be helping you to complete it. Financial resources should be available. You should have an intention to complete it. Hello, sometimes you may not have an intention, sir. This may not work out. Let me stop. Sometimes you may not have ability to complete it. Hello, intention should be there, ability should be there. Then you should prove in the market that FEB will be there. Hello, you should prove how FEB will be generated. In other words, manner in which FEB is generated, you should prove everybody. And at last, cost, is it measurable or not? If these 6 things are satisfied, we feel okay. Now that means definitely we will complete the project. FEB is also being generated. Cost also known. So everything is clear. If these 6 conditions are satisfied, then only you capitalize. If these 6 conditions are not satisfied, simply charge to P&L. The discussion clear? Please observe carefully. Research phase, everything should be charged to P&L. Development phase, if all the conditions are satisfied, capitalize. Otherwise, charge to P&L. Now, one more point. Sir, capitalize it, sir, because all the 6 conditions are satisfied. Suppose later on in the next year, FEB became doubtful. FEB is not probable. Now, can I once again charge to P&L? Once capitalized, can I charge to P&L? Yes. Sir, always that conditions should satisfy during the period at any time. If conditions is not satisfied, immediately you should charge to P&L. Once capitalized, can be charged to P&L later. But let me tell you one thing, sir. Once charged to P&L, cannot be capitalized. Because once doubt is there, now always doubtful only, sir. Hello, once you have done a mistake, we will always look from that angle only. So every time if you are proper only, we will capitalize. So once charged to P&L, cannot be capitalized later, even if you satisfy all the conditions, because we will wait till everything is completed, then only we will recognize. Therefore, once charged to P&L cannot be capitalized. However, once capitalized can be charged to P&L. The discussion clear? So this is what measurements are. If it is acquired asset, you know it. It is simple. Purchase price. You will add any non-refundable taxes. Hello. You will reduce trade discounts. As usual, sir. I think you might have seen this in number of standards. Now you will add any directly attributable costs like installation charges, etc. So like that we will add, sir. You will get the cost of the asset. If at all it is acquired asset. If it is self-generated, we will divide into goodwill and others. Goodwill means nothing. Others means research phase, we will charge to P&L. Development phase, if all the 6 are satisfied, then capitalize. Otherwise charge to P&L. Once capitalized can be charged to P&L, but the reverse is not possible. Sir, is that clear, sir? This is measurement. Subsequent expenditure. Hello, what is that? Subsequent expenditure. What I should do? Sir, on the asset, sometimes you may incur some subsequent expenditure or not. Expenditure you incur at the time of purchase of asset, you have to recognize as cost, sir. If you have done any subsequent expenditure after purchase, we have to observe whether it will increase the FEB or not. If it increases the FEB, capitalize. No, sir, it will not increase FEB. Just to retain the FEB, then you have to charge to P&L. Sir, let me give an example. Let us say copyrights was there. Somebody has filed a case against you that you are violating their copyrights. Now, what you will do? You have to appoint lawyer and just prove that now it is our copyright only, not their copyright. Now tell me, by doing this, will we get any advantage, extra benefit? Nothing. We are just telling it is our own copyright. Anyway, it is our own copyright. Due to this, our FEB will increase. No, it has to be charged to P&L. Sir, is that clear, everybody? So in this way, we have to observe whether it will increase the FEB or not. What is amortization, sir? Just like depreciation only. In the case of amortization, usually 3 things we have to be careful, sir. First one, method of amortization. Hello, what is that? Method of amortization. Next, we should be clear with respect to useful life. Next, we should be clear with respect to residual value. Sir, method of useful life. Usually, we apply which method, sir, for providing amortization? It is the manner of FEB. Hello, what is that? Manner of FEB. How FEB is generated? That means how many units you are able to produce based on that. If nothing given, SLM. We assume that benefits are derived equally. SLM. Generally, pattern, manner or pattern of FEB. If FEB pattern is not given, SLM. Useful life, sir. Standard assumes generally useful life shall not exceed 10 years. But you can prove. but you can prove against it. So that's what called as rebuttable presumption. You can prove against also in the court of law that your asset is having a longer life. Generally life is max 10 years. Residual value also, because it is not tangible asset where you can get some scrap value, assumed to be 0, but once again you can prove against. This is also a rebuttable presumption. And any change in useful life or method is to be treated on a prospective basis, just like AS10. Just like AS10, where any change in useful life or method we account on a prospective basis. Here also any change in life or method will be accounted on a prospective basis. That's all, sir. Standard over. Let me deal with few problems. You will have that clarity. So shall we proceed? Now also I'll take extra 5 minutes only. I'll close. Now 1 hour gap is there, sir. So we'll take that 5 minutes, not a problem. Sir, shall I proceed? First of all, summary clear? Simple recognition criteria, measurement, then subsequent expenditure, amortization. Amortization only 3 aspects: method, useful life, and residual value. Okay, right. Now let me deal with few questions, sir. You'll have full clarity. First question is completed. Second question, sir. A Limited acquired for its internal use a software on 1st March 2020 from UK for 1,50,000 pounds. The exchange rate was 100. Seller allowed trade discount of 2.5. Tell me, is this self-generated or acquired? Acquired. How do you record, sir? I'll not read entire question. Just let me show you. Purchase price less trade discount. You will add non-refundable taxes, sir. Import duty or customs duty is non-refundable. I think you know GST only input tax credit is there. Customs duty, it is not covered under GST. So thereby that is non-refundable tax. So anything they give, sir, import duty first we will record. On this new value you have to provide something called as additional import duty. Then you have to add any installation or professional fees. These are all direct expenses. If we add like that, you will get the cost. Is that clear, sir? That is in the case of acquired. Now look at question number 3, sir. During 16-17, an enterprise incurred costs to develop a routine low risk computer software product as follows. Different stages are given, sir, in the course. Now tell me one thing. It was given here after completion of phase 2. It was established that product is technically feasible. So assuming all other 5 conditions are also satisfied, because this is only one condition, technically feasible. Assuming other 5 conditions are also satisfied, from when we should start capitalizing? From when? After phase 2. That means first 2 phases, whatever expense are there, we have to charge to P&L. Here we have to add to capital. We have to capitalize. But one last expense is there, packing, sir. This is not for creating that. Packing charges are regular expenses. Now that has to be charged to P&L. Don't tell me that packing is a part of research or development. Hello, packing is neither research nor a development. So it has to be charged to P&L. Sir, is the discussion clear? So these 3 capitalize, first to P&L, last one once again P&L, because it's neither part of research or development. It's a regular expense. So hope it is clear. This is one of the important questions which is regularly asked, sir. CRD4. Messrs. Pasa Limited is developing a new production process. During the financial year ended 31st March 19, the total expenditure incurred on the process was how much, sir? 80 lakhs. The production process met the recognition criteria as on 1st November. When it met, sir? 1st November. But during the full year expense, how much? 80. When the recognition criteria was met? 1st November. Expenses till that date, how much? 42. That means 42 lakhs should be charged to P&L, because till that time recognition criteria not satisfied. The balance how much, sir? 38 lakhs should be capitalized. Sir, clear? Okay. What is the expenditure to be charged to P&L for the first year? How much, sir? 42. How much should be, what is the carrying amount of the intangible asset of the first year? First year how much, sir? 38 lakhs. Expenditure is 42, carrying amount will be 38. Now let us move to second year. Further expenditure incurred on the process for the year ending was 90 lakhs. Already condition satisfied or not? Yes. Now this has to be added or not? Yes. So the new value will become how much, sir? Already 38. Now another 90. Total how much, sir? 128. Now as on 31st March 20, recoverable amount is only 82. Sir, if recoverable amount is lower, recoverable amount means not from sale, sir. Recoverable amount means amount from sale or value in use, whichever is higher. Value in use means using that asset, whatever production we get in future, cash flows, if we bring it to present value, nothing but in your capital budgeting, you'll get present value of cash flows. Am I right or not? So it is present value of the cash inflows or the sale value, whichever is higher, that is called as recoverable amount, not the sale value, sir. So generally we hold fixed asset only for usage. So thereby whichever is higher also, if the recoverable amount is lower, in such a case we have to charge to P&L, which we call as impairment loss. Which loss, sir? Impairment loss. So actually what is the expenditure to be charged to second year? Normally, because it's not a research fair, nothing to be charged, but because of impairment loss, 128 minus 82, that 46 lakhs has to be charged because of impairment loss. What will be the carrying amount after reducing 46? That 82 lakhs will be the carrying amount. First year we have charged to P&L because recognition criteria are not satisfied. Second year, because of impairment loss, we have charged to P&L. This is one important question. Sir, have you understood the question? Sir, clear? Okay. Let me deal with CRD 5 and then close, sir, because other things are based on amortization. Amortization is somewhat simple. It is based on the production only. So let me quickly deal with question number 6. Sorry, 5. Okay, 5 and then close. X Limited has a trademark, sir, 2 trademarks, Sun and Surya. 1 month before, company came to know that both the trademarks have allegedly been infringed by other competitors. After investigation, legal department of the company informed that it had a weak case on trademark Sun and strong case in regard to Surya. X Limited incurred additional legal fees to stop infringement. Sir, we have incurred some legal fees to stop infringement. Is it increasing the FEB? No. This is subsequent expenditure. Whether it is strong case or weak case, whether we will win or lose, whatever expenditure we incur, will it increase the FEB? No. So it has to be charged to P&L. Next, during the year 18-19, company spent 7 lakhs for publicity and research. Tell me, if we spend, anyway, research expenses means definitely what, sir? Charge it to P&L, but they are telling publicity also. Tell me, if we incur any big amount for advertisement, is it definite that FEB will be there? Advertisement to increase the sales, but that is not a definite factor which can increase the FEB. So thereby, we cannot say FEB is probable. So thereby, entire expenditure has to be what, sir? Charged to P&L. Anyway, they are only telling it proved to be a failure. Failure means what, sir? FEB will not be there at all. So has to be charged to P&L. Third point, company spent 25 lakhs in the past 3 years to develop a product. These expenses was charged to P&L since they did not meet the criteria of AS 26 for capitalization. In the current year, approval of the concerned authority has been received. Company wish to capitalize. Once charged to P&L, can you capitalize? No. So thereby this is not allowed. But once capitalized can be charged. Okay. Last one. A company with a turnover of 200 crores and an annual advertising budget of 50 lakhs had taken up for the marketing of a new product by a company. It was estimated, of course, this is also advertisement only, sir. It was estimated that company would have a turnover of 20 crores from this new product. So the company have debited to the P&L entire expenditure of 50 incurred on this special advertisement. So can they charge it to P&L, sir? Yes or no? So whatever they have done is correct. Sir, usually if they do anything, we used to say wrong. Don't get to that conclusion, because advertisement will not bring any pakka FEB, sir. We cannot say FEB is probable. Though they say turnover may increase, but that is not certain. Advertisement can never bring you a definite FEB. So thereby we have to charge to P&L. But don't look at the question. They have debited to P&L, so that might be wrong. We have to capitalize. Don't get to that conclusion. Sir, is that clear, sir? With which we are closing this question CRD 5. Sir, I can say other questions. One is based on life. It cannot be 15 years. It can be only 10 years. And the other question, this is also based on production. So what will be the production? Based on the production only, in that ratio only amortization should happen. Then here also you should consider only 10 years. Initially, okay, amortization was not done till now. We will do amortization. For the past period, we have to treat it as prior period, because to be provided and not provided. For current year, we'll write normally amortization or depreciation. Like that, we have to record the entries. So with this, we are closing AS 26. So still how many standards are left? 4. I think in this session, 3 standards are completed, 19, 20 and 26. Still the standards left are 22, 17, 24 and 29. So I'll complete in the next session 22, 17 and 29. So based on the time, if because AS24 takes 15 minutes time, sir, that's all. Based on the time, if these three together itself takes 8:05, we'll close it. Or else if it completed by 7:55, we'll take the 10 minutes and by 8:05, we'll try to complete AS24. Depending on the scenario, we'll complete it, but leave it. AS24 is a chota standard and usually not asked in exam. Okay, so with this totally 9 are completed, 8 are completed. We'll complete the balance 4 in the next session. Okay, right. Thank you. Bye bye.
బాయ్స్ బ్రేక్ వెళ్ళనమ్మా ఫస్ట్ బాయ్స్ బ్రేక్ వెళ్ళండి
Good evening, everybody. Sit down. Okay. Everybody, are you all ready, sir? Okay, right. Now, let us deal with the new standard, sir, which is AS 22. What is the name of the standard? AS 22, accounting for taxes on income. Accounting for taxes on income. Actually, this is a standard brought from CA final, sir. One of the standards brought from CA final to CA int. And in fact, the level of standard also definitely beyond your level, what we learn in usually CA int. So in fact, in examination also, they focus on some basic aspects only, sir. They don't want to test you a lot. Previously, they used to cover almost all the concepts, at least by giving some simple questions. Maybe in the last attempt, when they have changed that material, last edition material, they have reduced the number of questions also in the study material. Previously, if 7 questions were there, now they have reduced to 4 questions. That means ICAI itself is indirectly telling that you need not compute or learn all the concepts in this standard. But anyway, first you should be clear with respect to basics, which they regularly focus in the exam. What are the basics, sir? That only first we will discuss. First, if we are good enough in understanding the concepts, all the basics will be crystal clear, sir. First, we should understand the concept well. What is this deferred tax? What is deferred tax asset? What is deferred tax liability? What is timing difference? What is permanent difference? What is accounting treatment for a DTA, DTL? These are the basic issues, sir. In examination, they want to focus on these basic issues only. First, if you are clear with respect to these basic issues, then some advanced will be there. Of course, some good concepts like tax holiday. Some of the other issues will be there. That also we will learn. First, let us concentrate on the basic issues. I am dealing with this as if I am teaching in a regular class now. I'll just start it afresh. But of course, because to save the time, I have already written some numbers. So already I have written some numbers so that I could save the time. So we'll deal with afresh, sir, as if it's a fresh. Nothing is known to you, but just everything will complete within that 1 hour or max 1 hour 10 minutes. Shall we start, sir? Okay, right. Now, listen carefully, sir. I am taking some data first. I am taking some data where accounting profit is 200 lakhs. How much, sir? Tax also 200 lakhs. Initially, taxable as well as accounting income, both are what, sir? 200 lakhs. First, you should know clearly what do you mean by accounting income and what do you mean by taxable income. Usually, accounting income means this one, sir, as per the standard, which is PBT. What is accounting income as per the standard? PBT, the net profit before tax. Whereas taxable income is this one. That means on which tax will be computed. Taxable income is the income as per income tax law. Over. What is taxable income? Taxable is the income as per income tax law. Now anyway, just to make you understand the concept, I am giving some profits, sir. I am there in year 1. Which year, sir? Year 1. Profits before depreciation. In accounts, how much, sir? 200 lakhs. In taxation also 200 lakhs. Now there was a depreciation. For this, let me give you information. Let us say cost of the asset is 120 lakhs. How many lakhs, sir? 120 lakhs. And assume that life is 2 years. How many years? Actually, life will be more. Just to make you understand the concept, I am taking only 2 years. Life is how many years, sir? 2 years. Now, sir, if it is accounting, how do you provide depreciation? On SLM basis. Am I right or not? Usually on the basis of life, 2 years is there. So we will provide every year 60 lakhs. Accepted. If it is taxation, how do you provide? Of course, based on the tax rates existing in Income Tax Act. Hello, the rates in Companies Act is different from the rates in Income Tax Act. But for the time being, because you might have several provisions where in the first year itself 100% depreciation will be provided. For just giving them some help, tax-wise help, we provide 100% depreciation. Maybe somewhere in PGBP you might have heard, sir. Hello, we provide maybe scientific research or some other whatever assets are there, we provide 100% depreciation. Let us assume we are taking such a scenario where in accounting we provide depreciation for how many years, sir? 2 years. Whereas for taxation we provide entire depreciation in first year only. That was the example I am taking. Is the discussion clear, sir? Now look here carefully. In the first year, now we are there in year 1, sir. Depreciation provided in accounts how much, sir? 60 lakhs. Depreciation provided in taxation how much, sir? 120 lakhs. Now can you please tell me what is profit before tax as per accounts? 200 minus 60, 140. Accepted. Now similarly in taxation, 200 minus 120, 80. There is this clear, everybody? Now we have to compute the taxes, sir, because from profit before tax, only if you reduce tax, we'll get the PAT. How do we compute tax, sir? Is it 30% on PBT or is it really tax on taxable income? Really tax has to be paid as per Income Tax Act only, sir. Hello? Tax has to be paid as per Income Tax Act. You cannot multiply with PBT 30% or 40 because really what we have to pay to government is only tax as per Income Tax Act. So thereby, tell me what is Income Tax Act income, sir? 80 lakhs. On that you have to apply the percentage. Let us assume 30% for the time being. Hello? Let us assume tax rate is how much, sir? 30%. Can you please tell me what will be the tax? So what will be the tax, sir? 24 lakhs. 80 lakhs into 30%, which we call as 24 lakhs. This is called as current tax. What we'll say? Current tax. Tax on taxable income is called as current tax. Tax on what? Taxable income is called as current tax. Okay. Now anyway, from PBT reduce the tax. What is PAT? Sir, from PBT reduce tax and tell me the PAT. 116. Accepted. Now come to year 2, sir. Hello, the same example. Let me see what will happen to year 2 profits. Assume that same level of profits are there before depreciation. Assume that same level of profits are there before depreciation. Year 2, tell me how much this year 2, sir. Year 2. How much profits was there? 200 lakhs in accounts, 200 lakhs as per taxation also. That means indirectly they said till now no difference in accounts and tax. Now only difference is going to be started. Okay, right. Now depreciation as per Companies Act. That means accounts. How much, sir? 60. Because already provided in last year only 60. Now in the current year we'll provide balance 60. So this will become once again 140. Accepted. Now tax how much, sir? Taxable 200 lakhs. Because depreciation already provided in the last year, current year it will be 0. As a result, this year taxable income will be 200 lakhs. Can you please tell me tax amount how much, sir? I think we have to apply on taxable income only. Whatever is there as per Income Tax Act, on that only we have to apply. So 200 lakhs into 30%. How much, sir? 60. How much, sir? 60 lakhs. Now can you please tell me what is the PAT here? What is the PAT here? 140 minus 68. Now I have a big doubt, sir. What is PBT in year 1? What is PBT in year 1? 140 lakhs. Very good. What is PBT in year 2? Once again, PBT in year 1, PBT in year 2. Super. What is PAT in year 1? 116. Year 2. Their accounting income is same in both the years, but you are telling me the final profit is something different. 140 PBT was there in year 1, where you are giving a net profit of 116 to the shareholders. Next year PBT was 140, but the profit you are giving to shareholders is only 80. What shareholders will feel? Something wrong is happening in the company. PBT is same, but still the PAT you are giving to the shareholders is getting different. Sir, are you getting the point? Something was there, some mistake was there here. In fact, what is the mistake existing here? Can you please tell me why there was a difference between PAT of year 1 and PAT of year 2, though the income is same? Sir, if income is different, I don't question you, sir. Income is same, 140 there, 140 in second year also, but why still there is a difference in PAT? Can you tell me reason, sir? Tax we have provided on taxable income. Whereas in Income Tax Act, no strict rules, sir. 1 year full, 1 year nil. Hello. So like that, in different ways, they are providing depreciation. If we follow Income Tax Act and provide entirely in first year, nil in all the next years, because now I have taken life 2 years, sir. If I take life 10 years, now all the 9 years difference will be there. Hello. Now I have taken life 2 years. If I take life 10 years, all the 9 years difference will be there. Am I right or not? Now, really, there was some problem, sir. Now, you cannot report to the shareholders in this way, sir. They'll get lot of confusion. Anyway, they'll have some basic confusion. If you create this one also, they'll not start reading financials only. Hello? Sir, are you getting the point? This confusion should not be there, sir. You should create clarity, not confusion. In fact, this is not a better reporting at all. When you're having some income, expense, tax expense should be corresponding to that, no? If you're having 140, then every year tax expense also should be corresponding to that. Suppose PBT in the next year is 120, then corresponding only tax expense should be there. If income reduces, tax expense also should reduce. Now what you are showing to the shareholders, your income is same, but tax increased from 24 to 60. Now it's not logical at all. You are not providing better presentation to the users. In fact, there is no matching. Hello, what is that? There is no matching between accounting income and the tax expense you provide. This is the purpose of the standard. The purpose of this standard is to bring matching. Hello, what is the purpose of the standard? Is to bring matching between what, sir? Accounting income and the tax expense. Then only proper PAT can be there, sir. Then only comparison can be there. Because ultimately, what the shareholders will compare every year, sir? PAT only. Now, if your PAT is being like this, what comparison can they do? What decision making can they do? Are you getting the point, sir? So, thereby, we are going to bring matching between accounting income and tax expense. For that, we are going to do some adjustment. These adjustments are only brought by AS 22. Why those adjustments are there means logic is simple. To bring matching between accounting income and tax expense. I'll show you now what we are going to do because of these adjustments. Now, actually, we are providing tax on what, sir? 80 lakhs. Am I right or not? What I say is don't provide an 80. Don't provide an 80. Provide on 140. What will happen, sir? What you are telling, sir? Just wait. Now, on 80, how much, sir? 24. On 140, if you have provided, how much will be the tax? 42. Now, what I will do is, temporarily, hello, what is that? Temporarily, I am going to add something called as deferred tax. Because this is not current year, I am going to defer it to future. Hello, this is not current year, I am going to defer it to future. Because payment I am not going to do, sir. Payment ultimately as per Income Tax Act. Companies Act cannot go and question Income Tax Act. Hello, you cannot stop the payment of 24. Payment should be 24 only. But what Companies Act can do, what standards can do, they can change the expense booked in P&L. Hello, please understand, you cannot change the payment of 24. Just because standards say do adjustment, you cannot pay higher payment or lower payment to Income Tax Department. Payment will be same, sir. The payment you made to Income Tax Department is current tax, sir. We don't change it. Our problem is just how expense you are booking. We are going to just change the booking of expense in the P&L. What I am going to do? To make it uniform, to make it comparable, I am going to book some extra expense. Hello, I am going to book some extra expense. So how much, sir? It is 24. How much is the difference? 18 lakhs. Now on a net basis, how much I will show is 42. As a result, my PAT will not be 116. My PAT will be 98. Accepted. Now come to the next year. What I will do, sir? Tax is how much? 68. 200 into 30%. Now I want it to be tax rate on 140. Am I right or not? This is current tax, sir. Whatever we have computed on 200. Now what I am going to do? To bring it to 42, should I add or reduce? Reduce. I will reduce deferred tax 18. Thus I will get 42. Once again this will be 98. Sir, on a net basis, are you doing anything big difference to the expense? No. Last year, whatever you have added, next year you have reduced. On a net basis, I have not booked 1 rupee extra also, sir. But I just changed the timing of the booking expense. I have not changed or booked 1 rupee extra. My booking of expense is same. But I want to change the timing, then only corresponding tax expense will be there. Now if you observe in first year and second year, what is the tax expense, sir? 42 only. What is the PAT, sir? 98 only. As a result, good comparison can be shown to the shareholders. Income is same. Now as a result, PAT also will be the same. In this way, comparison should be there. Now whatever adjustments we are doing are because of AS 22. Why we are doing? To bring matching between accounting income and tax expense. Now let me tell you how this 18 came. Hello? Let me tell you how this 18 came. Now in the first year, what is the depreciation expense you have provided? 60. Here 120. If at all they are also 60, will there be any difference? No. So what is the difference of expenditure here? 60. Now this 60, of course, the difference of income also same. Because of that reason only the difference came, sir. 60 lakhs. Tell me into tax rate how much, sir? 18. Into tax rate 30% gives you 18. This difference was created in year 1 and the same is reversed in year 2. Hello? Ultimately, we don't want to change 1 rupee expense also. What we are doing, we are just changing the timing. 1 year we are increasing, 1 year we are reducing. Why, sir? To bring matching. Are you getting the point, sir? Now, let me tell you what is the name of this tax. Shall we call it as deferred tax asset or shall we call it as a deferred tax liability? Now, please observe carefully. To decide whether it is an income tax asset or income tax liability, that is deferred tax asset or deferred tax liability, you have to start your base with taxable income. What is that, sir? Your base should be taxable income. Now, tell me, taxable income is how much, sir? 80 lakhs. It is greater or less than accounting income? Less than accounting income. Actually, your income was quite proper as per books of accounts, which is 140, but you have paid a tax on only 80. That means have you paid less or more tax? Compared to accounting, have you paid less tax or more tax? Less tax. Actually, you should have provided on 140, but because of the exemption given in taxation, you have your profit is only 80, but otherwise it could have been 140. You have paid less tax, accepted, because you have not paid also, you are booking less tax. You are booking less tax as a expense. That's why we will book the balance liability also. We have paid less. Balance is payable. Am I right or not? It's a liability. Am I right or not? That's why this is a deferred tax liability. Hello, this is what, sir? Deferred tax liability. This is creation of deferred tax liability, sir. Deferred tax liability was created in this year. Now, in the next year, tell me, is it a new difference created? Is this a new item? No. The same item, because last year itself 120 lakhs provided, current year nothing provided in tax. Now, the same difference is getting reversed. If you observe, now in this year, tax deduction was higher, 120. In this year, in accounts deduction was higher, 60. Sir, are you getting the point, sir? Now the difference is getting reversed. Overall, depreciation there or here, how much, sir? 120 lakhs only. That 120 lakhs is only getting depreciated. Amount is same, sir. Timing is different. That's why these are called as timing differences. Hello. Something I'm telling, sir. Amount of depreciation same or not? Yes. But still, the timing of the expenses provided is different or not? Yes. In both accounts and income. That's why this is called as timing difference. Sir, due to any timing difference, if accounts and taxable income is changed, then only you will get the concept of deferred tax. Are you getting the point, sir? Here, because taxable income is less than accounting income, that means you have paid less tax is booked. Now you book the balance liability, payment will be done in the next year later on as per income tax side. Now you book the balance liability, so thereby it is called as deferred tax liability. How do you book a liability? Will you credit it or debit it? How do you create a liability, sir? Will you debit or credit? Credit. So thereby, of course, because you are charging to P&L as a expense, so entry will be P&L account debtor to DTL, deferred tax liability. Accepted? Have you all understood, sir? This is creation of DTL because you are creating a liability. Liability has to be credited and you are charging the same to P&L. Entry will be P&L account debtor to DTL. And anyway, for your current tax, you will write the entry P&L account debtor to current tax. That is also a tax expense. Sir, current tax plus deferred tax is called as tax expense. Current tax plus deferred tax is called as tax expense. Because in books of accounts we reduce tax expense. That's why in all other chapters you are going to multiply directly based on PBT. In all other chapters you usually multiply tax rate with PBT to get the tax amount. Am I right or not? Now how it is matching? Because of this only. Because in all other chapters we assume that deferred tax is 0. In all other chapters we assume that deferred tax is 0. That means we are assuming that there is no difference between accounting income and taxable income. If there is difference, we'll create something called as deferred tax and once again we'll bring matching. Hello? We assume that difference is not there. If difference is there, we'll bring an adjustment in the form of deferred tax and we'll bring the matching. Is that clear, sir? So this is called deferred tax, that whatever adjustment we are doing is called as deferred tax because we are booking extra liability, extra tax liability, extra tax expense. It is called as deferred tax liability, DTL. For current tax also, this is the entry, sir. Totally in P&L we are charging tax expense. That is the concept. Discussion clear? Come to second year, sir. In second year, what is happening? Sir, here once again, to decide what it is, we have to observe taxable income. In second year, taxable income is what, sir? Sir, this is year 1, sir. Come to year 2. Taxable income is what, sir? 200 lakhs. Accounting income is what, sir? 140 lakhs. Higher or lower? Taxable income is higher. Now, if taxable income is higher, that means you will pay more tax. Am I right or not? Compared to accounts. Compared to accounts, you are paying more tax. Now the question is, why you are paying more tax? Is it because you have paid less in the last year? Or first time you are paying more tax in the current year? Because you have paid less tax in the last year. It is just like your outstanding salaries, sir. Last year, there is an expense for which you have not made the payment. How you will write, sir? Salary to salary payable, P&L to salary. So we are writing a combined entry, P&L to salary payable here. Salary to salary payable, P&L to salary. Here we are writing combined entry, P&L to salary payable. Instead of salary payable, we are writing deferred tax liability. In the next year, what you will do? Salary payable is there. You have to charge to P&L now. In the next year, what you will do? Of course, already charged to P&L last year. You have to make the payment now. You will write, of course, you will make the payment. Are you getting the point? But we will not do like that. When we are computing expense for the year, opening outstanding, what we will do? When we compute expense, closing outstanding means we will add, opening outstanding means we will reduce. Because from the expense paid, we have to reduce opening outstanding, then only we'll get the current year. Now, this is the total expense paid. How much, sir? 60. From that, if I reduce that opening outstanding, then only I'll get the proper expense. That is what I am doing. Now, this is not a prepaid expense which is created. This is outstanding expense of last year we are paying. That's why expense paid is more. So, I don't call it as deferred tax asset. If I pay first time extra, if it is like a prepaid expense, we will call it as deferred tax asset. Now it is not prepaid expense. Last year outstanding, now we are paying. This is called as reversal of DTL. Hello, what is that, sir? Reversal of DTL. What is the entry? Because opening outstanding has to be reduced from the expenses, we will write reversal entry. Anyway, liability reversal means we have to debit. Balance aspect is P&L over. Hello? Anyway, liability reversal means what we have to do, sir? Debit. Balance will credit to P&L. Is the discussion clear, sir? Current tax normal entry, sir. P&L to current tax. If you want now, you could observe net amount to P&L. Because P&L to current tax, how much we'll write? 60. And then DTL to P&L, how much we'll write? 18. As a result, net amount will be 42 only. That is what? Tax expense. In the first year, here 18, here 24. Net amount will be 42. So in P&L, tax expense will be the same. Sir, have you all understood? So what is deferred tax? For those timing differences which are created, we will create DTL or DTA. Of course, here what is there, sir? DTL. Sir, have you all really understood? If you have really understood, I'll take another example where you should bring me the answers. With that, we are going to learn about DTA or DTL. Anyway, you have to tell me. Shall we proceed, sir? Example 2. Still once again for understanding concept. Don't worry. Once we understand the concept, quickly we can complete balance issues. Not an issue. Now, understanding the concept once again. Look here carefully. Year 1. What is the income, sir? 200 lakhs. 200 lakhs. Year 2 also assumed that it is 200 lakhs and 200 lakhs. Now our area is not depreciation. I am going to take another area. Interest. Hello, what is that? Interest. I think how do we pay? How interest is booked, sir? In in Companies Act, how do we book? Whenever it is incurred, it is allowed as a deduction. In Income Tax Act, how do you allow interest? When interest will be allowed as deduction? Same year or the next year? Same year or next year? Maybe you might have heard something 43B. Hello, interest, cesses and duties, taxes like this, you might statutory dues. Like that you might have heard about 43B. What is 43B in Income Tax Act? If you make the payment before the due date of filing return, then reduction will be allowed in the last year itself. If payment is done for that after filing due date of return, so in other words after the due date of filing return, then because due date also over, you cannot include in the last year return. It has to be computed as expense only in the next year. Income Tax Act says only one thing: you take interest as deduction. I don't have any problem. For that, first you make the payment. Income Tax Act don't have any problem, sir. It will allow you to take deduction. For that, first what should happen? Payment. And it is telling, suppose it is relating to 1920. If you have paid in 1920, well and good. Sir, 1920 not paid, money is not there. Okay, I am giving you chance. I am giving you chance. If you pay before due date of filing return, then even by that time you can include in your last year return. That means in last year only I will allow you deduction. If return itself is filed, how could you allow you, sir? So I will allow only in the next year. Sir, is this point clear? Now what we are taking an example is interest for the year 1920 paid in 2021, that too after filing the return. Sir, is that clear? That means this interest will be allowed as deduction in accounts in which year? 1920. This will be allowed as deduction in tax in which year? 2021. Because it was not paid before due date of filing return. It was paid after due date. If it was paid before due date, it will be allowed in the last year only. Then difference will not be there. Then I will not discuss in this class. Hello? Are you getting the point, sir? Discussion is required only when difference is there in accounts and taxation. Now, because it is after due date of filing return, deduction is there in accounts in last year, whereas deduction will be there in tax in the next year. Is that clear? Now, first to call it as timing difference, expense should be same, but just a timing should be different. Amount of expense is same or not in both the scenarios? Yes. What is different, sir? Timing. In accounts, in 1 year. In taxation, another year. Sir, is the discussion clear? Now, can you please tell me the adjustments that we should do? In first year, accounts. Tell me, PBT, how much it became? 180. Tax, 200. Now, what is current tax, sir? Nothing but tax on taxable income, 200 into 30%, 60 lakhs. Now, can you please tell me what I should do? Shall I take 60 lakhs only as tax expense? No. It should be proportionate, corresponding, matching should be there. For that, what I should do? What is 180 into 30%? You should bring matching. What is the difference? What you should do? Add or reduce? So minus deferred tax. 6. How do you get this 6? If anybody asks you, what you will say? 20 lakhs into 30%. This 20 lakhs into 30%. Clear? Clear? Okay. Come to year 2. What is accounting income? 200. Taxable income 180. Why? Deduction was given. Now what is the tax? 54. 180 into 30. This is what? Current tax. Now can you please tell me how much it should be? 60. I have never said both year tax expense should be same. I said it should be matching. That's all. So 200 into 30%, 60. So how to bring it 60? Add deferred tax. 6 should be added. Now can you tell me the PAT? 180 minus 54, 126. This is 140. If you show to shareholders, will they have confusion? No. Because last year PBT is 180, so PAT is 126. Current year PBT is 200, so PAT is 140. Correspondingly only it is there. Now they don't have any confusions. Please understand, sir, expense is same, but because of the difference in accounts and taxation, why we should confuse the shareholders? For that purpose only, we are bringing matching between accounting income and the tax expense. To make it match, we will do some adjustments. That adjustments only brought by AS22. Depending on we are booking the expense or we are reversing the expense or we are doing something else, we are going to write it as deferred tax asset or liability. Now once again, what is the base taxable income? Year 1, what is the taxable income, sir? 200. What is the taxable income? For that should be only base, sir. 200 lakhs. What is accounting income? 180 lakhs. Now can you please tell me, taxable income is higher or lower? Higher. If taxable income is higher, will you pay more tax or less tax? More tax. More tax means first time because of any previous effect. First time if you are paying more tax without recording expense, it is what? Like a prepaid expense. So it is an asset for you. Hello, it's a prepaid expense asset for you. How do you create a deferred tax asset? Asset means will you debit or credit? Debit. Entry should be deferred tax asset to P&L. Clear, sir? Now current tax will write normally. P&L to current tax. If you want, you can substitute the values, sir. So which is 60 is the current tax, whereas this is 6. On a net basis, P&L is how much, sir? Debited by 54. That is what happening. Sir, have you all understood? This is the entry for deferred tax. Is this creation or reversal? Creation. Because first time we are paying more tax. If we are paying more tax because of paying less in the last year, that is reversal of DTL. Now we are paying first time more tax. This is what's the creation of deferred tax asset. Now come to year 2, sir. Everybody. Once again, you have to take what as a base, sir? Taxable income. What you should take, sir? Taxable income. So what is taxable income in year 2? What is taxable income? 180 lakhs. Accounting income. Higher or lower? Lower. That means if taxable income is lower, the tax you pay will be less. Why you are paying less tax? Is this first time? Because you have paid more tax in the last year. Because I have paid more tax in the last year. It is just like last year prepaid salaries. Last year closing prepaid means in expense computation, what we might have done, sir? In expenses, we will reduce closing prepaid. Now, if it is opening prepaid, what we have to do? We have to add. That is what we are doing, sir. For current year, we are adding opening. Because payment only was done in the last year, but expense has to be there in the current year. That's why we are adding. What is the entry, sir? Now, because you have paid less tax in this year, now you have to hello, is it booking liability? No, reversal of the asset. So how do you reverse an asset? Credit it. So automatically balance to P&L. P&L to DTA. P&L to current tax is as usual. So amounts will be 54 and 6. As a result, 60 tax expense is booked. Sir, have you all understood? Everybody, is that clear, sir? What is the purpose of AS22? Have you got an understanding? It is to bring matching between accounting income and tax expense. So that means, tell me one thing. So will always there is a matching between accounting income and tax expense? Will there be always matching or not? Wherever difference is there, we are adding, no? So will there be matching or not? Will there be matching or not? Yes, there will be matching, provided there is no permanent difference. Something I have said, what I have said. There will be matching, provided there is no permanent difference. Sir, sometimes an expense may be allowed in accounts, but never allowed in tax. What I have said is, expense is there in accounts, expense is there in tax, but timing is different. Then I will help you to book, then I will help you to change the timing. If it is not at all there in one aspect, I cannot help you at all, sir. I can help you if there is expense in both the scenarios, if there is income in both the scenarios, but timing is different. But if one area expense, another area expense is not there, one area income, another area exempt, that income is exempt in Income Tax Act, I cannot help you, sir. If the difference is in only timing of that, I'm going to help you. That means total expense in accounting is same, total expense in taxation also same. I will help you, sir, because only timing is different. Total expense in accounting not same as total expense in tax. I cannot help you. That is permanent difference. That means still there may not be matching between accounting income and tax expense. When it will happen? When there is permanent difference. When there is permanent. In other words, when deferred tax concept will apply, it will apply only when there is timing difference. If it is permanent difference, AS22 will not come into the picture. It will not help you in the form of deferred tax. Deferred is nothing but deferral. We are deferring the time. When the timing will be differ, only if it is timing difference. If it is permanent difference, how it can differ, sir? How it will differ over the period? So that's why please understand, deferred tax definition will be like this, sir. Deferred tax refers to tax effect of timing difference. Hello, what is that? Tax effect of on timing difference. Compute what is the timing difference, multiply with tax rate, you will get the deferred tax over. Hello? Compute what is the timing difference, multiply with tax rate, you will get the deferred tax computation depending on first time expense creation or reversal. First time we are paying more or the other one we have to call it as asset or liability or reversal of asset or reversal of liability. Sir, is that clear, sir? So let me conclude, sir, in the form of a summary. Please observe. I'll just show you. AS22. Already I have given a chart in the material. I'll just show you that chart. Because once the chart is understood, majority of the aspects which are regularly asked in exam will be completed, sir. Let me show you. So please observe this, sir. AS22 application difference. The differences are of two types. One is timing difference, the other one is permanent difference. If anybody asks you what is timing difference and what is permanent difference, timing differences means those difference which originate in one period and are capable of reversal in another, because overall expense should be same. What is permanent difference? Which originate in one period and do not reverse. That means expense will be, difference will be there permanently. So that is what the meaning, sir. Now anyway, let me show you that chart. Sir, first, whenever we are applying AS22, observe, is there any difference? Difference there? Okay. Which difference? Timing or permanent? If it is timing, then analyze whether, sir, if it is permanent, we'll ignore, sir. AS22, not applicable. Ignore. If it is timing, then check whether taxable income is more or taxable income is less. If taxable income is less, that means you are paying less tax. If you are paying less tax, two reasons might be there. It is first time or because you have paid more in the last year. If it is first time you are paying less tax, that means you have to book the balance tax expense. We will call it as creation of DTL. That's why entry will be P&L to DTL. Accepted. Suppose I am paying less only, sir, but it is not first time because I have paid extra in the last year. Now I am paying less. Because I have paid extra in the last year I might have created asset, deferred tax asset. Now I will reverse it. It is called as reversal of DTL. Sir, when taxable income is less than accounting income, two scenarios are possible. Either it may be creation of DTL or reversal of DTA. What we have to apply? If it is first time, creation, already something occurred, reversal. So it is reversal of DTA. Here also P&L will be debited, DTA will be credited. Because asset reversal means asset has to be credited. We have to debit the P&L. The discussion clear? Suppose taxable income is greater than accounting income. I think you are paying more tax. First time if you are paying more tax, it is creation of DTA. No sir, already paid less. Now I am paying more. Already paid less means last year outstanding. Hello, this year your last year liability might have been created. Now it's a reversal. So it's a reversal of DTL. Entry will be DTL to P&L. Sir, have you all understood, sir? This chart itself is very, very important because they are asking more in basics only, sir. And if you know this chart very well, basics can be done very quickly, sir. This is the most important chart for solving the basics. Okay, right? Before proceeding, anyway, I think I have given you the entries, sir. P&L to current tax for current tax. If it is deferred tax liability creation, P&L to deferred tax liability. Then in the reversal, P&L to current tax liability reversal means DTL to P&L. Asset means P&L to current tax, DTA to P&L when it is creation. Reversal means P&L to current tax, P&L to DTA. Asset reversal. All those entries also have given, sir. Next, this is one more important because in examination they will give you different scenarios. First you have to analyze whether it is a timing difference or permanent difference. Are you all understanding? Let me deal through some questions only whether it is timing difference or permanent difference so that you will have clarity. Please observe carefully CRD1. The following particulars are stated in the balance sheet of Deep Limited as on 31st March 2020. Deferred tax liability credit balance, deferred tax asset debit balance. Already there are some balances. When you are telling P&L to DTL, the balance will be there. No, it will not be closed. It's a liability account. So thereby they are giving some balances. Now depending on the transaction, either we have to increase the liability or decrease the liability or increase the asset or decrease the asset. Now the following transactions were reported and ultimately what you have to show? You have to require to show the impact of above items on deferred tax assets and deferred tax liability. Let me start one by one. The following transactions were reported. Depreciation as per books of accounts was 70 lakhs and for tax purpose was 42 lakhs. Tell me, what is this? Very simple. You have to look due to this taxable income will be more or less in that way comparatively. Now more depreciation where, sir? Books of accounts are taxation or otherwise look from taxation angle. Depreciation expense is higher or lower? Lower. If less expense in taxation means income will be more. Expense tax will be more. You are paying more tax. Hello, you are paying more tax. If you are paying more tax, now the question is, are you paying first time or because you have paid less in the last year? Now do you think first year or no clarity? Yeah? Depreciation we are paying, is it first year or later years? I'll give you one clarity, sir. You should know one basic principle, sir. Generally higher depreciation will be there in initial years for taxation when compared to accounts. You should know one aspect, sir. Higher because WDV rates as per Income Tax Act higher than rates as per Companies Act. Let me give you one logic, sir. In income tax, we don't want to take depreciation for longer years, sir. We want to claim the expense as quickly as possible. So usually rates will be higher, whereas Companies Act rates will be lower. So as a result, higher depreciation will be there for income tax purpose in the initial years. Later on, slowly, later on what will happen, sir? Higher depreciation will be there for books of accounts. Then tax wise it will reduce. In the initial years, depreciation will be higher in which books? Taxation. In the later years only, depreciation will be higher for books. So that means it is very clear when depreciation was higher in books, it may not be first year, it may be future years only. That means in the first years, depreciation might be more in taxation. That means more expense in tax means income will be less, tax will be less. You might have already paid less in the last year because you have paid less in previous years. Now you are paying more. That means already you might have created a liability. Now it is reversal of liability. The first one, have you all understood? This is what, sir? Reversal of DTL. Already I have explained about depreciation, but a new point where we have to see whether it is first time or reversal. For that I have given you logic. Sir, is that clear? Now let me move to the second aspect. Expenses disallowed in 1920 and allowed for tax purpose in 2021 were 14 lakhs. Now what about accounts, sir? They have not said. This is for taxation. They have not allowed in 1920, allowed in 2021. For accounts, 1920 only they might have allowed. Generally accounts no big, we cannot disallow anything, sir. Disallow will happen only in taxation. Now tell me, is it a timing difference or permanent? Timing only. Depreciation always timing. That's why I have not discussed. But this is we have to discuss, sir. Is it timing or permanent? Timing. If it is timing, deferred tax will be there. Now tell me, first of all, this in this year in tax more expense was there or not? Accounts nil, whereas in taxation high. So thereby in tax more expense means income of tax will be less. That means tax we pay will be less. Are we paying first time less tax? Because we have paid more tax in the last year, we are paying now less. Already interest was provided. Something was there in the past. That means definitely it's not a creation, it's a reverse. We need not analyze last year's data. Just we should know, is it first year or further years? If it is further years, definitely it cannot be origination most of the times. So it will be only reversal. So already more tax paid in last year. More tax only, yes. So thereby deferred tax asset of last year. This year we are paying less tax. So thereby it's a reversal of deferred tax asset. So reversal of DTA. DTA balance we have to reduce. They're accepted. Basics only tested more, sir. That's why I'm focusing more on this basics. Next, look at the third point. Share issue expenses allowed under section 35D of the Income Tax Act is 1/10 of the 70 lakhs incurred in what, sir? 1920. So total expense incurred how much? 70 lakhs. In books of accounts already entire 70 lakhs might have been provided as depreciation in 1920. Whereas in taxation, maybe you know section 35 where you will provide over the period. Now tell me, sir, we are there in first year or second year? Second year, 2021. So definitely it may not be origination, some reversal only. But let us see, sir, in the current year, accounts expense how much, sir? Nil, because last year only fully provided. Tax expense how much, sir? 70. More expense in, sorry, not 70, 1/10 of 70, 7 lakhs. Okay. Anyway, more expense in tax. So thereby taxable income will be less. The tax you pay will be less. Are you paying less tax first time? Or because you have paid more tax in last year? Because you have paid more tax in the last year. So that means last year a deferred tax asset might be created. Now there's a reversal of DTA. Have you all understood, sir? DTA balance you have to reduce. Next, point number 4. Repairs to plant and machinery made during the year for 140 lakhs and was spread over the period 21 and 22 equally in books. In taxation, what happened, sir? Entirely in 1 year. Whereas in books, equally in 2021 and 2022. Now, is this the first year or second year? First year, 2021. Hello, this is first year. Now, tell me, in books of accounts, how much expense? 140. Sorry. Books of accounts, 70. In taxation, 140. More expense in taxation. Taxable income will be less. So, thereby, tax you pay will be less. First time you are paying less tax. So, it is what, sir? Creation of DTL. So, increase in DTL or creation of DTL. In this way, you have to observe. Sir, everybody, have you all understood this concept? Sir, is that clear? Okay. CRD2, actually, here there will be some good concept called as virtual certainty, reasonable certainty and virtual certainty. But anyway, we can solve based on our discussion also, sir. Let me show you. Depreciation as per accounting records how much, sir? 2 lakhs. Depreciation as per income tax record how much? 5 lakhs. Tell me, now, is it timing difference or not? Yes. Higher expense in where, sir? Income Tax Act. So, thereby taxable income will be low. Tax we pay will be low. Okay. First time are we paying less tax or because we have paid more tax in the last year? Observe, logic. In the first years, I think income depreciation will be higher in income tax. Later on, depreciation will be higher in Companies Act. So, I think depreciation is higher in Income Tax Act. That means it might be the first years. So, thereby first years means creation. So, tax you are paying is less. So, it is creation of liability. Creation of DTL. It's a deferred tax liability. How much, sir? What is the timing difference? 3 lakhs into tax rate. I have said you, sir, tax effect on timing difference. So 5 lakhs minus 2 lakhs, 3 lakhs into tax rate 30%. You will get that 90 lakhs. 3 lakhs into 30%. Sorry, 50% in this question. So into 50%, 1 lakh 50. Is that clear, sir? Next one. Unamortized preliminary expenses as per tax record. Unamortized preliminary expense. Sir, in Companies Act, preliminary expenses will be charged to P&L in the first year only. As per Companies Act, first year only entire preliminary expenses should be charged. The taxation you can defer it over the period. Now tell me, here what is happening, sir? Unamortized expenses in tax. That means still there is some expenses in taxation, sir, but everything booked in accounts. Look at the first year, what might have happened? In the first year, more expense might have been there in accounts, less expense in tax. If there is less expense in tax, that means taxable income will be higher. Tax you pay might be higher. So more tax you have paid. First time it will be creation of DTA. From the next year onwards, it will be reversal of DTA. So if it is first time, because still we are telling unamortized is there, assuming that first year only that expense was done, balance unamortized expense they are giving. So this is a creation of DTA. From the next year onwards, what will happen? It will be reversal. Sir, is that clear, everybody? In the question they have not given when we are discussing, is it first year or second year? Now we are assuming in this year only preliminary expenses were incurred and entire was charged to P&L in accounts, whereas in taxation something provided, but still this much is unamortized. Maybe if you assume as 5 years, 5 years may not be proper. Okay, let us assume 4 years, then 40,000. Let us assume 40,000 entirely in accounts, 10,000 only in tax. So thereby 30,000 is still unamortized. Sir, is that clear? Or if you take 5 years, assume as 37,500, then 37,500 fully provided in taxation accounts. Only 7,500 provided in tax. So still 30,000 is unamortized. What is the difference? 30,000. 30,000 into 50%. 15,000 only will be the deferred tax asset. Sir, have you all understood? Everybody discussion clear? Let me move to question number 3. Sir, I am teaching as if I am teaching first time. You might observe it. But taking something quickly. But I can say, even if you have not learned anything before also, you will understand all the aspects I am teaching now. Right. Let me move to question number 3. Omega Limited is working on different projects which are likely to be completed within 3 years period. Hello, how many years period, sir? 3 years period. It recognizes revenue from these contracts on percentage completion basis for what, sir? For what, sir? Financial statements. For books of accounts, they are applying percentage completion, maybe as per AS 7. During 14-15, 15-16 and 16-17 for how much, sir? 11 lakh, 16 lakhs and 21 lakhs. However, for income tax purpose, now it has adopted completed contract method under which it has recognized revenue of 7 lakhs, 18 lakhs and 23 lakhs for 14-15, 15-16 and 16. So first of all, tell me, is it timing difference or not? Compute the total. For 11 plus 16 plus 21, 48. Here also 25 plus 23, 48. Total income here, I think it is income, sir. It is not expense, income. Total income is same, but just timing is different. Sir, is that clear, sir? Now let us observe. First year. Accounting income, how much, sir? 11 lakhs. Taxable income, 7. Income is low in taxation. So that means taxable income also will be low. Sir, income is low. That means taxable income also will be low. That means less tax you will pay. So if you are paying less tax, is it first time or because of previous? First time. First time if you are paying less tax, it is what, sir? Creation of DTL. First year DTL, deferred tax liability will be created. How much, sir? What is the difference? 4 lakhs. 11 lakhs minus 7 lakhs, 4 lakhs. What is the income tax rate? 35%. 4 lakhs into 35%, 1 lakh 40. First year 1 lakh 40 will be the deferred tax liability. Is that clear, sir? Now come to second year, sir. What is happening? Income in accounts is 16 lakhs. Incomes in taxation is 18 lakhs. Are we in taxation higher income or lower income? Higher income. More income means more taxable income. That means more tax we are paying. are we paying more tax for the first time? We have paid less in last year. Less. Already we have paid less in last year. So already when we have paid less in last year, we might have created DTL. So now it is reversal of DTL. So how much, sir? Once again observe the difference. 16 minus 18, 2 lakhs into 35%, 70,000 reversal will happen. So reversal will be there, sir. As a result, cumulative amount will be 70. Come to the last year, this is 21 and this is 23. Which is higher? Taxable income. So thereby, if taxable income is higher, more tax. Are we paying first time or because we have paid less tax previously? Less tax previously. So it is reversal of DTL. What is the difference? 2 lakhs into 35%, 70,000. Once again, here also reversal. At the end, balance will be nil. Have you all understood? With this question number 3 also completed. Sir, discussion clearer till now? Sir, shall I proceed further? With this, some important concepts are completed. Now, various timing differences we have seen, sir. Now, if you have time later on, you please look after the list of other differences also we have given in the table, sir. Most of the things will be same. Suppose 40A3 cash payment is there. Cash payment exceeding 10,000. It will be allowed in accounts, but it will not be allowed in tax. It is a permanent difference. Suppose goodwill written off, charged to P&L in accounts, but never allowed in tax. So thereby it's a permanent difference. Any provisions, this year it will be provision, somewhere it will become actuals, no? Or at least net effect will be there. So provisions are usually what, sir? Timing difference. You please remember, because this provision current year, next year it will become actual. So usually what, sir? A timing difference. Donation to private trust. These are some disallowed expenses, sir. If expenses are disallowed in Income Tax Act, definitely that will lead to permanent difference. If income is exempt in income tax also, that also it will lead to permanent difference. The discussion clear now. Another last one. Unabsorbed depreciation or carry forward of loss. Now tell me, what is unabsorbed depreciation, sir? More depreciation was there. Whatever is the amount of depreciation, I think we will provide in accounts, even if it leads to losses. In Income Tax Act, so if the depreciation is higher than the taxable income, gross total income, I think we will not provide. We will carry forward it to future. Unabsorbed depreciation can be carried forward for how many years? Unlimited. Whereas loss can be carried forward for 8 years. Am I right, sir? So now you could observe depreciation here and there, total will be same or not? Yes. Whereas losses carry forward, in this year entire loss will be booked in accounts. In taxation over 8 years. Now you may say, sir, what if 8 years we are not having profits? That means if this loss is not sufficient, then it will become permanent to that extent. But we take an assumption that within 8 years, that loss will get reversed. In such a case, total loss and total depreciation is same. There is also timing difference. Now, because more expense will be there in accounts and less expense will be there in tax. Less expense in tax means what, sir? More taxable income, more tax we might have paid in the first years, DTA in first years, later on every year reversal. But there is one point, sir, whenever in the case of unabsorbed depreciation or carry forward of loss, in other scenarios we never talk about this DTA discussion. Maybe in interest also 43B, I think we have created DTA only in the first year. Now I will never say there, but here we say one thing, sir, virtual certainty is required. What is required? What is this virtual certainty? Sir, today you are telling DTA. Why, sir? In future, it may reverse. In future, it may reverse. Now, my question is, first year, loss was there. Why depreciation was unabsorbed, sir? Your income was less. Or why loss was carry forwarded, sir? Because your income was less. Second year, once again, loss. Will that carry forward loss be adjusted? No. Third year, once again, loss. Will that carry forward loss be adjusted? No. Fourth year, over. Hello, company liquidated. Company liquidated. Now, do you think that loss gets adjusted? No. Usually, when there will be a scenario of unabsorbed depreciation or carry forward of loss, when the financial position of the company is not good. Sir, when there will be unabsorbed depreciation or carry forward of loss, when the financial position of the company is not good. If the financial position is not good, I will not allow you to create today an asset. Deferred tax asset. I will allow provided you give me a strong proof that in future, sir, I am having contract from so and so customers, definitely I will generate business, definitely I will have revenue. Like that, if you show a binding agreement which is already entered, then only I will allow you to create DTA. Otherwise, I will not allow. But if it is normal scenario like interest 43B, where we have created DTA, we say, will you have profits in future or not? Yes. Then reversal is also possible. There we don't say anything. Reasonable certainty is sufficient. Here we say virtual certainty. That means a strong proof, binding agreement is required. Then only we will allow you to create the asset. That is the concept of creating DTA in the case of unabsorbed depreciation. Is that clear, sir? That is what I have written here. In the case of rules for DTA creation, in the case of unabsorbed depreciation and carry forward of losses, it is virtual certainty. What is required, sir? Virtual certainty. Strong proof is required. In other cases like 43B payment, preliminary expenses, we are creating DTA or not? Yes, we are creating DTA only. There also, first more expense is there in what, sir? Accounts, less expense in tax, so more taxable income. So tax more we are paying, deferred tax asset, but still there we say reasonable certainty is sufficient because these are common for any entity. This is not for a company who are having bad financial position. This is for a company who are having bad financial position. We require, in future, will you continue or not? Will you be a going concern or not? For that, we ask for a strong proof called as virtual certainty. There is virtual certain requirement that there will be sufficient taxable income in future. Sir, have you all understood? So this is the rules for creation of DTA. Sir, shall I proceed? Okay. So let me show you, sir. Now, the same will be there in material also. Don't worry. This is a revision class. I cannot give you time to copy. Don't have a problem in giving, but other standards are there. So thereby. Now look at this question, sir. Once again, I would like to cover as many questions as possible in this standard, sir, because many feel this standard as difficult. That's why I'm covering. Now please observe carefully, sir. Quickly. Question number 4. We'll take just 10 or 15 minutes and we'll close this standard. In the last 45 minutes, we'll cover those balance 2 standards, AS 29 and AS 17. 24, depending on the time. Sir, logic is very simple. Even if I spend time on AS 24, no big use for you. But if I spend time on AS 22, I think you have got some good value addition. Maybe you have not read well previously or revision is not done. This is very much sufficient for examination for that reason only. Okay, right. Now let me continue, sir. Quickly, let me continue the 4th question. PQR Accounting Limited, sorry, PQR Limited accounting year ends on 31st March. Company made a loss of what, sir? 2 lakhs for the year ending 31st March 15. For the year ending 31st March 16 and 17, it made profit of 1 lakh and 1 lakh 20,000. It is assumed that loss of an year can be carried forward for 8 years and the tax rate is 40%. By the end of 31st March 15, company feels that there will be sufficient taxable income in the future years against which carry forward loss can be set off. That means they are telling certainty is there. Please allow me to create DTA. That is what they are telling. Okay, there is no difference between taxable income and accounting income except because of that carry forward loss in the year ending 16 and 17. Prepare a statement of P&L for each of the years. I think you know how do we prepare P&L, sir. First we write profit before tax. From that we have to reduce tax expense. In that current tax will be there, deferred tax also will be there. Now please observe what will be current tax of year 1, sir. I think current tax has to be based on income only. First year will there be any income? First year will there be any income? Sir, company made a loss, so thereby income will be 0. Current tax will not be anything, sir. In the second year, I think you are having a, now please observe, sir, whatever profits you are having, sir, based on that we have to apply the tax rate. Now you will get it. So how much, sir? 1 lakh. Okay, third year 1 lakh 20. Okay, anyway, let me tell you one thing. First, deferred tax you make it clear, sir. Current tax you can compare. Let me just quickly tell you the deferred tax. Now, first year you could observe 2 lakhs loss was there in accounts. Sorry, 2 lakhs, 1 lakh and 1 lakh. Now, what happened, sir? What is it? It is assumed that carry forward loss was there. Okay. First year company made a loss, sir. Okay. So because loss was there in the first year, what will happen, sir? That maybe that is carry forward loss, sir. What they are telling is this loss was not observed in taxation. Hello, this was we are not booking in taxation. We are booking only in accounts. Please understand, accounts only we can book the loss, sir. Tax, it will be carry forward. So thereby more expense is there in accounts or taxation accounts. So that means less expense in tax. So first year what will be created? Less expense means more income, more tax. So it is deferred tax asset. So first year deferred tax asset will be created. How much? What is the difference of first year? 2 lakhs. 2 lakhs into 40%, 80,000, that will be created. Is that clear, everybody? Now come to the next year. Hello, come to the second year. What is the second year, sir? It made a profit of 1 lakh. Now tell me, in accounts profit will be there 1 lakh. In taxation, will you record any profit? No, because that will be adjusted by carry forward loss of last year. Sir, are you getting the point? Anyway, from the second year onwards, what, sir? It become reversal. Hello, it became reversal. In the second year, what will be the difference? Once again, that 1 lakh, that 1 lakh into rate 40%, that will be reversed in the second year. In the third year, another 40,000 will be reversed. Sir, are you getting the point? Because third year, we have to reverse only to the extent of 1 lakh. 20,000 means extra profit only, which will be there booked in both. Hello, which will be booked in what, sir? Both accounts as well as tax. Really, when you will pay tax, sir? First year will you pay tax? No. Second year will you pay tax? No. Only when you pay tax in third year. That too on how much amount? 20,000. That is what we have written in current tax, sir. 20,000 in 40%. In which year we will pay current tax? Last year only. 20,000 into 40%. That will be the current tax of the last year. In all other years, first year DTA will be created. In all other years, DTA will be reversed. What is profit before that, sir? 2 lakhs loss. Now this is 1 lakh profit. This is 1 lakh profit. 1 lakh 20,000 profit. Sir, is that clear, sir? Now first year asset was created. Creation of deferred tax asset means, will we add to the tax expense or will we reverse? Deferred tax asset is like a prepaid expense. Hello, sir, are you getting the point? Reverse. So that means reduce. Reduction of expense is what? Addition. The expense has to be reduced. That means reduction of expense is addition. Thereby it became 1 lakh 20 negative in the first year. Accepted? DTA means expense has to be reduced. Reduction of expense is positive. Thereby it became 1 lakh 20. Current year DTA reversal. That means expense has to be created. Expense created means reduction only. So 1 lakh minus 40, 60,000. Third year also expense creation. Reversal of DTA means expense to be added, sir. So once again 1 lakh 28 minus 40. How much, sir? Sorry. This has to be reduced. This has to be reduced. Totally reduced, sir. 72,000. So this is the P&L statement of all the 3 years. Sir, have you all understood? Everybody discussion clear? So with this, this concept also completed, sir. Let me move to last 2 concepts, sir, with which we'll close this discussion. One is tax holiday period. Hello, what is that? Everybody, please look at this concept called tax holiday period. What is this tax holiday period? Maybe you might have seen, sir. Generally, when you establish industries in any backward areas, when you establish industries in backward areas, they'll say first few years you need not pay the tax. Am I right or not? So like that, something called as tax holiday period will be given. So now please look here carefully. Let us take one example. Depreciation. How much, sir? Depreciation. Let us assume it is 100 lakhs we have purchased an asset. 100 lakhs we have purchased a asset. Now, sir, first of all, you should know one thing. Sir, during tax holiday period, we don't pay tax. So shall we record incomes and expense in accounts and tax separately? Is it required? Because we don't pay tax. Is it required? Yes. Because suddenly after 5 years, when you start needing differences, now you cannot get it back, sir, if you don't maintain records. So records will be maintained as usually. Only one thing is, current tax, though you are having some amount, you will not pay anything. That's all. The only difference is in the case of tax holiday period, after computing current tax, though some amount is there, you will not pay anything. That's the only thing, sir. You maintaining records, everything is common. Let us assume tax holiday period is 5 years. How many years, sir? The tax holiday period is how many years, sir? 5 years. Now please observe carefully. First, in asset was purchased for 100 lakhs. Life is 10 years. Now in taxation, let us assume that depreciation was provided entirely in first year, like scientific assets. So there will be 100 lakhs depreciation provided in tax for first year. Let us assume the life is what, sir? 10 years. So it is provided every year 10. Sir, are you getting the point? Now can you please tell me in the first year what is the timing difference? First of all, is this timing difference or not? Yes. Timing differences, deferred tax has to be created first year. Deferred tax asset a liability. More expense in tax, so taxable income will be less. It's a deferred tax liability. So we are creating deferred tax liability. How much you will create? How much you will create? What is the difference? 90. 90 into 30%, assume. 90 into 30%, 20%. Sir, why do you create this deferred tax? What do you feel? Sir, ultimately the tax we pay is same. Tax we book is also same. Just we are making the difference, we are adjusting the timing difference. That is your logic. Am I right or not? Usually, why do we create deferred tax, sir? They are also expense same. Here also expense same. Ultimately, the tax you pay will be the same as per the accounting tax also. Tax paid here and tax paid there will be same, but timing will be different. That's why we are creating what, sir? Deferred tax asset. But my problem is, though you say 90 into 30%, 27, assuming that first 5 years is tax holiday period. Now, do you think in year 2, where once again there is a difference of 3, in fact difference created in first year, and every year 3 should be reversed for how many years, sir? 9 years. Am I right or not? This is what will happen, sir. Now the point is, do you think in the first 4 years you will pay the tax of 3? That extra tax of 3. What we have thought, sir, this year we have paid less tax, so in next year we'll pay more tax. So that's why we are creating deferred tax liability. Next year we feel that we will pay more tax. But the point is, in the next 4 years, are we paying any tax, sir? No. So thereby the deferred tax concept only goes wrong. What is the deferred tax means? Paying less now, in future we'll pay more. Just timing is difference we are creating. That's why what standard says is, sir, if you are creating deferred tax, ensure that it reverses after tax holiday period. What I have said, it reverses after. Because if it is reversing after tax holiday period, from year 6 onwards, I'll pay or not? Yes. So what the standard says is, deferred tax need not be created for those differences which arise in tax holiday period and which will reverse also within the tax holiday period. Out of this 27, 12 will reverse within the tax holiday period, and within tax holiday period only reversal. 15 will reverse what, sir? After the tax holiday period. What the standard says is, within the tax holiday period means you need not create only, because anyway you will not pay it. After the tax holiday period only you create. That means DTA required is not 27, it is only how much is getting reversed? 40. Real difference is only 50. 50 into 30% you create only 15. 15 will be created in year 1. That will be reversed in year from year 6 only, sir. Deferred tax should be created in the year in which difference originated only. Just because it is reversing in 6th year, you cannot go and create in 6th year. First year only should be created, but reversal will happen from year 6 onwards. That is when reversal starts. Have you understood, sir? First point is what, sir? Deferred tax should be created for those differences which arise within the tax holiday period and which also reverse within the, if it arises and reverse within the tax holiday period, should not be created. Arises and reverse after the tax holiday period, for that only should be created. Have you understood, sir? Now, here the question is very simple. I have done a good discussion. Let me change the question a bit, sir. In the same example, if I change the question little bit, assume that suppose in Income Tax Act it is 50% depreciation for first 2 years instead of 100, 50% in first 2 years. That means let us assume 50 in first year, 50 in second year. Now can you please tell me total how much difference created here? First year 40, second year 40. That 80 difference will be reversed over the period. In other words, total 80 into 30%, 24 is created. That 24 only reversed over the 8 years period. Same discussion. Now those differences which arise within the tax holiday period and which will reverse within the tax holiday period, for that deferred tax need not be created. Now tell me, assume the tax holiday period is 5 years. For how much I should create? Out of the difference of total here 40, here 40, for how much I should create? And in which year I should create? It should be created in the year in which it originates. Now you get a doubt. Sir, what is being reversed? Is it related to first year? Is it related to second year? For that purpose, standard is giving an assumption FIFO. Hello? The reversal will happen in which basis, sir? Standard has given an assumption that take this basis, reversal will happen on FIFO. If reversal happens on FIFO basis, that means 30 reversal belongs to first year only. As a result, first year will create only for 10. 10 into 30%, 3. Second year 40 into 30%, 12. So in this way will be created. This 15 will be reversed over the period. Every year 3. So 3 points I have said. If tax difference arise and reverse within the tax holiday period, deferred tax not required. After the tax holiday period, reverse deferred tax needs to be created. When it should be created? In the year in which difference originated. For that purpose, reversal happens on which basis? FIFO basis. So these are the 3 points that you should know. Sir, have you all understood the concept? This is called deferred tax concept. Now let me show you, sir. Beta Limited is a full tax-free enterprise for the first 10 years of its existence and is in the second year of its operation. Depreciation timing difference resulted in a tax liability in year 1 and year 2 is 1000 lakhs and 2000 lakhs. From the third year, it is expected that timing difference would reverse each year by 50 lakhs. Assuming the tax rate is 40%, you are required to compute deferred tax liability at the end of second year and any charge to P&L. First of all, tell me, what is the total tax holiday period? Full tax-free enterprise for the first 10 years. Okay. First year, depreciation timing difference, how much? 1000 lakhs. Second year, 2000 lakhs. Okay. Within first 10 years, every year, it will reverse by how much amount? 50 lakhs. That means first year created, second year also created. Reversal will start from third year. How many years reversal will happen? 8 years. That means how much will be reversed? 50 into 8, 400. So thereby this reversal belongs to first creation, second creation, first creation. So thereby 1000 minus 400, 600 you will create the difference, and in second year you will create on 2000. So 600 into 40%. So it is 240 in first year. In second year entire 2000. 2000 into 40%, 800. Second year closing balance will be 800 plus 240, 1040. Have you all understood, sir? This is called tax holiday period concept. Let me discuss last concept. Within 5 minutes we'll close. Don't worry, sir. As promised, I'll complete the balance 2 also. AS 29 and AS 17. Max, I'll take 5 minutes extra. That's all. Okay, right. 5 minutes only I have said. Sir, my intention is very clear. Many of you may not have prepared this standard very well. I want to make you good in this standard. That's all. Nothing more. Other standards also I want to complete it. For this purpose, I am removing my S24, which is simple, which you can complete. That's all. Now let me go to the last concept, sir. MAT. Hello, what is that? Not MAT. Hello, it is MAT. Minimum alternate tax. Now what is this concept MAT, sir? Let me tell you quickly. Everybody please observe carefully, sir. What is this concept called as MAT? Generally, sir, income tax provide various tax exemptions if you establish industries in backward areas. Now itself we have seen. They will provide various tax exemptions. Now, generally, if they provide more tax exemptions, it will be helpful to the companies. Am I right or not? They will not pay any taxes, so that they can run their operations very well. But there are many companies who have started misutilizing this concept. There are many companies who have started misutilizing this concept. How, sir? Let us say, on the first, whenever you establish in a backward area, you will get first 5 years, no taxes. 4 years established in one backward area. If there they have said, operations are not good here, I will move to another backward area. Hello? Operations are not good here, I will move to another backward area. Here worked for another 3 years, operations are not good, I will move to another backward area. What they are doing? claiming tax exemptions and nothing else. Are you getting the point, sir? Not accepted. Many people have started doing like this, sir. They are claiming subsidies, they are claiming tax exemptions, but later on they are not doing benefit. Why we are tax exemption? We giving tax exemptions. Okay, after 5 years, when they get profitable, they'll provide good employment to the people nearby. They'll provide good taxes to the government. These were the logic. But everybody started exploiting the exemptions purpose, sir. What they have started doing? Shifting. Hello. After few years, they have started shifting to claim another area. This became a wrong concept. Thereby, Income Tax Act started a new concept called minimum alternate tax. That means though you are claiming tax exemptions, still you should pay me some tax. Hello? Still you should pay me some tax, which is called minimum. Everybody, whoever is claiming the tax exemptions, they have to pay me tax, which is called as minimum alternate tax. For that purpose, there is separate computation, sir. How profits will be computed, how that book profit will be there. On that some tax rate will be applied. So tax we pay here is called as what's that? Minimum. You need not pay me full tax. Minimum I will prescribe. This much tax you have to pay so that evasion of taxes can be avoided. But you may feel, sir, if they say like that, then there might be some genuine companies who are really establishing in backward areas. If we ask them to pay the tax, now they are losing that. No. Okay, don't worry. So if you pay tax like that in the tax holiday period, later on you can get reversal. In other words, to that extent I'll give you reduction. Once again, are you getting the point? Which is called as MAT credit. Hello, what is that? Just like your input tax credit. If you pay tax, you can later on get it as a credit. If you pay MAT, later on you can get it as a credit. When you can get it as credit? When your current tax is higher. Hello, what is current tax? Tax as per normal tax, income tax laws. Whenever your income tax as law is, two acts are there. Income tax act only. Within that, another section they have brought called 115 JB or something. 115 JB something. Now, under that they have created separate provision, separate computation. If that tax amount is higher than the current tax, usually what will be paid to government is current tax or minimum alternate tax, whichever is lower. Hello, are you getting the point, sir? Current tax is normal tax laws, or minimum alternate, not whichever is lower, sir, whichever is higher. You will pay whichever is higher, because current tax means normal tax laws. You will apply normal tax exemptions, it will become zero. Now in MAT, what we will do? We will not allow those normal tax exemptions. We will ask you to pay some tax, which is called minimum tax, minimum alternate tax. Later on, you will get this as a reversal called as MAT credit. When you will get is when your current tax is higher. If your current tax is higher, then you will be paying what, sir? Current tax. Their reversal will be there. As a result, you can pay less current tax. This is called as MAT concept, where first you will pay minimum tax even during the period of tax exemptions. Later on, you will get reversal. But let me tell you one thing. If you have understood this concept, very good. If you have not understood, very, very good. Because MAT concepts are required for income tax, not required for AS22. For AS22, normal tax laws only applicable. That means totally accounts is there, normal tax laws are there, 115 JB tax laws are there. For deferred tax, these two only compared. Though for paying the tax to the government, they will compare these two and pay higher. For our purpose, we'll always compare only these two. That means what you should know. If they give anything called as MAT, ignore it and compute in the normal way. Hello? If they give anything called as MAT, don't confuse, compute in the normal way your deferred tax, you will get the answer. Sir, is that clear? So that is what we are going to do. Let me show you, sir, one question. Because ultimately we will not consider that and we will pay only normal tax. But just a presentation will be different, sir. Quickly, let me proceed, sir. Look here carefully. From the following details of A Limited, for the year ending 31st March 2017, calculate the deferred tax asset or liability as per AS22 and amount of tax to be debited to P&L. Can you tell me what is accounting profit, sir? 6 lakh. Book profit as per MAT, 3 lakh 50. Book profit as per Income Tax Act, 60. What two we will compare? Accounting profit and profit as per Income Tax Act. Ignore wherever MAT is there. What is the difference? 5 lakh 40. What is the tax rate? Not MAT rate. What is the tax rate? 20%. 5 lakh 40 into 20%. Deferred tax is 1 lakh 8,000. Sir, are you getting the point? Deferred tax liability, asset. More profit is there. Sorry, less profit in tax. So less taxable income, less tax you will pay. So because you are paying less tax, it is creation of DTL. Deferred tax liability will be created. They're asking amount of tax to be debited to P&L. How do you find amount of tax, sir? How do you find amount of tax, sir? This in this way, sir. Current tax plus deferred tax liability plus excess of MAT over current tax. Because whenever if MAT is higher, what you will pay to government? MAT. So in that case, that extra portion also will be covered. For that purpose, we will show this, sir. But actually what I say is for computing deferred tax liability alone, that is not required, sir. Now here, let me show you. Presentation is somewhere different, sir. But concept is same. We'll ignore the MAT. Presentation is different. What is the total tax expense? It is very simple. 6 lakh into 20%, 1 lakh 20. That will be considered as equal to current tax plus deferred tax. What is current tax, sir? 60,000 into 20%, how much? 12,000. Just compute this one also for your additional. 3,50,000 into 7.5%. 26,250. So anyway, you have to pay what, sir? Whichever is higher. You have to pay whichever is higher. First, for computing deferred tax, they'll make the normal equation and find the deferred tax. Because deferred tax, how it is found, sir? Normal tax laws and accounting. For that purpose, they have framed an equation in 1 lakh 20. If current tax is 12,000, this is deferred tax. In that way, we have found. Instead of doing that, straight away what we can do? 5 lakh 40 into 20%. This is deferred tax. Now, P&L amount is 1 lakh 8,000 common, sir. Actually, current tax is only 12,000. But because MAT is higher, what you will pay to the government? Current tax or MAT? MAT. So thereby what is the excess? 14,250. That also has to be shown as expense. That's all, sir. In that way, you will compute the amount debited to P&L. Deferred tax computation is same. Instead of finding directly, they first write in the equation normal way. There they'll find the difference as the deferred tax. Instead of that, you can find in the normal way. 6 lakhs minus 60 into 20%. In that way, we are closing the discussion on AS 22. I think it's like a full standard getting completed in 1.5 hours. Okay, but I don't bother at all, sir. Though we have taken 1.5 hours, it is justified. Okay, right? Now let me quickly complete the other standards, sir. Not an issue. First, AS 29. Sir, everybody, please look here. 2 standards are there. 17 also I'll cover. Don't worry. Maybe I'll take 10 minutes extra max. That's all. But I will close it. Time by time increasing. Okay, don't worry. I'll close it, sir. 40 minutes there. 20 minutes sufficient for each standard, sir. 7:27. 30 minutes. Already 3 minutes extra. 2 minutes is there now. 32 minutes. By 8 we'll close it. Okay, right? Sir, everything for you only. What I'll get for 8 minutes. Okay, don't worry. Don't worry. Don't worry. More completion is required, sir. That's all. Nothing is there. Okay, if you waste the time like this, another 2 minutes will be extended. So let me proceed. AS 29. Look here carefully. Sir, AS 29, the standard name is Provisions, Contingent Liabilities and Contingent Assets. Provisions, Contingent Liabilities and Contingent Assets. Now, in that we are talking about provision. Sir, throughout the standard, we will revolve only around provision, mainly. Provision, definition I am giving, it's a liability. Hello, what is that? It's a liability measured with a substantial degree of estimation. Sir, creditors is also liability, but will we say it provision? No. Why? It is accurate. It is not requiring any estimation. Any liability which is measured with a substantial degree of estimation, that means more estimation is required, we will call it as what, sir? Provision. So what is a liability? Your framework should tell you. Hello, what is a liability? It's a present obligation arising from a past event from which or which is expected to result in outflow of resources which are certain. Something I have said. Do you remember anything, sir? Outflow of resources are certain. 3 things should be there. First of all, there should be a present obligation. Next, there should be a past event. Next, there should be outflow of resources which is certain. So this is important, sir. Now, what is present obligation? If probability of losing or probability of doing something, if it is greater than 50, If the probability of you losing something or making some payment is greater than 50, it is present obligation. If probability of losing is less than 50, it is possible obligation. Hello, what is that, sir? Present means probability is, if the obligation probability is greater than 50, that is present obligation. If the obligation probability is less than 50, that is possible. It should be what, sir? Present obligation. There should be a past event which is giving rise to this obligation, and outflow of resources should be certain. That's why provision for doubtful debts. What is that? Provision for doubtful debts, provision for depreciation. These are all not provisions as per AS 29, because outflow of resources will not be there. Outflow of resources are there, then only we'll call it as a provision as per this standard. So discussion clear? Okay. So this is the definition. Now we'll deal with some questions, sir, where we are going to check each of these conditions, just like our AS4. In AS4 morning, we have seen different conditions. Check whether each of the condition is satisfying or not. Exactly in the same way, I'll just take 3 or 4 questions where we'll analyze whether each of these conditions are getting satisfied or not. Then we'll have a full clarity. I'll just open the questions, sir. Because in AS29, more and more only application will be there, sir, rather than any new concepts. AS29. I'll just deal with 4 questions, sir, relating to provisions. 3 or 4, that's all, not big. Anyway, remember by 7:50 at any cost, I'll close this AS29. Whatever is the concepts completed. 7:50, I'll start AS17 till 8:10, it will be completed. I've said you, sir. Okay, anyway, let us not extend the time. If you disturb 8, okay, right. Don't worry. Now, first question, sir, quickly. A case has been filed against the company in the consumer court, and a notice for levy of penalty of 20 lakhs has been received. Company has appointed a lawyer to defend the case for 2 lakhs. 50% of the fees has been paid. Balance 50% will be paid after the finalization of the case. There are 75% chances that penalty may not be levied. First thing, is there any past event? Case has been filed. Okay, is there present obligation? What is the present obligation? Means if the probability of losing is greater than 50, they are only telling penalty. Okay, penalty may not be levied. So thereby that means present obligation is not there. So if present obligation not there, definitely penalty should not be created. Sorry, provision should not be created. However, sir, fees is compulsory whether you win the case or lose the case. So thereby already 2 lakhs was the fee fixed as fees, sir. For that you can create a provision. Of course 50% is already provided. Balance 50% you have to create. Sir, discussion clear? Penalty depends on the obligation. Whereas fees, it doesn't depend on obligation. You have to pay it whether you win the case or lose the case. Simply you have to create the provision. Question number 2, part A. Sun Limited has entered into a sale contract of 5 crores with X Limited during 2015-16. Okay, the profit of this transaction is 1 crore. Hello, what is the profit? 1 crore. The delivery of the goods to take place during the first month of the 16-17. In case of failure of Sun Limited to deliver, a compensation of 1.5 to be paid. We have agreed to deliver some goods to third parties, sir, in April. If at all we fail to deliver, then we have to pay a compensation. Sun Limited planned to manufacture during the last month. As on balance sheet date, the goods were not manufactured, and it was unlikely that Sun Limited will be in a position to meet that contractual obligation. First of all, tell me, past event is there? Yes, that agreement that you agreeing for compensation. Now, is there present obligation? Present obligation means probability of losing should be greater than 50. They are only telling that it is unlikely to meet the contractual obligation. That means it is going to lose. They are going to lose only. So present obligation is there. Outflow of resource will be there. Yes, 1.5 is certain. Estimation only, sir, because later on court may change. Some happenings may be there. So thereby all the 3 conditions are satisfied. Present obligation is there. Past event is there. And similarly that one is also there. So provision has to be created for 1.5. They are telling one more thing. Should provision be measured as an excess of compensation to be paid over the profit? I think the profit on this transaction is 1 crore. Shall I provide only for 0.4 is the point. We should not think like that, sir. Provision has to be separate. Your profit recognition has to be separate. You have to recognize provision normally. It should not be recognized as a excess of compensation over profit. Because if you execute that sale transaction, you will get 1 crore profit. Don't net off. You do it on a gross basis. That is what the concept. The discussion clear? So that is one important point. Now let me tell you for some special points, sir. Before moving to special points, one last question. Okay, 2 questions. Now look here, sir. CRT4, an oil company has been contaminating land for several years. It does not clean up because there is no legislation requiring cleaning up. Sir, please observe carefully. They are contaminating land for several years, sir. Okay, there is no legislation till now. At 31st March 2017, it is virtually certain that a law requiring cleanup will be enacted after the year end. Is provisioning required for your penalty? Please understand. So at 31st March, they are telling a law will be created. First of all, past event is there. You already done great activity, sir. Don't tell me past event is not there. You have contaminated land for several years. Past event is there. Present obligation is there or not? Yes. If the probability of paying the damage is greater than 50, they are only telling the law is definitely going to be enacted. If it is enacted, already over, activity done, you cannot rectify also. So damage you have to pay if that law is enacted. So probability of law enacting is greater than 50. So thereby present obligation is there. Anyway, outflow of resource also on a best estimate it is certain. So we can say provision has to be created. So please write down those 3. Amount is measurable. Present obligation is there. Similarly, outflow of resources are required, and tell that amount is also measurable. Like that we have to say, sir. Okay, anyway, what is the answer, sir? Yes. Now, let me proceed, sir. Okay. Question number 6, be careful, sir. Question number 5 also important, but somewhat easy compared to question number 6. Based on time, we'll proceed. As per new legislation, an entity is required to fit smoke filters to its factories by 30th November. If it is delayed, entity has to pay 10,000 as penalty. The cost of purchase of smoke filters amounts to 3 lakhs. Entity has not purchased and fit the smoke filters on 31st March 19. Should it make a provision on 31st March? What is the due date of fixing smoke filters, sir? 30th November. By 31st March, is there any obligation to fix that smoke filters? No. So you will not be created any penalty as on 31st March. So nothing. So is there any requirement to create a provision? No. As on 31st March, no provision is required. Second, assuming that entity has not installed smoke filters till 31st March 2020. Next year, by next year also smoke filters not installed. Now tell me, shall we pay that if it is not installed, so shall we create provision or not? Yes. Provision for what? For installing smoke filters, for penalty. Please understand, provision means obligation should be there which you cannot escape. Sir, suppose they came to me and said, you should install smoke filters. Can I say like that? Can they say like that? You want to continue business, you please install. Like that they will say. Then I will say, I will not continue business. Hello? I will not continue business. Can they do anything, sir? No. They cannot force me to do business. So, let us assume, okay, I am not doing business. Then what other person will say? Already you have done mistake, first pay penalty. Now what you will say? I will not pay penalty also. They will throw you in jail. Hello? Already done mistake, you cannot say I will not pay penalty. But you can say I will not continue the business. Nobody can do anything if you say I will not continue the business. In other words, that 3 lakh rupees can be escaped, sir, by doing an alternate action. When alternative is there, it is not an obligation. When alternative is there, it is not a obligation. You are having a great alternative to stop the business. So thereby, that 3 lakhs is not mandatory, but already mistake is done. So 10,000 penalty is compulsory whether you continue the business or not. So provision has to be created for penalty and not for the cost of smoke filters. Sir, discussion clear? Okay, right. With one last point, I will close this provisions definition, sir. With reference to AS 29, how do you deal with the following in the books of accounts? Company operates an offshore oil field where its licensing agreement requires it to remove the oil rig at the end of production and restore the seabed. Sir, oil rig is nothing but for extracting the oil big rigs are required, just like it will like big boat, not boat also, big, almost 10 to 100 boats, it will be size of that, sir. A big oil rig will be there. So it was installed. Removal also takes some big time, sir. Now what they are telling is 85% of the costs relating to removal of that rig which was established and restoration, 15% arise through extraction of oil. At the balance sheet date, rig has been constructed, but no oil has been extracted. Now tell me, sir, already oil rig was constructed. We have not started extracting the oil. In future, cost will be there. In that 85% is related to removal. 15% is related to extraction. Tell me how much I should create provision. Assuming that this business may continue, tell me, 85 or 100? Please understand, you can say, I will not do business. In such a case, 15% is not required because you may not extract the oil. Suppose I say, I will not remove the oil rig. Allowed, already installed, sir. Already installed. If you have done something mistake, now they will not allow you if you don't remove it. You have to remove. So for removal, how much is required? 85%. So definitely 85% created. For that 15, it depends on your decision whether to continue or not. Because escaping is possible for 15. Same discussions. Because escaping is possible. You have to create only for 85. The discussion clear? With this basic definition of provision is completed. Let me tell you a few special points with respect to provision. Everybody observe carefully. There are some special points, sir. First, provision should not be discounted. Hello, what is that? Maybe you might have seen in AS10 PPE, decommissioning, restoration and other similar liabilities where we write a discounted value. Sometimes you may need to pay liability at the end of third year or fifth year, but shall we discount it? Not required. It should be before tax. You need not provide provision after tax, sir. It should be what, sir? Before tax. Next comes the main point. Risk and uncertainty should be considered. What should be considered, sir? That means probability factor should be applied. What is that, sir? Probability factor should be applied. Probability factor should be applied. What do you mean by this? I'll tell you, sir. Look at this question. Probability factor. Now, you could observe, sir, here they are telling A Limited provides after sales warranty for 2 years. Based on the past experience, company has been making following policy for creating provision for warranty. Provision for warranties will be there, sir. So past event is there, sale of goods. That means you might have agreed present obligation. If you feel that repairs they will come, present obligation will be there. Warranty will create on the remaining balance warranty period. If it is less than 1 year, if the warranty period remaining is less than 1 year, that means already usage period is more chance for repairs. So 2%. If it is more than 1 year, 3%. Company has raised invoices like this. Now you could observe, sir, based on these dates, you have to observe the period. If it is less than 1 year, 2%. If it is more than 1 year, 3%. Like this will be there. But of course, this question is probability factor should be applied means, sir, the same point applies for contingent liability also. What is that? Probability factor. This point applies for contingent liability. Here I will show you. At the end of the financial year ending on 31st December, a company finds that there are 20 lawsuits outstanding which have not been settled till the date of approval of accounts by the board of directors. The possible outcome as estimated by the board is as follows, sir. Probability of winning what, sir? 100. Sir, tell me, is there any requirement of provision? No. Please understand. If probability of losing is greater than 50, then only provision. Next 10 case winning. Probability what, sir? 50. Greater than 50, no. Losing 40. With low damages 40, high damages 10%. Third case winning what, sir? 50. Once again here also 30 and 20. Now in this question actually they will not ask you to compute actually that provision. They will ask you to compute contingent liability. What is that? Contingent. If the probability is less than 50, we will create what, sir? Contingent liability. What I say is probability factor should be applied even for contingent liability. It is 40% probable that loss will be 1,20,000. 10% probable that loss will be 2 lakhs. Now what I say is, to say how much is the contingent liability, you can say 1,20,000 into 40% plus 2 lakh into 10%. You need not say higher amount, 1 lakh 20. You have to apply that probability factor. Here also, what is the contingent liability? 1 lakh into 30% plus 2 lakh 10,000 into 20%. You need not say what is higher. You have to apply the probability factor and then you have to say the amount of contingent liability. The discussion clear? So this is what the application. Here everybody commits one mistake. They forget about this 5 case and 10 case. This is per case, sir. You have to multiply into 5 and into 10. Please remember that. That is a mistake usually committed. So with this point also completed. Let me move to one last aspect. Anyway, because I am telling about contingent liability, let me tell you one thing. If any of the conditions of provision are not satisfied, it will become contingent liability. If any of the provisions of, suppose it's a possible obligation, contingent liability. Present obligation only, outflow of resources not certain, contingent liability. Present obligation only, amount is not reliably measurable, once again contingent liability. Any of the conditions not satisfied means what, sir? Contingent liability. Let me move to one important special point with which we are going to close this AS 29, sir. Reimbursements. Hello, what is that? Reimbursements. Now, sir, we have to observe two things. If seller has an obligation, if seller has no obligation. Seller has an obligation if seller has no obligation. Now I will take one example here to make you understand this reimbursement, sir. It is back-to-back warranties. Hello, what is that? Back-to-back warranties. In other words, maybe you know, sometimes seller will sell you a product, sir, for which manufacturing company may be different. Are you getting the point, sir? So sometimes seller will give you warranty, but who will actually provide the service? Manufacturing company. That is what we are going to discuss, sir. Back to back, manufacturer, retailer, final consumer. Retailer will give warranty to final consumer. Now retailer will claim the amount from manufacturer. Are you getting the point? He will incur some expense, but he will get it as a reimbursement from manufacturer. That is what we are calling as reimbursements. Shall we provide that? What shall be the treatment for it? That is what I am telling, sir. If seller has no obligation, example is online sales, sir. Usually in the case of online sales, seller will be different, sir. Now do you think seller will have an obligation to do warranty, sir? No. Suppose we purchased any Sony company product or any other Samsung, warranty is there. Will we go to seller? Call that Amazon seller. Will we say? No. We'll go to that Samsung shop or any Sony shop. Their warranty will be done. So here seller is having no obligation. If seller is having no obligation, no discussion. If seller is having an obligation, two scenarios, sir. If reimbursement is certain and if reimbursement is not certain. Because sometimes seller will say warranty will be there, but later on when you go, they'll say come tomorrow, come after 1 week. Like that they may say. Are you getting the point, sir? If you feel reimbursement is not certain, hello, if you feel reimbursement is not certain, I am talking about reimbursement from manufacturer. Retailer may provide you, but I am talking about reimbursement from manufacturer. So if manufacturer says reimbursement I will not give or delays it, then what retailer should do? First he should create provision for his expenses, sir. But reimbursement should not be recognized as a asset because reimbursement is not certain. Is that clear, sir? Provision has to be booked for his expenses because he is incurring that warranty. Because he is not getting it as a reimbursement, he should not recognize reimbursement. Sir, reimbursement also certain. Then provision, you book it as a liability because you are telling reimbursement is also there. Book reimbursement also as a asset. Sir, provision will become a liability, reimbursement will become a asset. Sir, in P&L also for provision income will be there, expense will be there, no? For reimbursement is just like an insurance claim, income will be there, no? Yes. So thereby income and expense. So what they say is in P&L you can net off allowed in P&L. Whereas in balance sheet, can I net off, sir? No, you have to show provision and reimbursement separately. No net off allowed, sir. No net off allowed here. Whereas net off allowed in P&L. So hope everybody have understood. This is the concept of reimbursement, sir. If seller has an obligation, if seller don't have if seller has no obligation, it is like online sales. If seller has obligation, like local sales. If reimbursement is not certain, just book provision for your expenses. If reimbursement is certain, book the liability as well as the asset that it is receivable. In P&L, income and expense will be there. No, you can net off. Is that clear, sir? Now let me show you a similar question which everybody usually write wrong, sir, or have a confusion. This question, employees related, sir. I'll tell you one thing. In this question, the company makes a provision of 680 lakhs for pay revision in the financial year. Sorry. Now let me tell you one thing, sir. As per the contracts with the client on cost plus job, the billing is done on the actual payment made to the employees and allocated to the jobs based on hours booked by employees on each job. Now what is happening here, sir? Actually we are having employees. We'll take jobs on contract basis. We'll hire employees. They'll do the work and the payments will be given by the job, whoever is giving that contract. We will collect whatever expense we pay to them plus some 10%. Are you getting the point, sir? Now here, the amount we are paying to employees, is it really expense for us? No, we are getting as reimbursement. But what the standard says is, because you are getting reimbursement, don't try to avoid this as an expense. First you are paying to your employees, you are recovering it later from the company which is giving you that work. First you create this provision. If reimbursement is certain from that company, what you have to do? You have to recognize as a asset. If reimbursement is not certain, only provision. And one more thing, can you net off in P&L? Setting off in P&L is not allowed. This question is based on same, sir. We will pay salaries to the employees. The same we will get reimbursement from another company. Now this is the discussion relating to reimbursement. The same points will be discussed. Is that clear, sir? Hello, have you all understood, sir? P&L net charge you can be nil, sir. You can eliminate both provision as well as reimbursement, but you should show both liability of 680 lakhs, asset of 680 lakhs, provision as well as reimbursement. That's the concept, sir, with which we are closing AS 29. Sir, contingent liability means any of the condition not satisfied, contingent liability, sir. Contingent asset not required, sir. Because nowhere you will record in the books of accounts also. Let me deal with the last one, sir. AS 17 segment reporting. Please observe, we can complete quickly, sir, not an issue. AS 17 segment reporting. Okay. So what we will learn in this standard, sir? First we should know division of segments into two segments. There are two segments, sir. One is business segment, the other one is geographical segment. Hello, how many segments, sir? Two segments. One is business segment. Segments will divide into two. One is business segment, the other one is geographical segments. Geographical segments will divide once again into two. One is by location of assets, the other one is by location of customers. One is by location of customers, the other one is by location of assets. What do you mean by business segments? What do you mean by geographical segment? Very simple, sir. If you are dealing in, let me show you this example. Okay. Okay. Look at this example, sir. Many brands of HUL. There is a company HUL which deals with all these products, sir. Different products it is dealing. I can say, if this many products are there, suppose 30 products are there, can I say 30 business segments, sir? Usually based on products only, business segments will be decided. Based on what, sir? Products. Hello? Based on products only, business segments. Based on locations, how many locations you are working. Based on sales areas, location of customers will be decided. Based on production areas, how many production areas is there? Location of assets will be decided. Usually, if you are having 10 products, 10 business segments. If you are having 10 sales areas, 10 location, geographical segments by location of customers. If you are having 4 production areas, 4 geographical segments by location of assets. Like that, segments will be divided, sir. What we should know is, what is a business segment as per this standard AS 17? Let me tell you one thing. As per this standard, business segment means a distinguishable component of an entity which is engaged in providing an individual product or service or group of related products or services. Something I have said, it may be there in single, I am talking about single segment only, sir. A single segment may provide one product or service or more than one product or service, and whose risks and returns are different from other business segments. Something I am telling, whose risks and returns are different from other business segments. Sir, if risks and returns of two products are same, it should be one segment only. If risks and returns are different, we should say different segments. It is based on risks and returns only. Similarly, location also, sir. Reliance company is having operations in different areas. Joya Lucas is having operations in different areas. If two different areas, risks and returns are same, we'll call them as single geographical segment. Different risks and returns, we'll call them as separate geographical segments. Let me show you how do we call single or separate. I will take an example here. Now you could observe Rin, Surf Excel and Wheel. Hello, what is that? Rin, Surf Excel, Wheel. Everything is from which company? HUL only. All the three are from HUL. Now tell me, do you think risks and returns are different of these three products? Usually they are used as a substitute, and one product and other product prices also will be similar, and share also almost market share also same. Now I can say if they increase the price of all the products, now I think loss also everything will be the same. I think almost the risks and returns of removing one product or adding one product exactly same. I can say three are one segment. Hello, I don't say all the three are separate segments. They should be one segment. If risks and returns are different, then different segments. Otherwise, one. If risks and returns are similar, always it should be having only one segment. Let me take another example. Brew and Lipton green tea. Hello, what is that? Brew and Lipton green tea. Do you think brew and Lipton green tea same, sir? No. Brew is used regularly. Lipton green tea used only those who require health, proper health, they'll use it, sir. So maybe for dieting or something else. Now, anyway, and in fact, Lipton green tea is costly, sir, compared to brew. Now, there are 100 packets you will buy for maybe 400 or something, and brew packets, each packet 2 rupees to 5 rupees. But only 2 rupees difference. No, don't think like that. Doubling is there. Another thing, one brew packet you will use for 2 or 3 persons, or at least 2 persons. Lipton green tea packet, one for only one. If you dump in one's water, you cannot dump in another time. Hello, are you getting the point, sir? So thereby cost will be significantly different. Sir, are you getting the point? So cost will be different and pricings also different. Sir, are you getting the point? If price increase of one product, impact will be different. I can say risks and returns are different. If risks and returns are same, one segment, otherwise different. Let me take you one example which is given in the standard AS 17. This may be asked in exam, sir. Just let me show you. Don't worry, everybody. This is one question which may be asked. So question number 1. Microtech Limited produces batteries for scooters, cars, trucks and specialized batteries for inverters and UPS. How many segments it should have? Batteries for scooters, cars and trucks. Specialized batteries for inverters and UPS. I think vehicles, automobiles will have one nature. Those inverters and batteries will have another nature. Both will have different risks and returns. So thereby, what we can say? 2 segments. Company A is engaged in manufacture of chemicals. Company manufactures 5 type of chemicals that have 5 different applications. Can this company include more than one type of chemical in a single business segment? 5 chemicals are there. Can they include more than one in single segment? Possible, Yes, provided they have similar risks and returns. They're just asking you the question, sir. Can they include more than one in single segment? Yes. So just answer. If risks and returns are similar, you can include it in a single. If risks and returns are different, significantly different risks and returns, they cannot be included in a single business segment. Is that clear, sir? Okay. Now, for the purpose of disclosure, these segments are divided into 2 types, sir. One is primary segment, the other one is secondary segment. Hello, what is that? Primary segment and secondary segment. Sir, if it is primary segment, hello everybody, if it is what, sir? Primary segment, we will give detailed disclosure comparatively. If it is secondary segment, we will give brief disclosure. Accepted? Hello, are you all understanding, sir? Whatever segments are there, we will divide into 2, primary and secondary. For primary segments, we will give detailed information, whereas for secondary segments, brief information. Now please understand, totally how many segments we are having? 3. Out of these 3, if one is primary, balance to become secondary. Suppose geographical segment is primary, business segment will secondary. Of course, geographical segment by another will be secondary. Suppose business segment is primary, these 2 will be secondary. Out of this 3, 1 will be primary, the balance 2 will be secondary. Is that clear, sir? Primary means detailed information, secondary segment means brief. Okay, sir. Suppose business segment is taken as primary. Now you have seen HUL is having how many business segments? That too in example, really many products are there. Can I give detailed disclosure for all these primary segments also? Suppose I have assumed business segment is primary, products are only primary. Now can I give detailed disclosure for all primary? No. For that they have given criteria. Hello, what they have given, sir? Criteria. Let me show you what are those criterias. 4 important criterias will be there, sir, which is very, very important for examinations. Usually in AS17 they will be testing only this aspect, sir, the criteria for a reportable segment. That means out of many primary segments, how do you select which segment should be reported? Very simple, sir. Materiality concept to be applied. What is that, sir? Material. When there are more and you need to pick only few, what you will apply? Materiality. Here we are going to apply which concept? Materiality concept. Now, how do we apply? For that 4 conditions are there. What is that? 4. Out of the 4, if anything is satisfied, any one condition is satisfied, we feel it as a material. What is the first one, sir? It is called 10% threshold criteria. What is that? 10% threshold. Threshold means limits, sir. 10% limits. What is this, sir? Very simple. If segment asset is greater than at least 10% of the total of the assets of all segments. Total of all segment assets. Similarly, if segment revenue is at least 10% of the total of revenue of all segments. Similarly, if segment result means profit, sir. Expense means, okay, revenue minus expense gives you profit or result. Segment result will observe greater than or equal to 10% of total of all segments in profit or total of all segment is loss, whichever is higher in absolute amount, whichever is higher in absolute figure. If in these 3, any of the conditions, that means asset wise you are material, or revenue wise you are material, or profit wise you are material, you are considered to be what, sir? Material segment. Disclosure is required. That means you are a reportable segment. Second one, based on previous year reporting. That means in the last year you have satisfied any of these criteria. Hello, in the last year you have satisfied any of these criteria, then in current year also we'll ask you to report it. That is, we'll continue, because shareholders should know if it is reportable in the last year, what happened in the current year. So if it is reportable in the last year, has to be reported in the current year. That too because of satisfaction of limits. Suppose in the next year, in this year also not satisfied, in the next year will we report? No. Don't say that last year reported. No. That means lifetime it has to be reported. Please understand, once reported means it should be reported because of satisfaction of 10% limits. Then only in the next year also it will be reported. Okay, right. Third year, based on management discretion. Sometimes we may start a new business segment, sir. Now, they definitely will not satisfy any of these limits. But if management wants to show on their own, it is always allowed. Next, based on 75% enterprise revenue criteria. Very, very important. Based on 75%, what, sir? Enterprise revenue criteria. What is this 75% enterprise revenue criteria? Sir, by applying above 3 conditions, if we identify the some segments, now total of external sales of above segments, hello, what is that? Total of external sales of above segments, if it is at least 75% of total external sales, that means of all segments, then it is okay. If it is not 75, then we have to find some more segments to make it 75. We have to make it 75, sir. If it is not 75, then we have to find some segments to make it 75. Straight away we will not understand, sir. Usually these two are not applied in exam. What is applied is only 1 and 4. For that we look after a example. Then only we will have a better clarity. Please look at this question, sir, everybody. Because this is what most important. Usually if they ask a question from segment reporting, 80% chance that they ask this question only. So very, very important. Look here carefully. Similar question, what I say is, X Limited operates through 8 segments, A, B, C, D, E, F, G and H. The relevant information about these segments is there. Sir, if I say in the third condition, last condition, the total of external sales, that means in first condition, when I say segment revenue, it consists of both external as well as internal. Generally, segment revenue means both external as well as inter-segment sales will be considered. If I clearly say enterprise revenue, for the enterprise as a whole, I cannot consider internal, only external will be considered. So please observe. So what is the first condition, sir? 10% threshold. Tell me, as per first condition, which of these segments are reportable? As per first condition, which of these segments are reportable? What is first condition? Total segment revenue. What is the total segment revenue? 600. In that we have to observe at least 10%. A is reportable, B is reportable. That's all. These two only, sir, as per the first. Next, segment assets. What is the total? 100. At least 10%. That means 10. A is reportable, B, D. That's all. At least 10. Sir, even if any condition is satisfied also, it is reportable. Now, let me go to result. Result, what we say is, sometimes a segment might give you heavy loss. You cannot ignore it. That's why they say, add all those segments giving profit. Now, add all those segments profits, sir. 5 plus 15, 20, 28, 5, 33 and 40. 40 is the profits. Losses, 90 plus 5 plus 5, 100. 100 or 40, which is higher, sir? 100. In that apply 10%. 10% of 100, 10. Now, forget whether it is positive or negative. If it is greater than or equal to 10, it is reportable. So, thereby, B is reportable, C is reportable. That's all. These two as per that result. Sir, is that clear? So, in this way, we applied. First one, sir, first test. Second one, previous year reporting, not possible. Third one, that unless given in the question, we don't know. So, tell me, as per these three, of course, first criteria, what are reportable, sir? A, B, C, D. That's all. Am I right or not? Can you please count external sales of these three? A, B, C, D. 255 plus 15 plus 10. It is 280. Total external sales, how much? Only external sales, 400. Minimum, how much should be there after taking these three? 75%. But how much is only there? 70%. So thereby, still I require another segment which gives me at least 75% means how much is required? 300. So I should require another 20. So take either E and another or at least either of the F, G, H. It's up to you. Take any one segment or any other segments which gives you at least how much, sir? 75%. This is what the application. Sir, have you all understood, sir? Very, very important. Like this, you will have these questions, sir. Please observe. Assets, revenue, result. Usually, that last one may not be applied, 75% enterprise revenue. But I have shown you, if at all given, how that should be applied also. Let me deal with one or two important aspects which may be asked, sir. Sir, whenever we say segment assets, in that any deferred tax assets or liabilities should not be considered. In this question, I will show you XYZ Limited was there, 3 segments, X, Y and Z. Total assets are 10, 2 and 3. Of course, 10, okay, total assets is 10. In that 2 is X, 3 is Y, Z is 5. In that deferred tax assets included is 0.5, 0.4 and 0.3. Deferred tax assets need not be computed for the purpose of segment assets. So what you will do, you have to remove what is the real segment assets. 2 minus 0.5, 1.5, 3 minus 0.4, 2.6, 5 minus 0.3, 4.7. Now make the total 8.8. Now 10% of it, if it is there, it is considered as a reportable. Are you getting the point, sir? That means any deferred tax assets need not be considered. How much, sir? 8. So 10% means 0.88. Everything is reportable. So that's the point. Now, sir, usually what is segment assets, segment revenue, segment result, like the definitions will be there, sir. Segment revenue means simply we'll consider 3 things, sir. Directly related, then allocated, and then inter-segment. Usually I have said in contract costing ceremony, construction contracts, directly attributable and allocated. In addition, we will add inter-segment. Here they will give, sir. And few items should not be considered. Sir, only from your business if there is income or expense to be considered. If it is not from your business, it should not be considered. Because for deciding materiality, I cannot take for a segment a non-business income. Are you getting the point? So thereby, any income like revenue from extraordinary items, dividend income, interest, sale on investments need not be considered. There will be one question, sir. They will be giving other income, all these things. Similarly, losses also, any business expenses need not, only business expense should be considered. Other things need not be considered. Simply add those two, you will be getting. Is that clear, sir? In this way, reportable segments will be identified. Is that clear, sir? Examination, these aspects are important. One or two miscellaneous issues may be there. You please read it. With one last point, I'll close. They'll give a company has an inter-segment transfer pricing policy of cost less 10%. Market prices are generally 25% above cost. Can they make an inter-segment transfer pricing policy of less than 10% is the question. Is that pricing policy okay? Now the answer is, sir, inter-segment transfer is up to you, sir. Standard never guide you for that. Hello, standards never guide you. You can make it cost or less than cost or more than cost. Anything is up to you. But whatever you follow, follow it consistently. Hello, whatever you follow it consistently. Therefore, any policy can be adopted if it is followed consistently. It can be based on cost, below cost or market price. Just whatever you follow, you please disclose and follow it consistently. This is also one of the important questions. Usually from segment reporting, they'll ask CRD 7 in examination frequently, and they'll ask CRD 3 relating to this, CRD 2, and the first possibility CRD 1 part A. All those questions which are frequently asked, 80% of the times these questions are only asked, sir. That questions I have discussed. With this we are closing segment reporting. Sir, clear? Have you all understood? I know I have made it quick, but still I have given you the proper aspects. Okay, except AS24 we have completed everything, but I think this is sufficient, sir. AS24, just read it, you will get it, sir. Simple only. So hope you have enjoyed today's session. Got some good value addition. Okay, right, sir. Some good standards complete. Happy for me also anyway. Thank you. We'll continue in the next if required. Okay, right. Bye-bye.